funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India Market Open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information plates into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit. You're watching live from the NDTV Profit headquarters in Mumbai. This is India Market Open.
Very good morning. You're watching India Market Open and a lot to unpack this morning. Fed has kept rates unchanged. Powell's deciding not to go anywhere and will very much stay at the Fed. Brent is close to 120 and no one knows what's going to happen in West Bengal. That pretty much sums it up.
Yeah, I mean, everything under the roof that we need to talk about today, because it's not only global factors, we have something from the domestic front as well, which could be market moving.
Yeah, or market non-moving, I would say, if that was one of the factors yesterday. But suffice to say that the euphoria that we saw yesterday seems to be maybe at risk from what the implied is showing.
It was already dissipating. Remember, in the second half, towards the end, you had the breadth that turned to the negative, and you had the benchmark shave off as much as 160 points.
Yeah.
But another possibility is that if your exit polls are not able to give a direction to the markets today, is there a possibility that Monday will be crucial in the second half once the results come, and that's when you will see that market move?
It could be in either direction.
Either direction.
So the thing with state elections and markets is that there is at best a sentimental move one way or the other. And what the understanding was when the start of the first phase was going on during, the second phase was going on during trade yesterday, is that if you do have a change of guard and a historical entry of the BJP in West Bengal, as some polls at that point were indicating, that would be a shot in the arm for the central government and its policies. You're talking about stability at the center at a very turbulent time, because this is the most current temperature check, so to speak. But the exit polls are showing a mixed bag, and in fact there's one major pollster who's saying that I might not put out my exit polls at all because the data is too mixed. That's My Access India, and that's sort of, everyone looks forward to his poll. So I don't know, we'll have to wait and see what's happening. Here's the global setup meanwhile. US markets have stayed muted as no solution in sight to the Hormuz blockade. Max 7 stocks have reported, and it's a bit of a mixed bag. Indices, if you take a look at it, pretty much all in the red. NASDAQ managed to stay flat to positive. Futures, let's pull up futures as well, because there is now an uncertainty about what's going to happen with the Hormuz blockade. No side seems ready or in any mood to really go ahead and find a resolution anytime soon. The S&P 500 futures, though, about 0.5% up, as are NASDAQ futures. Just a quick look at what these Max 7 results look like. Some came during trading hours, regular hours in the US, some came in after hours. Meta was down 7%, the stock price, because the first quarter capex has disappointed, and this was not what the street was really looking at. Microsoft was also pairing off all gains, closed about flat, negative 1% down. It was a beat though on the top and bottom line. Alphabet came post-market hours and zoomed 7% because Q1 was a revenue beat. Likewise for Amazon, was up about 3% because it was a Q1 revenue beat. Bond yields, meanwhile, jumped as Fed kept rates unchanged, but there was a clear split on rate guidance. So you had the 10-year tick slightly up and above. Oil prices, meanwhile, are zooming as Trump indicates he will extend the blockade. Doesn't seem to be in a mood to remove it. Kept talking about how an 18-hour flight to talk with the Iranians one way was not really worth it. About 120.56 on the Brent. I mean, these were unbearable levels as far as India is concerned. So brace for maybe some pain. But let's listen in to what Donald Trump had to say on the prospects of continuing that naval blockade in the Strait of Hormuz.
We're not flying anymore with 18-hour flights every time we want to see a piece of paper. We're doing it telephonically, and it's very nice. I make a call, or I have my people make a call, and you know the answer. I always like face-to-face. I consider it better. But when you have to fly 18 hours every time you want to have a meeting, and you know what the meeting's all about, and you know they're going to give you a piece of paper that you don't like before you even leave. It's ridiculous. At this moment, there will never be a deal unless they agree that there will be no nuclear weapons.
Okay, no signs of a deal there. Meanwhile, let's talk a bit about what the Fed has done. It was Jerome Powell's final briefing as the Fed chair. He outlined the effects of oil shock on the U.S. and other countries.
Given the fact that we're, a big exporter of energy, and that our economy is far less energy intensive, oil intensive than it was during the 70s, the effects on the United States are really substantially less than those of Western Europe or Asia, who are feeling much greater effects from these things. The effects we're feeling in the current situation currently, and in sort of what's priced in, which is a relatively quick outcome. if this goes on for much longer and prices go much higher, then we'll feel that much more. And of course, I'm talking about aggregate inflation numbers. We know, we're very well aware that people are experiencing higher gas prices all over the country now, and that hurts. And those hikes may continue to happen. And other things are going to start to reflect airline fares, I mentioned, and other products and services that are dependent upon petroleum and derivatives of petroleum. People are going to start to feel that.
Okay. Another interesting part of that press conference is when Powell was asked whether he would leave the Fed because Trump really wants him to, and he says, looking at recent events, that I have no choice but to stay. So I wonder how that's going to pan out. Meanwhile, Asian markets also feeling a bit of heat after all of that uncertainty about the blockade not really ending. We don't know when it's going to end. Nikkei down about 1%. India implied is showing maybe 120 points downtick on open. Now 140 points downtick on open as we start off. Sonal Verma, Managing Director and Chief Economist, India and Asia, ex-Japan Nomura with us. Jonathan Barrett, Chief Investment Officer, ETO Markets joins us today as well. Sonal, very good morning. I'm going to start with you. About 3 months since the whole US-Israel-Iran war began, and we have no resolution in sight, Brent at 120. How does this place India?
Well, yeah, we are in week 9 already. And I think, clearly the energy shock is a major shock for the Asian economy, speaking more broadly, because these are major net energy importers. And a big part of this energy actually is via the Persian Gulf. And when we look at the vulnerability across Asia, I mean, it's not similar. There is a differentiated impact across different countries in Asia. There are the more vulnerable ones like Thailand and Philippines, and I would put India in the top 3-4 in terms of the energy vulnerability. So it is clearly vulnerable. That said, I think actually the impact has been more manageable so far, and I would say better than expected because there was some inventory to draw down. The government has, and companies have contracted supplies from other players, even at higher cost. We've seen energy rationing measures, increase in LPG production. So a lot of stuff has been done on the supply side, basically to enable economic activity to chug along, and things like industrial production numbers actually have held up despite the big drop in fertilizer production in the month of March. Now, as we go forward, I think we're now reaching that point where we need to be a bit alert in terms of the physical supply shortages starting to show up going forward. So that is essentially, one thing we are monitoring. And second, the price shock is now relatively broad-based across different energy complex and is spilling into various other downstream industries as well. So one, will the government change fuel prices given the burden on OMCs? And two, as corporate margins are under pressure, will companies pass on a bigger share of this cost to consumers? So I think some of these effects is what we are monitoring right now for India.
All good points. On Brent crude specifically, though, I need to ask you, Jonathan, at 120, and there seems to be no panic. This is pretty much at the highest point it has been since the conflict started, in fact, higher. So what's going on?
Yeah, look, I think that's a very good question. And we're just trading up through 121, 121 and a half at the moment. I think it's a combination of events which have caused this. Obviously, what Donald Trump has come out and saying this could go on forever. Whilst it's going on forever, limited supply goes through the market, through the straits. That becomes an issue. We've got a crisis in OPEC, obviously, with UAE sort of taking itself out of that. Will we see more members make the same decisions to determine their own future? So there is this general feeling in the market that prices are just trading high because there's no clear direction in how we're going to resolve it. And to your point earlier, Trump was saying, oh, look, we're not going to travel anywhere 18 hours to have a discussion. I mean, those sorts of comments don't add strength to the fact that they're trying to resolve the issue. So yes, very well bid at the moment, and it's going to play out in the inflation numbers going forward.
Good morning, Jonathan and Sonal. Sonal, let me come to you first. Let's club this in with regards to what's happening with crude. As Alex just mentioned, we are at $120 and there is no sign of really any alarms that are ringing right now. Now, to add to that, in India, you have the state elections, which probably will be behind us now already. Do you think the government will use this opportunity, Sonal, to go ahead and hike oil prices, and this will be at retail level, number one? And two, with the data that the exit polls are indicating right now, what direction are you seeing private capex move then?
Yeah. So I think like the official comments from the government side has been fairly clear that they do not intend to hike pump prices even after the state elections are over. Now, we know that the under-recoveries for oil marketing companies on petrol, but most particularly importantly on diesel, has been rising. It was close to 40 rupees per litre on our estimates for diesel about a week back, and it would have gone up in recent days. So the losses for OMCs continue to rise. So I think it's sort of a tough tussle between the government wanting to keep stability in prices for the broader consumers versus the losses for OMCs, which ultimately will show up in terms of the higher fiscal burden. It is possible that, if the view from policy officials is that the conflict and particularly, the elevated oil prices may be with us for a month or two more, beyond which it will settle down at a level which can be accommodated, then they may not immediately hike fuel prices even after state elections, but wait it out for a month or so to see whether this is more longer lasting or not. And two is, if there is a decision to hike, it could be more gradual once that decision is made. So at this stage, just looking at the official statements, it looks like a hike may not be imminent. But is something we need to monitor, because the burden on the fiscal side is basically increasing quite significantly if prices are unchanged and oil stays here. On the state election impact on private capex, I think that's a very regional phenomena. So depending on what the final results are, if there is a bigger push towards industrial transformation and infrastructure spending in some of the eastern states in India, then those pockets in East India could become a source of growth. But otherwise, I think key drivers of private capex are more broader in terms of the demand assessment, cost of capital, and of course the uncertainty companies are dealing with right now on the energy shock.
Certainly. In fact, there's so many things that we will talk to you about in the next couple of weeks. Hopefully the conflict will resolve by then. But Sonal, Jonathan, thanks so much for taking the time and for speaking to us this morning. All right. Well, let's talk about what happened in trade yesterday. As much as it sets the context for trade today, equities gained but ended off the day's high. The start of the new F&O series began on a positive note. I think you can take a glimmer of hope from that. The Nifty 50, however, failed to hold on to that 24,200 level, dropped as much as 157 points from the day's high. The Bank Nifty, in fact, underperforming and ending flat in trade, with an underperformance for the PSU banking pack in particular. The market breadth, in fact, turning negative towards the end of the session. It was for the large part of the session favoring the advances, and you saw a cool off, a pretty sharp cool off at the end. Broader markets also gave up ground and ended mixed. You had the mid cap index that ended flat with a negative bias, and the small cap index ending higher by just about 0.5%. Quite a few newsmakers. You had ITC and Godfrey Phillips that rose on account of an NDTV Profit report of price increases in certain cigarette brands. And you had earnings beats that dominated market moves as well. Bandhan Bank, Greenply, and then beyond that, Sapphire Foods and Devyani were some of the key winners in trade yesterday. The latter, in fact, gaining as much as 19%.
Yeah, that's how the setup also looks like, because it's very event focused.
Yeah.
and event-driven markets that we are seeing right now. So clearly, volatility could remain high and event-driven in the near term as well. In fact, markets are expected to react to first the domestic political developments that we're looking at. Your exit polls after the second phase of state elections will be a key event we are watching out for. Secondly, the final results next week are likely to add to the market volatility as well. Elevated crude prices, as well as lack of clarity when you talk about US-Iran negotiations, they continue to remain the key overhangs that the markets will be watching out for. And the ongoing earnings season will further drive stock and sector-specific action. But the key today, from a domestic perspective, is going to be what the exit polls are indicating. And Tamanna is with us to explain to us everything that the exit polls actually mean politically and for the markets as well.
Exit polls, of course, come with their bag of salt because these are all estimates. They often go wrong. And what we've done is we've sort of broken out all of the clutter because you have a whole host of agencies and local agencies in every state giving their polls. So we've squeezed it down to the state and what the poll of polls is. So this is an average of all the key exit polls in that state. Now, let's start with what those polls are talking about. And the most interesting is West Bengal. So this is going to be a dramatic turn of events on the 4th, if you track politics carefully, because the BJP and the TMC are as neck to neck as you can imagine. 143 for the BJP and 142 for the TMC. Those are the seats that are being talked about, which means it's going to be a fight to the finish. Now, these polls could be terribly wrong. It could be a one-way sweep at one side, but the lack of comfort that these polls give the markets might be seen in the price yesterday as well, because the sense that the BJP might come into West Bengal was one of the factors that was driving the markets yesterday. There is so much confusion that one major agency has said they just may not put out their exit poll numbers because there's no clear picture emerging on the ground. The Congress and the left, of course, decimated in West Bengal as per the poll of polls. In Tamil Nadu, you have the DMK looking like they'll comfortably come back. The ADMK not really managing to make the cut, and superstar Vijay's TVK, as per one poll, might have a positive surprise, but the poll of polls puts it down to a good debut and nothing much else. The BJP looks comfortably poised to come back in Assam. The Congress really not doing too well. In Kerala, you have the Congress Alliance UDF, which looks like it will come back to power as well. And in Puducherry, it is the BJP Alliance, which will be in power. So what do you make of these poll of polls? Really, the big story as far as the markets are concerned hinges on what happens in West Bengal. And if there's a positive surprise, you might see some sentimental impact of that at best. But let's talk about some of the other factors in the markets today, because that becomes more crucial. The bigger problems in the world right now, and the index is essentially stuck in a tug of war between bulls and bears. And you see that one day up, one day down, and that's pretty much what's happening. Decent domestic earnings versus a perfect storm of global headwinds. Because if you look at all of the banking earnings, they've done pretty well. But the global picture is not great. The surging oil, a hawkish Fed are all leading to pain points as far as factors are concerned. Market is technically positive but losing momentum. There is repeated rejection near the 24,300 to 24,350 mark. And you've seen that time and again in the last few weeks. You hit those levels and you pull back. There's weak follow-through buying. Rising crude and state election outcomes also become important today, as we've talked about. So this is not a clear trending market yet. I suppose it's as confusing as the West Bengal exit polls. It's a range-bound breakout dependent. So you will have to see some kind of clear breakout and a sustained move above 24,350. Then the targets will move to 24,500 to 24,600. If it breaks below 24,000 to 23,950, then targets now become 23,800. Structurally, it's weaker than the Nifty. That's the bank Nifty I'm talking about, and below key moving averages. So that becomes difficult. Resistance at 55,900 to 56,000, supports at 55,000 to 54,900. So those are some of the key factors to look at. Why don't you start off with what stocks you have on the radar?
Absolutely. Earnings front and center, and that continues to be the case across the board. These are likely to be the big movers in trade today as well. MOIL, I'm going to start with a good one first. Strong quarter driven by higher volumes and realizations. The mining segment specifically remained a key growth driver with solid offtake in the quarter gone by, and these are the factors that have contributed to that strong number. Operating leverage has kicked in, and that bolstered EBITDA growth, particularly on a sequential basis. Margins have expanded on better cost absorption as well and pricing support. Remember, these are commodity companies that have seen the commodity prices move up very significantly. A sequential profit jump has been aided by the improved operating performance. So take a look very quickly at the key numbers here. The PAT number up as much as 75% on a sequential basis. The revenue growth of as much as 28%. Remember, this is sequential. And the EBITDA growth of as much as 43%. Margins coming in at 31.3%. Stellar set of numbers. Schaeffler India was slightly not amazing, but it was a good set of numbers. Strong quarter across the board. You had all of their business lines. You had automotive tech, vehicle lifetime solutions, as well as exports that saw double-digit growth, and margins expanded, but were more or less in line with what you've seen over the last 4 quarters. So take a look at the key metrics. You had an uptick of 19% in the revenue on a year-on-year basis, EBITDA uptick of as much as 22%, and the margins expanding just by about 40 basis points, which led to an improvement of 26% on the bottom line. HEG, and this is, I've left the worst for the last. It's a weak quarter and continued pressure in the graphite electrode demand reflecting in those numbers. Realizations remain subdued on account of global oversupply conditions, and basically there was also a one-off. Other expenses increased by as much as 367 crore rupees on account of the price drop of its listed subsidiary in New York, NYSE. So net loss has widened. Doesn't look like a good picture.
Okay, I'm starting off with Bajaj Finance, the big one. Rajiv Jain steps down from his position as a non-executive vice chairman, if I'm not mistaken, but that was to be expected. The numbers by itself are good. Revenue, that's total income, was up 18% at 21,607 crores. Net profit was at 5,465 crores. PPOP, which was essentially operating profit, was up 21% at 9,408 crores. Net interest income at 11,781 crores. Gross NPA was at 1.01% versus 0.96%, slight uptick there. Net NPA was down at 0.41% versus 0.44%. And AUM, that's assets under management, was up 22% at 5.1 lakh crores. Lots of brokerage calls on Bajaj Finance. I've picked one. Morgan Stanley has maintained an overweight, hikes the target price to 1,120 from 1,090. They say good numbers, stronger commentary. Management said that despite geopolitical headwinds, it's entering FY27 with intrinsic asset quality tailwind. Think this confidence should support the PE re-rating. So that's the one for Bajaj Finance. Adani Power is also a thumbs up. Revenue up 14.2% at 14,223 crores. EBITDA was about 12% up, and EBITDA margin at 33.27% versus 34.03%. So flat. Net profit up 62%. Cantor on Adani Power says strong Q4 exit, improved EBITDA conversion, contracting and capacity build out support FY27 setup. Q4 was a better than expected EBITDA and margin quarter despite some revenue line softness. Of course, standard disclosures there. You're watching this on NDTV, which is part of AMG. That's part of the Adani group. So that's Adani Power for you. The third one is a brokerage note. It's JP Morgan's take on Meesho. They've initiated an overweight with a target price of 215. They say NMV growth can outperform user growth. Advertising is under-monetized and has 3 levels. They treat the logistics cost pullback as a one-off rather than structural issue and see option value from monetizing premium users. They expect free cash flow to recover faster than EBITDA. So Meesho, watch out for quite a few initiating notes on Meesho.
Yeah, I mean, and that has been in focus as well with the kind of moves that we've seen on that counter. On my list, I have two earnings. Vari Energies is one. First up, your rising costs and shift in revenue mix as well as your inventory provisioning is what has impacted margins. So revenues have seen a good growth. EBITDA is up 70%. Margins have come in at 18.6 versus at 23%, and net profits are up 71%. So there is a possibility you could see a positive reaction because clearly your margin downtake is mainly on the back of the capacity addition as well as the kind of investments that they have been making as well. Second up, you have Navin Fluorine, a spectacular set of numbers, exceptionally good earnings, but they've seen a strong recovery in the CDMO business, continued expansion in the specialty chemicals business as well, on the back of which your profits have gone up 124%. Your EBITDA has seen a growth of around 80% and margins have also expanded substantially. It's the increased orders from global pharmaceutical giants and high margin molecules that has fueled the surge in the CDMO segment. Your specialty chemicals has seen a strong demand when you talk about the fluorinated intermediaries in the agrochemical segment, and your HPP on the back of the stabilization of the Dahej facility has seen a good growth. So a strong move there. FY27 guidance also that the management has given, they've said 20 to 25% growth, and this is mainly backed by strong project pipeline in CDMO business. Very lastly, I've taken a L&T. You know, L&T is very interesting to watch out for because now with regards to where the Hyderabad metro rail arm goes, that has been divested in terms of the stake that they have. The reason, I've taken this one is because now L&T is focusing on cash flows and ROE. Previously, in February 2026, it divested its stake in the Nabha power plant. Now, the deal cumulatively will yield them a cash of around 5,600 odd crores. And if you talk about the current transaction, that will not only lower the debt but also improve the ROEs. And an annualized basis, a 70 basis points improvement in ROE is what analysts are expecting to 18.4% from a 17.7%. So because of this, you could have a L&T which is in focus as well. And lastly, you have IIFL Finance, a strong set of numbers that have been reported. In fact, my colleague Nisha Podar is in conversation with Nirmal Jain. Let's listen into what he had to say.
The gold loan, the surge that is seen in the AUM of gold loan, it's also the key driver. What really led to the growth? And also wanted to ask you about the LTV ratio of 63%. How does that really get seen and impacted going forward?
Thank you. So first question, the gold loan growth. I think we had the very strong gold loan growth in this year, driven by, I would say, three factors. One, the base of the year before was very low, primarily because, practically for a significant part of, or larger part of year, our business was suspended. We had RBI embargo and which are lifted later in the year before. And therefore, the base at which we started was low. And also our customers, we kept our branches, our employees intact. So no branch was shut, no employee was fired. And then that basically led us to a strong comeback. We could get back our customers. And so that was the first reason. Second is gold prices were very strong. That increased the borrowing capacity of MSME and household who want to borrow against gold. And third, year before, we also saw that there was a clampdown on the unsecured loans, unsecured personal and unsecured business loans. Many fintechs were into it, and RBI and the losses were significantly higher than expected. RBI also tightened the guidelines, risk weightages, and all these. Basically, the industry for unsecured lending shrank, and that contraction also helped the gold loan lenders. So these three reasons drove the strong growth the last year, and the industry also grew very well, and we were part of that. So that is the first part of your question. And the other question that you had was, what was that about? Can you please repeat?
Yes. So Nirmal, about the loan to value ratio, it stands at 63%. Now with gold prices going up, how is it stacking up and how will it impact your business?
So, the RBI basically allows up to 75% and for very small loans up to 85%. But we have been conservative to start with. And, during the last quarter, there have been many days when we basically kept our maximum lending much below 75 or 85. primarily because we were concerned about the volatility in gold prices. And also, customers' requirement really doesn't go up in line with the gold prices. So we have to really take care of that. So our gold LTV is lower. That is conservative. Going forward, I think gold prices remain firm. Then you'll see strong growth in this, this category of loans. But we'll continue to be conservative. So we are very cautious in giving top up when the customers LTV comes down. So what happens? Customer takes loan and they start repaying. Then also you'll see that your LTV on the portfolio has gone down. But in either case, I think the best strategy at this point in time is to be as conservative.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and
All right, welcome back. Let's pull up the implied for you very quickly. And I think at some point, Brent at 120 is going to start hurting. That's what you're seeing on the screen right now, about 160 points down. You've seen a big pump up in crude prices this week itself. Kush Bora, Parag Thakkar joining us this morning. Very good morning to you. I know it's Friday feeling, but so it's the last trading day of the week. Yeah. But the fact is that we're closing off on a very uneasy note, Parag.
Absolutely.
Yeah.
Absolutely. So Brent at 120. I can say that although invested, but shit scared. And plus we have to be alert of physical shortage also. Na? If this continues for 10 more days, Strait of Hormuz blockade, then we'll have physical shortages also affecting some sectors. LPG we have already seen. We can have some shortages in petrol, diesel, who knows. And 120 is too high a price for fiscal to adjust. So it's a very scary situation in my view.
Yeah, it is getting a bit rich for our blood, 120.56. I think what's also worrisome is that no side seems like in any mood to fix this. Trump is saying, why should I take an 18-hour flight? I mean, do it on a Zoom call, but then let's find a solution. So that seems like another difficult situation.
It's a tough situation. It can change over midnight when we all are sleeping. Suddenly it can change. But right now, it is what it is. So it's a scary situation. No doubt.
You think that's the overhang that we're going to see, Kosh, at least on the indices as well? You might have decent results, good results, all of that, but then this becomes front and center, and that's what the index is showing.
I wasn't as constructive in terms of going all out long on the markets. Neither am I as cautious, because there are supports at the lower levels and you are seeing buying emerge from lower levels. Of course, we are seeing sell-offs and we are seeing profit booking. Yesterday's rally, if you see, was very interesting. The direction wasn't a surprise, but the intraday magnitude certainly was, right? So 24,300, that resistance zone, we hit it, and then, we've retraced from there a couple of times. So like I said, nothing out of the ordinary to say in any rara market here, long job, but nothing to be so worried about. Of course, crude spiking and all is a concern, but from a data perspective, it's not really as worrying just yet. Also, if you look at, the setup, Nifty is still hovering around that 50-day moving average. The bias right now is still about consolidative to positive. If you look at PCR, neutral but just above 1, RSI just above 50. So I think, there could be some consolidation, on the cards for the next few days. If you have a long position, you should hold, but yes, keep a tight stop loss around the 23,800, 24,000 zone. a break above, a clean break above 24,300 will push the index towards higher levels. And from consolidation with a positive bias to consolidation with a negative bias, Bank Nifty, bit of a worry there, because you are seeing the Bank Nifty retrace a couple of times. Multiple attempts at moving higher have fizzled out. RSI slipped below 50, again confirming the fact that the bias could be a little negative going forward. 50 DMS support at 55,000. That should be your line in sand on the downside. If you do have long positions, my suggestion, keep a stop loss at or just below those levels.
Okay, so Bank Nifty specifically, right? There's been an underperformance in the recent past, and I guess that's the reason why you're pointing to that. But individual stocks that you like this morning?
So I'm still going with a mix of long and short as I have been for some time, and that is somehow starting to reflect in the markets. Mid caps yesterday had a slight negative bias. Small cap indices did well, but I think the exhaustion that we spoke of yesterday, day before, that is starting to show in the markets. So I've got 2 long calls, 1 short call. Ingersoll Rand continues as a buy call. We've discussed this as a weekly pick on Monday. Is doing well. The reason I reiterated is because the volume on this one yesterday is through the roof, at least about 4.5-5 times of the last 20-25 days average volumes, and the price action also seeing a follow through. So just to reiterate the targets, 4,400, 4,600 and a stop loss at 4,150. Despite the caution on Bank Nifty, one of the calls is from the banking space, and that is Bank of Maharashtra. Now, we've been very bullish on this for a while. It's absorbed all kind of news. It's seen the markets turn volatile, but it's holding ground and perhaps even gaining some. At least yesterday's moves, show that. So targets on this one, 82, 85. The stop loss. Alex, you want to take a guess at that?
No, you can go ahead.
77, because that's the threshold level that we've been speaking about, how that is a resistance and now acts as a support. On the short side, I've got InfoEdge. This is one call that can continue as a short hedge. Resistance is around the 20 and the 50-day moving convergence. On the short side, targets at 985, 974, stop loss at 1007.
Okay, so we've talked about how the scary situation is emerging as far as Brent is concerned. Results overall look okay, but then let's talk about the other third factor that markets may be looking at, which is exit polls, because the recently held assembly elections across 4 states and 1 union territories could pack in some big surprises come Monday. We have Shankar Iyer joining in, and Shankar, we put together the poll of polls to show our viewers, and the picture, at least in West Bengal, is more confusing than many would like.
Well, it's a very tough, closely contested, high rhetoric election. It's a pressure cooker situation for both the sides. So people are not taking any chances. So the exit poll itself, the polling itself is a little tough for the pollsters because there is a fear factor. Now, the fear factor is twofold. One is the fear of violence from the ruling incumbents. The second fear is losing out on voting rights and stuff. The high turnout actually makes assessment very, very tough for the pollsters. So anything that we see in the exit polls, one must sort of hold your breath till the real numbers come out. Having said that, I think that Bengal, after 15 years of the TMC rule, there is a scent of Odisha in the Bengal polls. People in Bengal feel left out. I mean, these are avid travelers. Bengalis are avid travelers. They travel the world. They travel across India. And so they are referencing their situation with the situation in other states and economic development and all. So there is a certain push for change that might translate into a very big surprise on either side. If, for instance, the SIR, or what I call the impact substitute effect in this election, goes haywire, then TMC could well retain its position and storm its way back. However, if the urge for change, the urge for development, the urge for jobs persists, which is visible on the ground, then I think you might have a major sweep in favor of BJP.
Instant, Shankar, what are the implications for politics at the center?
Well, a victory is a sentiment booster. So you guys deal with the market, so you know how you interpret advanced declines or interpret mid cap, small cap. The day large cap is up, you feel that the entire market will go up. So similarly in politics, for the ruling party at the center, victory in Bengal is expansion of their writ across the country, and that gives a sentimental boost on the face of it. But I mean, it all depends on whether they can take bold decisions based on one victory or two victories. The situation in the macros is pretty grim for as far as I can see. I mean, markets have their own logic, but I'm struck by the fact that with Brent at 121 rupee at 95, the higher level of subsidies, the access, the affordability and price challenges that the market is holding up, and good for the Indian markets.
In part because, Shankar, there's this wall of money coming from domestic institutional investors, right? Everyone's filling in their SIPs very loyally month after month. So that money is holding things up as well. Just trying to understand how important these polls are also from the perspective of a temperature check. Because this is, if you're looking at data as an indicator, this is the latest data available about how Janta feels about how this government is handling issues of the day at a very tough time geopolitically, whether it's inflation, jobs, etc. This is the temperature check, and that's what becomes important as well.
Of course, very much so. You see in Tamil Nadu, where there is a whiff of a surprise with the TVK performance, and in Bengal, the two clear factors that are coming through is jobs, and attendant to that is cost of living. And there is a persistent concern about corruption, or what I call thuggery corruption. The flexing of muscles by political parties to extract from businesses. Even the best ruled states have this problem, and this is a persistent flagging. So I think in terms of macro policies, there is the bottom of pyramid, or rather the K-shaped recovery that we've seen since COVID, that is playing up big time on all the verdicts. If you see the urge for change, the jobs, look at the way the first time voters are voting, the youth are voting. There is a challenge that the government needs to, and this is what I call the Insta generation, the Reels generation. They're not going to wait for 15 years, 20 years for stuff. And what we have seen in the neighborhood, in Nepal, Sri Lanka, has a bearing on how youth views politics in India. And this is kind of a wake-up call for most political parties, is to come up with a blueprint. And this is also might be a good time, Tamanna, for the fund managers and others to sort of roll out their own agenda as to what needs to be done. Canada is launching its own sovereign fund to invest in Canadian industries. Europe is doing stuff.
Sure.
In India, I have for a long time advocated that all the PSU holdings be put into a Temasek-like fund, Viksit Bharat or Amrit Kal fund, and sort of, fund the development. You are going to be resource scarce. The rates are going to be high.
100%, Shankar. So much food for thought. And, we should find time and actually talk a little more about the intersection of politics, policy and markets sometime soon. But always a pleasure to have you on. Shankar Iyer, their author and columnist, breaking it down. So net, no one knows what's going to happen on the 4th. But there is a scent of Odisha is, I think, one takeaway which I saw from Shankar, where after several decades there was a overthrow of the government. I think more everyday matters though back home for us right now as far as markets are concerned. And let me start by asking you about Bajaj Finance, Parag Bhai.
So I would say decent results, good growth, asset quality improvement, good guidance. I wish and I hope that the situation on the ground remains conducive for them to achieve their guidance in terms of asset quality and all. Because right now, as we speak, the situation is looking a little bit murkier. So
they do say though that while geopolitics and all of that is a headwind, but they have a tailwind of asset quality. So they are very confident.
So they are very confident. We own them. So we would like them that they do what they can execute what they have promised. But in my view, looking at currency, if this situation lasts long, everybody is in a problem, and right now nobody can see that exactly what kind of problem will emerge. But and see, lenders will come at the second point. First, the businesses will suffer. Then businesses can say, now I cannot pay your money back at a particular time, and then the lenders will suffer. So I would say that, and many businesses I know at least are already experiencing the pinch. For example, yesterday one of my colleagues attended Nesco's Chemical Expo. Most of the chemical guys who had low inventories are already feeling the pinch. They are saying that raw material prices have shot up so much, we cannot pass it on.
Before we move on from Bajaj Finance though, one of the notes that I saw this morning stood out, which was Macquarie, and they've maintained an underperform with a target price of 860, which implies a downside from here, and they are challenging that growth projection in FY27. So exactly what you're talking about, they may be in the minority here because everyone said good set of numbers, outlook looks positive, but there is a cause for concern.
Mr. Rajiv Jain is a fantastic communicator. Okay, so he communicates so well that you get impressed, and that is why, and they have always delivered actually. So we are also invested with them, but the point is that, right, see, the macro situation, how it prevails, physical shortage of energy, so much high price of oil, how that is going to play out. If this situation does not solve within 10-15 days, I think many things will change.
So a quick one then, if we are talking about the situation that you're alluding to right now where it worsens, apart from a Bajaj Finance, who on your list would be in order of priority be impacted the first?
I think every industry in some way or the other will be. For example, see, I'll tell you, Ultratech also we own. But Ultratech has an inventory till say May end or June 15. That's what they have said on the call. So everybody will have some inventory. But until then, it's okay. Even government will have inventory of crude oil and reserves and all. But if another 10-15 days goes, then physical shortage will start to play in, and already energy price bill is going up. Our government has already cut excise duty and taken a hit on its chin.
That's the other question really. Now that the last vote has been cast in these elections, will we see maybe some form of passing on? Although there has been so much talk about it and so many denials
and
coming in.
Government has denied,
but they have denied specific reports with specific numbers.
I know.
That it's going to be, this much of a hike or that much of a hike. Can they really sit on it for too much longer and not pass on anything is the question. All right, let me go across to Sumit Sarkar joining us this morning with all the chatter from the dealing rooms. Sumit, good morning.
Good morning. Well, a few stocks that dealers have highlighted that one should keep an eye out for in trade today. Firstly, it's Bharti Airtel. Dealers indicate that there are buy flows on the institutional desk, specifically for Bharti Airtel, and this they are also saying that the selling pressure that was there on Bharti Airtel is largely over, and all the negatives are now priced in for this counter. For Religale, there are buy flows on the HNI desk. The buzz on the street is that the record date for the demerger would be announced very soon, and the street is also expecting that there could be some stake sale announcement in the insurance business as well. When it comes to Honasa Consumer, there are buy flows on the large HNI desk, and the street is expecting that the company might announce a potential acquisition very soon. So keep an eye out for Honasa as well. And lastly, when it comes to Exide Industries, there are buy flows on the PMS desk. Dealers indicate that the fourth quarter earnings could be quite strong for this counter. So keep an eye out for Exide as well.
Okay, thank you for that, Sumit. So many, stocks to unpack today. There are a lot of earnings as well. But Parag, you want to come in on Bharti Airtel because that's something you track closely.
Yeah. So Bharti Airtel is a stock which I love because it protects you, it keeps you insulated from all this what is happening. There are around 60 crore subscribers, including India and Africa, who are paying ARPU. That ARPU is only going to increase. When it is going to happen is just a question. Whether it is going to happen in September or December, that of course, it makes free cash flow of 70,000 crores. That is not going to be affected by all this, what we are seeing, Brent at 120, rupee at 95, whatever it happens in the world. Right, and plus now management is very, they have communicated very well on their capital allocation, data center, 14,000 crore NBFC, that is also spread across 4 years. So I would say that plus this Airtel money thing is going on, Europe listing.
Yes.
So I would say that at a 6% free cash flow, for me, in my portfolio, Bharti Airtel, which is around 9% of the portfolio, is like cash. And whenever market falls because of these worries, Bharti Airtel is a stock to go for me.
But data is the new oil only when oil is not at $120.
Oil is the new data. Yeah,
But okay, so I just have a counter over here. You're talking about Bharti Airtel, which is in your portfolio 9%. In the last 1 year, Parag bhai, stock has done nothing.
So I have bought after the fall. That's what I like, right? That's what I like. After a blue chip company who is less leveraged and generates strong operating cash flow, after that company underperforms, that time I start buying it. I have not bought it at say 2,100.
Correct.
And because, see, it fell because of that NBFC thing. And just put it in perspective, the numbers. They make 60 to 70,000 crore free cash flow every year. They are going to just invest 3,500 crores. So 5% out of the free cash flow in NBFC business every year. And that too, they have a right to win. They have got 37 crore Indian subscribers. They have already done this in Africa, Airtel Money, where again they are going to unlock value. So I think after a fall, it made sense, of course.
Yeah, if you held it since a year, you're not going to love the stock as much as Parag Thakkar is right now. Kush on charts, Bharti Airtel, Bajaj Finance.
Yeah, so Bajaj Finance, again, nothing to write home about. It's had a good run only because, everything else worked along with the markets. Now it's consolidating at the 50-day moving average on the way up. 960, 965, thereabouts is the 200-day moving average. Won't be surprised to see, even if it hits that, it just continues to consolidate around that level. So from a momentum perspective, not really. Bharti, by the way, is turning a corner from a near-term perspective as well. Hiral, you're right when you say that the stock's not done anything practically in a year's time. With this base formation around 1800 mark, now you're seeing an uptick. There is a falling trendline resistance from last December's highs, and that comes close to the 1900 mark. So if you do get a close above this, I think some supply pressures will get done and dusted, and then the stock would move higher to about 1960 and 2000 odd levels. So yes, from a near-term momentum perspective, also momentum building on Bharti above 1900.
Okay, so 1900 is what you should be watching out for as a price in terms of Bharti Airtel. But a slew of other stocks that will be in focus as well on the back of earnings. Sharad Dubey is standing by to tell us more. Sharad, good morning. We've discussed a couple of them, but what catches your eyes in terms of stocks that could react?
Good morning, Hiral. Interestingly, the first stock is SEM India Projects. Earlier, this stock's name was ITD Cementation, and a really strong numbers. Yesterday, we saw Orient Cement also coming out with a good set of numbers, and over here, we see the margins jumping up almost 200 basis points on a year-on-year basis. And also there's a cost reduction at play. Jana Small Finance Bank, interestingly, the operational parameters are stable, asset quality has improved, and the net interest income that has gone up 27% on a year-on-year basis. Motilal Oswal, if you remove the M2M losses, which is of course just the treasury portion of it, the operational numbers have beat estimates, and for Syngene, weaker than estimates, the numbers have been reported. Interestingly, Fino Payments Bank's a little bit of concern has come in. The operating profit has taken a big hit. That's down 82% on a year-on-year basis, and we'll of course try to understand why this big fall has happened. And K Fintech also, we see there has been a margin pressure coming in, especially because of higher employee expenses, which was recorded in the fourth quarter, and that's why a weak set of earnings is coming over the last 2 to 3 names.
Vari also has reported. Thank you for that, Sharad. And numbers look good optically, but margins have seen a slight squeeze down. Is that something you've looked at? That Fino Payments Bank, any of the stocks in Sharad's list?
So generally, I have been a little bit skeptical about going into this new business. I always buy time-tested businesses.
Which is a new business you're referring to?
So
Fino?
Both Vari and Fino.
Vari is also new business?
Solar. Solar plus, you have not seen the cycles. Now, for example, today the call is at 3 p.m. and I will be very curious to know that why margins have dropped so much. Is it because of realization decline or is it because of raw material price going up? In my view, it should be realization decline. If it is a realization decline and it is going to stay there, then structurally you have a lower margins.
Correct. So Waaree Energies might see a bit of a pain today as well. Fino is another one which is a bit concerning.
That I don't track, unfortunately.
Okay, and Motilal Oswal, because the treasury income makes the numbers on the face of it look quite weak, the M2M losses that they've had. But should we look at it operationally then?
Yeah, so I think generally, as you know, I have been more bullish about AMCs and wealth managers. Broking, of course, broking I think the growers and those kind of companies, I don't own them, but those companies are doing phenomenally well.
Specifically on this MTM and the treasury losses, you saw this with UTI AMC as well, which is why it posted a big net loss. It was punished on the day. So how should you read this from an operational standpoint?
I think M2M losses of anything, bond, treasury for banks, I think that's why you see whenever ICICI Bank comments, whenever Bakshiji announces results on the earning call, he starts with our aim is to grow PBT X of treasury.
Okay.
Right? That is the key thing to monitor, right? X of treasury. How can you control those things? Those of course, you can control them, but not.
You can mitigate them.
You can mitigate that, right? For example, if India 10-year goes to, say it is 6.95.
It's gone to 7.15.
Yeah, who can be saved?
Yeah.
It has to be a loss, M2M.
Okay, so there's a potential negative reaction that could come in on a Motilal Oswal, though operationally the numbers are good. But Kush, if you have to look at Waaree and MOSL on the charts, what is the direction you're seeing? Because that will sum up everything for the viewers.
See, Motilal Oswal wasn't really doing well anyway, and I've said in the past that, the broking space, it could have these spurts, but it's not something that you buy and hold for a long time, and at least in a market scenario like this. So not really constructive. In fact, on the downside, I'd watch for levels of about 770, 780, those levels, 775 to be precise. Break below that could actually push it further. Very interesting setup. We've given out a call or two on this stock in the past as well. Now it's seeing some cooling off of the momentum indicators, volumes also shrinking. So I think, if a dip does come about and does take it to 3,300 odd levels, that's when it becomes a buy on dips. So structure still positive on Waaree.
Okay, we're talking about Motilal Oswal. Let me go across to Sharad, who tracks this space, to break down those numbers as well. Sharad.
Well, yes, street is divided, but let's just give you the exact numbers, what has actually happened. The revenue, that has jumped up 27%, and the net loss, the numbers are looking on the higher side. Remember, there's an M2M loss at play. This is basically a treasury impact which has been seen, but if you take the operational part of it, that has gone up 25% on a year-on-year basis. But let's just point it out, what has worked for Motilal Oswal. The first three important point is the cost control has led to a beat in the operational part, and the brokerages have stated that as well. There is a strong growth coming in on a year-on-year basis, especially when we see the asset, private wealth management, as well as the housing finance business, the AMC business I'm talking about. All three of them have done well, and a strong growth has been reported. The revenue has been largely in line with street estimates, but of course concern is also there. The bottom line numbers were impacted by the treasury M2M losses, which are, of course, we have calculated that, and the retail broking market share, they have lost ground on a sequential basis, almost 20 basis points in cash segment, and the FNO premium segment, they have lost roughly 130 basis points of market share. And of course, the street was expecting a larger AUM growth, but there has been a miss on the average AUM growth for all the fronts except the housing finance segment.
Okay, so that's the breakdown on MOSL also coming in. Just thinking about a few other ideas that we should be looking at. I mean, setting the context of how you have Parag Bhai, and now Brent is at 122. We'll pull up the latest Brent. It's constantly inching up. We're talking about the next 10 to 15 days becoming very, very crucial. You talked about one island of safety. You said one telecom company. What are the other islands of safety?
So pharma is another island of safety, but in pharma also remember, many of the pharma companies have to use crude oil derivatives. So there may not be a demand issue in pharma. Demand that will stay, but there can be a supply side issue if this shortage is, because see, Strait of Hormuz there is no passage of ships after the blockade. So if this continues for 10 days, I'm sure there will be some solution. And I am really hopeful that there'll be some solution. But if there is no passage and you have an energy shortage only, then even pharma will get affected from the supply side issue, not from demand side issue.
And packaging costs and all of those things.
So for FMCG, again, they are using crude oil derivatives mainly, except for Marico, which oil uses copra oil, which is correcting. But packaging costs for everybody will go up.
But apart from that, when you mention about crude derivatives for pharma companies, now what happens is pharma products do have a ceiling which the government caps for them for a lot of products. Does that mean if the government is not able to increase prices for them, if they don't increase the ceiling prices, you could see a hit in terms of margins, number one, because that I don't think so they have that big a buffer as well.
So very good question. Just to tell you what happens is, in pharma, whatever prices are controlled prices, right? What happens is government allows them to take the price hikes every year based on WPI number. WPI inflation number. WPI inflation number is mainly affected by crude oil. So actually your worry is right, but it might be a case that they can be able to increase prices higher if the formula is followed in a right spirit.
Interesting. So I think that's going to be an important aspect to watch out for, because if they're able to take the price hike, probably the impact could be slightly nullified to some extent and we might not see a margin.
But this is only for controlled products. Where
Correct,
prices
only for
are
controlled products, absolutely.
I do want to actually complete the circle on pharmaceutical companies and ask Kush to weigh in on the technicals, because on the basis of news flow, you've seen quite a bit of action in the stock prices in the recent past. Take DRL, for example, where it was a proper sell on news situation that came through. It ran up ahead of that approval and then it cooled off. So what looks attractive on the charts?
Yeah, there are pockets now. There are pockets starting to form within the pharma space where, everything does well, theories out of the window, which was, by the way, up until March. So a couple of stocks, and I wouldn't suggest buying them immediately because they've run up quite a bit. Senores and Granules. These were the two stocks that, we'd given calls on the channel, did well. Yesterday saw some profit booking. There's a good possibility that could continue for some time. But these are pockets of strength. So any kind of 3 to 5% kind of pullback on some of these names should be an opportunity to buy. Also to add to the list, Aurobindo Pharma could run some profit booking. Again, 2 to 3% kind of a dip should be taken as a buying opportunity. I would avoid the likes of Sun Pharma and Dr. Reddy's for now.
Okay, we've been talking about crude now at 122, and the US-Iran war is now entering its third month. The Hormuz blockade is now turned into a double blockade with Iran and the US on both sides choking off supply. So amongst other things, it's of course energy which is not coming through. The question over here is that how long can India hold off passing on these high fuel costs? It's happened in most nations. So far, fuel prices at the pump for you and me have not changed. How long can we hold off? Soumit Sarkar is joining in, not to answer that question because frankly nobody knows, but just to talk about how India has managed the crisis so far and how the math adds up. Soumit.
Well, yes, Brent crude is now trading at around $120 per barrel. Now, is it the highest price that we are seeing? In fact, no. Back in March 7, 2022, when the Russia-Ukraine war had started, in fact, at that time on intraday basis, Brent crude had hit a high of around $139 per barrel. And what happened post that, from March end, we did see some price hikes coming in from March end to April first week. Around 10 rupees per litre was hiked in around 16 days. 14 increases is what we had seen. Post that, government had cut the excise duty on petrol and diesel by around 8 rupees and 6 rupees, and this was completely passed on to consumers. So net the impact on the consumers was largely neutral at that point of time. Now at that point of time, Brent continued to remain above the $100 per barrel mark for nearly 6 odd months, but we had not seen any change in the retail fuel prices, that is petrol and diesel prices. So there were no changes in petrol and diesel prices back then as well when Brent crude was trading above the $100 per barrel mark. But there was something different at that point of time, and that was the fact that India was getting Russian crude, that too at a discount. And this is not happening at this moment. So OMCs were able to absorb this shock coming in. But despite that, there was a big impact that came in onto the books of the oil marketing companies back then. In the 2 quarters where oil prices continue to remain above the $100 per barrel mark, the combined loss that HPCL, BPCL and IOCL reported was close to 18,800 crore rupees. And HPCL, which has the highest exposure to the marketing business, alone had to book a loss of close to 11,000 crore rupees in the couple of quarters where crude prices continue to remain above the $100 per barrel mark. Now what happened post that? Post that, retail fuel prices continue to remain unchanged, but Brent crude, that had come down, and on an average, the prices that we had seen from 2022 till 2026, till Feb 2026, the average prices was close to $77 per barrel. But retail fuel prices continue to remain on the higher level. And because of this, oil marketing companies were able to recoup all the losses that they had bared in those 6 months back then. And they were earning supernormal profit when it comes to the marketing segment. In fact, because of this supernormal profit, the company's reserves jumped nearly 57% during that time frame and came at close to 3.27 lakh crore rupees. This is the combined reserves for oil marketing companies, IOCL, BPCL and HPCL. But what is happening now and what is different? Firstly, is the INR depreciation, and because of that, despite the fact that Brent crude in dollar terms is not the highest, but Brent crude at rupee term is the highest ever that we are seeing at around 11,000 rupees per barrel, and that is the biggest impact that is coming in on the country and on the oil marketing companies. Apart from that, crude is now available at a premium. Even Russian crude is available at a premium, which was not the case back in 2022. So these two are the main reasons why it is more impacting the oil marketing companies at this point of time. Now at $120 per barrel crude, oil marketing companies are seeing a burden of nearly 27,000 crore rupees. This is the loss as per Kotak Securities that these companies are bearing every month, and they would require a price hike of close to 25 to 28 rupees per litre. But given the fact that these companies have so much reserves at this point of time, around 3.27 lakh crore rupees, at least if they do not take a price hike and continue to see this impact coming in onto their books, at least theoretically, oil marketing companies can bear the burden for the next 10 months at least. And this is completely theoretical, and it does not mean that they will do this or not. But what the street is expecting at this moment is that there might be some price hike coming in, not immediately. Government might want to see how crude price moves on going forward. If they continue to remain above $100 per barrel, street is expecting a price of hike of up to 5 rupees per litre that could come in, and in that as well, diesel is something that will see a sharper price hike as compared to petrol, because petrol is largely used by common man and diesel is used more by factories and for other purposes. So that is what the street is expecting at this moment, and theoretically oil marketing companies can still have a positive net worth and sustain without taking any price hike for 10 months. But do remember that is just a theoretical exercise that we're doing.
Okay. Even as we're speaking about this, rupee has popped past the $95 mark. So it's been a pain point coming in, and expected that the rupee would open with that kind of weakness after you've seen crude at 120. So rupee on one side, crude on one side, and it's looking like a very tough picture. The last rate I saw for Brent was 122. So you have both those factors coming in. Naveen Mathur, Director Commodities, Currency and Gift City, IFSC, Anand Rathi, Share and Stockbrokers, joining us on the show this morning. Naveen, thank you so much for speaking with us. Just in terms of the rupee direction, do you see much more weakness building in?
Yeah, thank you very much, and good morning. I think the weakness continue to persist. There are troubles with respect to the extended blockade fears in Iran, which is taking crude oil prices at around $120 a barrel. So Brent is currently at around 121 a barrel. And even the 1 month NDF market is at around 95.32. So I think the dollar being hawkish, the Fed remains to be hawkish. And therefore, the continued appreciation in the dollar index is one of the major reasons for the rupee to depreciate. We also see the FII outflows, which is continuing from the previous calendar year. This year itself, in last 4 months, the FII outflow has been around $20 billion against the $18 billion or $19 billion for the last calendar year. So I think the rupee would continue to be under pressure. And up till and unless we don't see any kind of a resolution with respect to the crude oil, with respect to the Middle East, and even the FII inflows, we might not see a breather as of now.
Naveen, thank you so much for joining in and giving us that quick call on the rupee. So, I mean, that's what you expect to happen, frankly. I just want to pull up the Brent if we can as well. Rupee at 95.09. Painful situation. Big drop this morning, has hit a record low. You've seen Brent also, cross those very difficult points as well. Let me go across now to Sharad for the big brokerage call of the morning. Sharad, what's on your radar?
Well, the company in focus is WeWork, and interestingly, Kotak Securities has come out with its report, and they have initiated a buy with a target price set at 670 rupees per share, and they are bullish on this counter, and they have stated that there is a multi-year growth runway out here, and there's also valuation comfort also coming in this counter. The premium flexible workspace operator is having almost 8.2 million square feet of the work, and they're expecting a 25% adjusted EBITDA growth CAGR coming over the next 3 odd years, and the company itself is among the leading takers for the new office supply which is coming in, and the moderation in the overall office absorption actually augurs well for the company, and this might be an important trigger.
Okay, all right. So WeWork in focus. Nothing much happening in the pre-open session. Actually, let's look at the pre-open session very quickly. Naveen Fluorine numbers 4.5% up. IIFL Finance numbers. These are impact of reportage of their quarterly results that you're seeing. Emphasis basis numbers about 3% up right now. So that's doing okay. Bajaj Finance, the big one. Just want to look at that very quickly. Also 1.5% up. ONGC expectedly going up 1% right now. So there you have some excitement as well. HEG was a poor set of numbers, about 7.5% down right now. Wari Energies, that margin contraction is worrying the street clearly, about 5%, 6% down right now. Likewise for KFin Tech and Schaeffler, the numbers are not really marking up. SEAT popped after its numbers, seeing a sharp cool off maybe from where its highs were, about 3% down right now. All right, Dharmesh Khan joining us this morning, Head Equity Research at Chola Securities. Dharmesh, very good morning to you. Want to just get your take on some of these companies that have reported and you were tracking them. I want to ask you how you, what you make of KFin Tech, HEG, Schaeffler, if you're tracking any of these. And let me add a SEAT as well.
Yeah, very good morning to you, Tamanna. I mean, the numbers as far as, KFin Tech is concerned, that was not so encouraging. It was a muted set of numbers. SEAT came out with a very strong set of numbers, but in Q1, there is a problem for SEAT because input prices of raw material, I mean, the raw rubber prices have gone up significantly. In Q4, it was not there, so that will play out as a headwind. And petrochemical prices have also gone up. So both goes into the making of your tires. So margins compression is expected in Q1, and with the kind of run-up it has seen, it's likely to see, cool off from yesterday's run-up. So more or less, I mean, largely the numbers which came yesterday, they were, quite encouraging, especially if you look at Bajaj Finance numbers. The very strong set of numbers, 22 or 23% kind of a growth across the board, be it AUM, net interest income. ROE is improved to 4.7%, ROE is improved, asset quality was impeccable, and the guidance remains strong. But our take out there is, there's a headwind coming on the way for Bajaj Finance, because most of the MSME player, SME player, or individual business owners whom you talk to, whom Bajaj Finance is indirectly a provider for their working capital needs, are facing headwinds because of the Middle East crisis, which is continuing. Basically, all the plastic makers and everybody connected with petrochemical businesses in a tight situation. So Q1, we are expecting there's a pit stop for them. So there will be some problem out there. I mean, Tamanna, Q4 numbers have been good, but Q1 there is a problem on the macro side. So one has to be careful about it.
The problem is that Q4 numbers don't seem to matter as much right now. It seems like it happened too long ago, even though it was just last quarter. Dharmesh, actually, you and Parag echo each other on the take on Bajaj Finance. But I was wondering then, what are the spaces that you are finding safe? I asked this question to Parag Thakkar a short while ago. What are those islands of safety right now, considering we don't know really what's going to be happening?
See, I mean, the consistent compounders, for example, on the business front, for example, defense companies, is a high margin of safety out there, because almost every company is sitting on a very strong order book out there. At the same time, executions are happening. The structural bottlenecks which has come in the way for FY26 is now out of the way. And there we have, I mean, couple of weeks back, we have initiated high conviction buy call, which is a part of our high conviction large cap portfolio, Majgaon Dock. The order book has been strong, and they are about to tie up for P75 ice submarines. If it materializes, which is likely to be the case, it's around 90,000 to 1 lakh crores of an order book, JV with ThyssenKrupp of Germany. So it will change the entire orbit from where Majgaon Dock is sitting right now. From warships and frigates to a submarine kind of a business they would be entering into. They have come a long way from repairs and maintenance and shipbreaking company to a ship manufacturer, from 4-5% margin to 17-18% kind of a margin, which is likely to go forward. So Majgaon Dock, BEL, HAL, defense pack looks very solid. Metals continue to look strong to us, but we have shifted to ferrous players than pure say aluminium, zinc and copper plays, because there I think the run up has been done. Steel prices are not moved up for last 1.5 or so years internationally. Domestic, we have seen some uptick in the steel prices. Going forward, as rebuilding starts, international steel prices both will come in a big mix. So Tata Steel is a big out there.
Okay. All right. So quite a few stocks there to watch out for. Good morning to you, Dharmesh. Kush, just about 20 seconds left. So what stocks stand out post the pre-open session?
Yeah, I'd suggest some caution and don't initiate this trade right at the start. But LG Equipments had a good run yesterday, some cooling off from high levels. Just to reiterate the target and the stop loss revised once, 585 is your target, 555 is where you keep that stop loss. So LG Equipments.
Okay, LG Equipments, but tread with caution on all of these. If you look at the pre-open session and the rates that have ended, it's very clearly that those that have good reportage of results are seeing some support. Whether it will last or not is looking difficult. This Thursday morning, last day of the trading week, weekend factor also may be coming in. Crude prices are not helping, nor is a depreciating rupee. You're seeing a 200-point dip on the Nifty as it opens, worse than what the implied open indicated, but much expected as the situation seems to be worsening. June futures for Brent at 122, and that's really the ouch point over there. There seems to be no intent to wrap this up in the Strait of Hormuz from the American side, and that's what's worsened things. The advance decline ratio looking quite negative at this point. 689 advances to 1,036 declines. The Nifty mid-cap weak, banks weak, and you're going to see this across the board. The small cap is still about 0.25% down. I want to pull up the Nifty heat map for you and just take you through what's working and what's not. You might see much more red than green on the screen. I'm going to start with the losers. Shriram Finance, second consecutive day of a knock there, 2.5% down. Indigo, understandably, with high fuel prices and airlines putting out an SOS to the government. I mean, there is limited room for cushioning there. And will the government prioritize aviation turbine fuel over others? Perhaps not. So you're seeing Indigo about 2.5% down as well, as is Axis. Eternal coming off and seeing some profit booking after a positive response to its numbers for 2 consecutive sessions, end of the day before and of course yesterday as well. On the winning side, Bajaj Finance, strong set of numbers. It's actually the confidence that the management is showing that is being reflected over here, because they're saying that even though you have geopolitical headwinds, and that's the concern, this is a bank, or this is an NBFC, beg your pardon, which lends to that strata of society which could be hit badly with rising energy costs. But they're saying we have a tailwind of asset quality. Coal India is a clear indicator and a mirror of what's happening when there is a choke in the Strait of Hormuz. Your energy costs are going to go up. For Coal India, it's a positive. Likewise for ONGC, because what they give becomes more precious. Wipro doing okay over there, but it's a largely red screen. India VIX about 3% up. And as Alex comes in, let me just pull up the India VIX for you as well on your screen, because that's the fear gauge and that's showing an uptick today. Though it's below 18, so it's not popping off in that sense, but definitely no one seems to be in the mood of going into this weekend with large bets on the table.
Yeah, and no one would blame them, right? And whatever we cooled off yesterday, is back on the table with regard to the volatility index. I want to pull up the sectoral indices just to complete the picture, because you will see a lot more red on the screen than you have at any point this week. Indeed, it's pretty much a red screen. The only pocket is something that you would normally discount, the media index. It's just that they have few constituents in that index. Small cap is not actually doing too badly. We'll come to that in just a bit. What is, though, at the bottom of the screen, once again you have the banking pack that's under a tad bit of pressure. The PSU banks have been underperforming, even the Nifty bank, so that continues to be the picture. The private bank index down about 1.2%, as a result of which, not too far behind, you will see the Nifty bank losing about 1.2%. We spoke about the technical levels for the Nifty bank earlier today as well, and caution is warranted. I do want to pull up the small cap index, though. If you can pull up just that header and the mid cap index, there you go. So it's a relative outperformance for the broader markets. Pull up the mid cap index as well. It is okay. So mid cap index is down about 0.7%, but bear in mind, as an index, this is now just about 2.5%, less than 3% perhaps, off the 52-week high. Small cap index still about 6%, 7% off or thereabouts. But let's talk about individual stocks, and you've got earnings front and center for quite a few of them. Moil is something that was actually moving in the opposite direction. It had a pretty decent set of numbers, but the stock is down about 3.7%. Maybe some money being taken off the table here. IIFL Finance, Navin Fluorine, good set of numbers for Navin in particular. These numbers are reflected in the stock price as well. Emphasis is another one that did particularly well. Okay, we're still seeing Moil on the charts, but HEG, Fino Payments Bank, had a weak set of numbers, and that's reflected here as well. Margin concerns were described for Waaree Energies. It took it on the chin just a short while back. I wonder if that is the case. In fact, it is the worst loser that I've seen so far today, down about 8.8%. Other stocks in focus, let's pull up MTAR Tech. There's strong numbers from Bloom Energy, and you know the sensitivity here, Texmaco, as well as Indian Hume Pipe. For Indian Hume Pipe, there's a significant order. Even for Texmaco, there's an order of 187, but Indian Hume Pipe, 460 crore order or thereabouts. Brigade Enterprises has gotten into a joint venture with Bain Capital for a Bengaluru project. Not doing too much. Time Technoplast in focus on account of an approval for hydrogen cylinders. You have Chambal Fertilizers, IQ Tech, production commencement. IQ is doing particularly well in trade today, up as much as 6%. A few more stocks to look at. EPAC Prefab. It's commenced operations at its unit in Andhra Pradesh, and so that's a positive. MCure Pharma, they've got an acquisition of stake that has happened, not doing too much. And Lloyds Metals finally has gotten a fundraise announcement. Again, it's not doing too much. But I've picked a few stocks that might have been moving in the pre-open session. A few of them are, in fact, the highlights. But Hila, I wonder what else you're spotting in the broader markets.
You know, very similar, Alex, to what you've just mentioned right now. But I think a quick mention of a HEG on the back of a weak set of numbers is what you should be watching out for. And the volumes are exceptionally strong when you talk about Eternal, which is down a little over 2% in trade. Kush, quick view on the charts, because strong volumes are downtick on Eternal. And two, you have a HEG as well, which is trading under pressure. In fact, a lot of hype that was created when you talk about Graphite India and HEG in the last couple of months. But I think numbers are not supporting it. So what are charts indicating?
So a lot of positivity was already factored in, because if you see the moves on HEG from about 470 to 700, almost about 700 odd levels, the rise was too fast. So any disappointment would have led to some kind of, a downtick like this. Up until a few sessions ago, the consolidation with a negative bias was on thin volumes. I won't be surprised to see those volumes spike up today. So be a little cautious. If you have a position, not a bad idea to keep a stop loss at the 585 zone. Eternal, like we discussed yesterday, it's lost some of that steam, some flavor, perhaps even some flavor with the market. So I will remain constructive, or I will get constructive on Eternal once it crosses the 275 mark. Up until then, there could be a consolidation that could continue. On the downside, support comes in at 225, 230, that band.
Okay, so there is pressure that builds in on an Eternal as well in today's session. But thank you, Parag Bhai, thank you, Kush, and thank you, Dharmesh, for joining in. Always a pleasure to speak to all of you. But moving on, markets and your exit polls, a key conversation that we've been having in terms of impact. We also have Anirudh Sarkar, co-founder and CIO at Equinova Investment Managers, joining in. Anirudh, good morning and welcome to the show. Always a pleasure to speak to you. This is Hiral on this side. You know, since morning we've been discussing what's happened with regards to where the FOMC comes in. You have Brent, which is already, your futures are at what, 122 plus. Your rupee has breached the 95 mark, and your exit polls giving you a pretty mixed, view. I mean, there's no particular direction that you're able to take. With all of these factors at play, with the way markets have opened, what is your take?
So I would say that, the exit polls definitely this time around, if you see, except for Assam and Bengal is the big kind of, the number which everyone is looking out for. And if you look at the exit polls, I think it's absolutely in the middle. So I think no one wants to take any chance with regard to a long weekend and with regard to the exit polls, which kind of gives you a 50-50 chance to both the parties to come. So I would not want to be kind of betting on who comes to power on Monday. But having said that, I think the bigger concern for the market is oil. And I think that is something which market is also wanting to factor in, and that will be something which will in fact get reflected in the numbers for different companies who start reporting from the next quarter. So first quarter is where the big impact will happen, because most of the inventory gains and everything has already been taken care of, and the fourth quarter numbers which are coming, they're not so bad. But the real impact of $120 and $115 oil is going to hurt in this quarter. So I think market is more worried about that and not so much worried about who comes to power on Monday.
I agree, Anirudh. I mean, there are bigger fish to fry in the market's parlance. Is there any comfort coming in from what you're seeing in terms of quarter four reportage? Or is that data now redundant in the light of everything that we're seeing?
No, Tamanna, I would say that if you look at the numbers which are coming, broadly, it's a mixed bag, and with some positive upsides also. In fact, there are a good number of companies who are surprising on the positive. But unfortunately, because of, the broader pessimism in the market, even the good numbers are not kind of, exciting the investors to jump in, because everyone is worried about, where oil is headed and how inflation, because I think inflation is one factor. If you see the FOMC meet yesterday, good part of the conversation was on inflation. And I think that's a concern which is bothering everyone around the globe. Unfortunately, there seems to be no end to, I would say, the Hormuz issue which has happened. And there's nothing in picture that, when it will end. And the way things are, it seems it's going to get much longer before we see some decline in the oil prices. So I think inflation is a big concern, and it will start showing in the consumption also. Because, in fact, I was just looking at one data point today morning, wherein the people now economists have started talking about a degrowth in the consumption overall in the world, and that is not a great thing. Like, if consumption overall starts going down, definitely it will take at least 4 to 6 months for consumption to pick up after that.
Anirudh, and good morning to you, Alex here. The tendency in this kind of a scenario is to start thinking about where you can find a little bit of safety. Because when things start looking a little questionable and you don't have an outlook for the first quarter, you're assuming that for a lot of companies it will get worse. What are the companies that you anticipate, or pockets that you anticipate, will be relatively resilient?
So I would say that, the pockets which will be resilient are those which are not facing the consumers and which are more kind of, a broader economic play, where it could be, the government capex heavy, whether you talk about the power capex, you talk about the large infra projects, you talk about aerospace, you talk about defense. So I think these will be pockets which will be immune to, any kind of inflation which goes up and impacts the consumption. Pockets which will get impacted definitely will be, I would say, the low ticket consumption will get impacted, and to some extent even NBFCs could get impacted, because if overall the consumer sentiment goes for a toss, definitely the borrowing also goes for a toss. And also with all the concerns around IT not doing great, I think, this is again something which will be on the top of everyone's mind. So I think there are any consumer facing companies will have headwinds. Where I would be betting on is sectors where it is more of the government capex, more of a kind of macro capex which is happening. Just to put it again, power capex, aerospace, defense. These are areas where I don't see a big concern.
Okay, so what about the impact for example, I'm just wondering, Anirudh, whether earnings estimates for FY27 are capturing this kind of uncertainty, because some people have already cut for the Nifty 50. They were expecting initially double-digit earnings growth, and now they've cut it to 8%. While others are still saying that there is a possibility that this will settle. So I guess it depends on when you expect this conflict to get over and where you see the average of crude prices in the remainder of FY27. What's yours?
Yeah, so I think, I would say all the numbers which we are seeing today for estimates for FY27, they're not yet priced in the full impact. It's more like, when we talk to companies, companies are also very in a same spot as we are. And they are like, we take every month as it comes. So I would say getting a good finger on the exact estimate for FY27 looks very, very tough. I would say that it's more about trying to do a best estimate for where the numbers can be in this quarter, the first quarter as it is happening. So I would say it's not yet fully priced in the impact. Now, the good part of this is, I should not sound too pessimistic. The good part is whenever this issue gets resolved with the Strait of Hormuz, the recovery could also be equally fast. So that is the brighter side to it, that, since it's a kind of the man-made blockade, this can also get resolved extremely fast. It all depends on who takes the first step. So I would say, as of now, it looks tough, but yes, it can change overnight.
Thank you so much, Anirudh, for coming in and speaking with us as we're just trying to set up what's happening with the markets. Painful situation really as far as oil and the rupee is concerned. But let's move to our corporate focus, and we're talking about L&T Finance. A bit of a deep dive here. They've reported a strong quarter driven by robust retail disbursements. Sudipta Roy, MD and CEO at L&T Finance, is here with us in our studios. But before we get to that conversation with Sudipta, Shivam is setting up the chat for us and taking us through all the numbers.
Well, yes, L&T Finance has posted a strong quarter and starting with the key highlights, the company has recorded its highest annual PAT of around 3,000 odd crores, and this strong disbursement has been seen in the retail segment, which was led by two-wheelers and gold loan segments. Wholesale book has reduced by 14% on YY basis as the company is strategically focusing on retailization. And if we take a look at the gold loan branches, that too has increased to 330 branches as of quarter 4 for FY26. Now, talking about the AI implementation, the Project Cyclops implementation is scheduled in home loans and loan against property in quarter 3 of FY27, and Project Nostradamus implementation is planned in personal loans, SMEs and farm equipments too. Now, looking at the key guidance that the company has given, the AUM growth is expected to be around 20% in FY27, which will be led by urban finance, rural franchise and gold loans. The NIM plus fees is expected to remain stable in 10 to 10.5% range, and credit cost is expected to trend down to 2 to 2.2% in quarter 4 by FY27. Also, the OPEX is to guided at 3.75% to 4% range over the Lakshya 31st strategy.
Okay, thank you for that, Shivam. Sudipta Roy, MD and CEO L&T Finance, with us in the studio. Sudipta, thank you for coming in and welcome to the NDTV Profit Studios. Great to have you here.
Thank you for the opportunity. Happy to be here.
All right, let's start with how now Lakshya 2026 is pretty much ticked. Pretty much everything you want, done and dusted.
Yeah.
Next step is Lakshya 2031.
Yes.
Since your numbers came, the street reacted well to it. I think you have hit most of your goals. What's the next step? What's the next strategy?
So as part of Lakshya 31, we have now announced a set of 4 goals. In Lakshya 2026 was primarily transformation of the organization from a previously wholesale plus retail lender to a completely retail focused lender. And now, as we see, we ended Lakshya 26, we're a 98% retail franchise. So we're a completely retail company right now. The journey from Lakshya 26 to Lakshya 31 is a journey of acceleration and journey of strengthening the franchise. So we have sort of announced 4 goals, growth at 20% plus across the 5 years, CAGR. We have said that credit costs to trend below 2%. If you see, currently we are at 2.64%, so there is a 60 basis points play, but once we hit 2%, we'll try to hold it at 2% or below during the period. We have said that ROA is in the range of 3 to 3.2% across the, probably towards the latter part of the Lakshya cycle rather than the earlier part. And we have said ROA is between 16 to 18%. So these are the sort of the 4 numeric measurable goals that we are taking for Lakshya 31. And obviously the franchise, which is currently right now about 1,21,000 crores, we expect it to at least, get close to 3 lakh crores at the end of the Lakshya 31 franchise.
So the immediate question, now that was a question talking about the next Lakshya, the next 5-year plan, so to speak. The immediate question is, does year 1 of this plan get torpedoed a little by what's happening? Because as you get more retail and you've hit that goal well, the fact is that in your entire space, not just in your company, the question in the street's mind is what happens to the stress when it comes trickling down to the person taking loans from you or the entities taking loans from you?
Yeah, so two questions here. First and foremost thing, the West Asia crisis, which has a spillover effect into energy markets as well as fertilizer markets, and overall, a lot of second order and third order impacts. Does it impact growth? That's the first question, right, in terms of disbursements, etc. And the second question is, does it impact asset quality? Now, if we take the growth question first, right? So we started well, so April is going well. So if I see real in terms of whether the impacts are showing up in terms of real disbursement momentums getting squeezed, not really, as of now, right? For example, the microfinance industry, which actually was in a crisis period for almost 18 months, has reasonably mended. Disbursements are quite strong. April is a good month for vehicles, especially for two-wheelers because of weddings, etc. in many parts of the country, right? So the two-wheeler momentum is holding strong this month. Tractors, it's a good month. Normal April and May are good months for tractors. So tractor sales are quite okay. Personal loans is still doing well. So as of now, I do not see any palpable signs, but obviously, as the energy markets probably transmit some of the cost of energy that is coming through, which has been largely shielded to this particular point, we might see some moderation. However, our growth guidance has been 20% plus of book growth. I think we should be able to achieve that. On the credit cost side, over the last 24 months, we have been really at the sort of the task of paring down credit and building structural guardrails within the organization to make sure that the credit costs do not go beyond a particular level, even in times of stress. We are and we have onboarded a lot of prime customers who have a lot of resilience during the times of stress. The loss rates between prime and near prime and non-prime is almost at a factor of 3. Non-prime customers are expected to exhibit 3 times more loss rates than prime customers.
How are you making this diversification or this classification of prime and non-prime?
So the fact is that, if you see in the two-wheeler business, we implemented our AI-based credit engine, which is Cyclops, which is probably one of the very first AI-based credit engines, and we did it in June 2024, we launched it. And this quarter in our analyst presentation, we have given up the results of the two-wheeler business, which has now gone through it for almost close to 20 months now. Now, for a book which was acquired between April to July 2025, about 3,000 crores, the 30 plus numbers, 30 days past due post 10 months for our Cyclops portfolio is only 2.71% compared to industry at 7.1%. So we have given out these graphs across cohorts, across the industry categories we have given out, which means the quality of underwriting or the quality of customers that is coming through this engine is almost on an order of magnitude 2.5 times better than that is done by comparable industry. And my prime contribution of this particular flow which has come in is now almost close to 90% of the total sourcing that we do. And our volumes actually also have gone up. So this tool, which is now live in two-wheeler, it is live in SME, it is now in tractors, in personal loans, and going to be live in a microfinance business as well as a mortgages business latter part of this year, gives us the ability to sort of separate the good from the bad like a scalpel, right? And with that, with the leading indicators, we are very, very confident that, we will be able to hold credit costs to a large extent. Some amount of amplitude is possible because if things worsen materially, right? When you are in an ecosystem, some amount of upward amplitude will happen. But the question is that really material enough or is that manageable? For us, we think even if that amplitude happens, it will be very, very minimal and we'll be able to manage it very well.
So just to be clear, the tool protects you in a normal working environment, but if there are systemic shocks where there will be mass scale delinquency, it does not protect you then.
Okay, good question. So the way when we announced our new technology architecture in our RAISE, which is our annual AI conference that we do in the latter part of 2024, we unveiled a technology architecture. We said that Cyclops will be the AI-based engine which brings in the customers. We said that we'll have another AI-based engine which we call Nostradamus, right? Which is for portfolio monitoring. See, typically what happens is that when you source a portfolio, the portfolio generally Indian financial services organization originate portfolios relatively well. The real test of monitoring the portfolio, monitoring risk pools come when your managers or your portfolio managers sift through the already acquired portfolio and look for pockets of risk and then take preemptive decisions. Nostradamus, which is live for us in two-wheeler and now going live in personal loans, actually help us sort of identify those hotspots much, much earlier than probably a normal human-based analysis would do or an Excel-based analysis would do. And it's in a GUI format. So what happens is if a particular geography or a district is showing risk, it will show up as red and yellow. And then you zoom into it.
Are you seeing red and yellow on the screen right now?
No, we are not seeing red and yellow. In fact, I will say when in our early warnings course, I looked at it about 2 days back. 2 districts in India are in yellow and 1 district is in red. The rest are all in green as of now. So as of now, no leading indicators, but the way we have built it is that, what we have told to the markets is that the maximum amplitude of risk we as an organization will allow between good times and bad times is 100 basis points or maybe a max 150 basis points. That means in good times, if your target credit cost is about 2% odd, then in bad times, you will max go to 3%. So we are building portfolios like that, right? So, and we have automated stress testing also. So we have been doing stress testing. Our EWS models do stress testing. As of now, nothing is showing off the behavior, but we have to wait and watch.
So very quick follow-up because Hiral's got her questions as well. But on credit cost, your guidance is to move below 2%. You're at 2.6% right now. When do you hit 2%?
See, this 2% journey will happen over a couple of years. Our guidance is then in Q4 FY27, we'll hit the corridor of 2 to 2.2%. So 4 quarters from now, we should hit the corridor of 2 to 2.2%. The journey from below 2% will happen after that. Okay. So the journey below 2% is a FY28, FY29, latter part of FY28, early FY29 item.
Okay. To add to this now, in the end, what investors want to understand is what is the impact that comes on financials as well of the models that you're building, right? You've talked about how you're monitoring the credit aspect of it. If you have to look at the benefit that could flow into the bottom line, what's that threshold that investors should be watching out for in terms of benefits on the back of the AI model that you're building?
Okay, so AI models do 2 things, or AI implementations do 2 or 3 things, right? First thing is our first focus when we started implementing was bringing down credit cost, right? Because microfinance, tractors, two-wheelers, these are notoriously difficult sort of lending businesses to maintain in terms of credit cost. So our focus was that let's first deploy them on the aggressive credit products, as we call it, and bring down the cost of credit down. So AI models bring down the cost of credit. AI models also increase our operational efficiencies. For example, I'll give you some examples over the past, past 1 year. Our collections in our pre-delinquency measurement as well as in our self-cure percentages, the penetration of AI bot calls is now at about 80% plus. Okay. And our success rates also have gone up by about 20%. This also improves operational cost and operational efficiency. The cost of an AI bot call for us is right now between rupees 10 to 12 rupees per bot call, compared to an average human call of about 300 rupees. So you can see that amount of operational efficiency that it gives. Now, if I were to translate that into a bottom line or a cost save this year, we're looking at about a 30 to 40 crore cost save just in collections cost in terms of AI implementations between bot calls.
Is it leading to workforce rationalization?
See, we haven't sort of shed any people right now, but what it has done is it tempered the hiring of additional people in our call center because these bots are able to take. So as of now, field force, etc., we do not really see much of workforce rationalization because Indian consumers still expect you to do on except for digital personal loans, right? So the second impact is on OPEX and operational efficiency in collections, in terms of processing speed. For example, our AI Copilot for SME underwriting. Prior to implementation, and we have a full AI Copilot for SME underwriting that fully underwrites that file, creates the credit approval memos, suggests the personal discussion questions to the underwriter, and then finally gives its opinion on what amount of loan should be given, obviously to be tempered by the human underwriter. Previously, we used to take, for self-employed non-professionals, we used to take 37 hours to underwrite, that's down to 21 hours. For self-employed professionals, we used to take about 28 hours to underwrite, that is down to about 16, 17 hours right now. And we are still not yet done. 2 more modules are yet to be deployed. Our target is to take it out to about 8 hours. Now, when a previously, and to your question, when a previously an underwriter could do 3 files a day, now we are equipping them with tools to do 8 files a day, right? The same person, right? With much more accuracy, right? So, it will build operational efficiency, and last but not the least, it actually empowers the sales force on ground, right, to answer customers' questions much more effectively. So it has an impact on NPS as well as on customer satisfaction. For example, a mortgage copilot. We recently rolled out a mortgage copilot, which our sales guys use. If the customer asks a very complex question, and for a new salesperson in a product like mortgage who is 2 months into the field, sometimes it might become difficult. So previously they used to call back the product manager, try to get an answer. Now they just key it in and it just gives him the answer. So he's able to answer and interact with the customer far more effectively.
So one, you've told us about the profitability that it will translate to in terms of improvement.
Yes,
what it adds on.
OPEX
is what you've spoken about. The other aspect is if you talk about Lakshya 2031, profit targets are absolutely high, right? Now, your retail segments are high yielding.
Yes.
In addition to that, you've also mentioned about evaluating affordable housing. You're talking about checkout finance as well. How do these new products align with this high profitability target that you've set in for Lakshya 2031?
Yeah, so if you see, we have high yield unsecured products as well as we are in mortgages, which is like of a lower ROA trajectory. Right, so we need to balance all this. So first thing what we said is that given that we have signed off to a sort of a particular credit cost sort of trajectory, we wanted a high yield secured product in our basket. So we acquired gold loans business last year, and when we acquired it, it had 130 branches. As we exited this year, we have 330 branches. So we have added 200 branches in exactly 200 days, 1 branch a day. We're going to add 400 branches this year, 1.5 branches a day. We are going to sort of, we have announced that we are starting a payments business. That is a process of diversifying our fee revenues trajectory. Our personal loans business is growing stronger. And personal loans is also a high yield product, and we're able to hold the credit cost. So between the balancing of a secured high yield product like gold loans, growth in personal loans, growth in two-wheeler business, growth in our microfinance business, as well as new fee revenue streams through the new fee revenue products, plus as well as micro-lab business, 18 to 19% yield, we are very certain that we should be able to maintain our NIMs and fees in the corridor of 10 to 10.5%, at least for the near term. And with the credit cost around between the corridor of 2% in the near term and less than 2% in the longer term, and our OPEX plus credit cost trajectory of between about 5.5 to 6% in the longer term, we are reasonably confident of that ROA trajectory of 3 to 3.2% towards the latter part of Lakshya 31.
Sounds good, Sudipta. Thanks so much for taking the time. Pleasure speaking with you, and I can tell that you enjoy being in the studio. Welcome you back.
Perhaps being in the studio. So
well, that's where we want to talk to you next as well. It's always better to have an in-person conversation.
Thank you so much. Thank you for the opportunity.
No, our pleasure. Well, let's talk about more earnings, right? And we've got Granules to talk about next. It's delivered a strong Q4 with clear quality upgrade. Margins have expanded sharply on robust revenue momentum as well. We're going to speak to the management in the next few seconds, but before we do, let's go across to Varsha to round up the numbers for us. Varsha, how does it look?
Well, overall Q4 numbers was a beat, and as you rightly said, the EBITDA expansion was led by stronger revenue growth and the improved product mix, and the Europe and CDMO emerged as incremental growth contributors in Q4, in quarter on quarter. Talking about the formulation, which is a core revenue growth, now contributes 74% of the total revenue. Complex launches reducing price erosion risk. Talking about the complex generics, they are higher entry barrier and limited competition products, and generics are exceeding 50% of their fixed dose year portfolio. Talking about the peptide CDMO, which is a new growth lever for the company, they have entered via acquisition of Sen Chemicals, and the peptide CDMO achieved EBITDA break-even in Q4 FY26, and they are also focusing on GLP-1 products and overall specialty peptides. Talking about the key structural change that Granules is going into, the business is shifting from a volume to value growth or high margin products, and the complex generic share formulation increased to 43% from 31% last year. CDMO is emerging as a new fourth revenue engine, and the margin expansion that you're seeing is a product mix driven and not cost cut driven. Lastly, on the Gagillapur facility, well, this is a key overhang. Received a warning letters. Management has indicated confidence in a positive re-inspection output. So overall, there are businesses shifting from volume to value growth, but yes, Gagillapur contributing 60 to 65% to the overall revenue remains a key concern for the company.
Thank you so much, Varsha, for that. In fact, let me get in Priyanka Chigurupati, Executive Director at Granules India. Priyanka, apologies for keeping you on hold. Our previous conversation overran, but thank you so much for joining in. Everything said and done, numbers are looking good. And as my colleague Varsha just pointed out right now, the key question is what happens when it comes to Gagillapur, because if the re-inspection gets delayed or observations persist, I'm sure investors want to know what's the financial impact on FY27 growth. So let's start with that and then we will follow suit.
Good morning. Good morning to everybody. Yes, we did have a really good quarter. Now, Gagillapur, I mentioned even in the investor call yesterday that we have had our meeting with the FDA last in January, and we have been sending them our updates continuously. And now it's really up to the FDA to decide when they want to come. But we do have a continuous correspondence with them that's ongoing. So at this point, we'll just leave it to when the FDA comes, or we will send in our notification saying that we are ready for an audit. But that said, we do have a priority review for a product that we filed from this site. So we do expect the FDA to come in rather soon because the goal date of that product is rather soon. And the second thing is, from our perspective, we are reasonably confident in, the readiness of meeting the FDA requirements. We've done all our remediation activities and we're ready to go. We've had about 108 customer audits and 13 regulatory audits over the last year in itself. And we've had very positive response from everybody.
Priyanka, are any complex launches or approvals contingent on this facility clearance? What's the risk factor if you have to look at the opportunity potential that you could see from here?
Yes. So we have about 10 launches that are pending from this site. And from our perspective, we're doing all the pre-validation activities, etc., getting geared up for the launch. So the minute we get these approvals, we'll go boom, boom into the market. But yeah, we only factored in our next year's ABP, we only factored in these launches from the second half of the year. So while they are meaningful, it's not something that would derail the growth trajectory of our existing business. Because over the last couple of calls, I've mentioned that we are actively looking to grow in different areas, different countries, and all the filings have started in different countries. And sooner or later, we'll start getting approvals. Our API, PFI segments are growing decently well in Latin America and other regions. So these could offset some of the growth misses in case the FDA doesn't come in. But that said, I did say that we do have a priority review, so I'm expecting them to come in anytime.
Okay, and hope that gets resolved in the near term. Priyanka, good morning. This is Alex. I'm just trying to understand whether the other extraneous situations that everybody is currently faced with, and here I'm primarily talking about energy costs, I'm talking about crude oil derivatives and the costs therein. What is the kind of impact that you're bearing and you're facing right now? Are you already seeing issues with supply chain, or right now you're insulated?
So there's two ways of answering this. From a supply chain security point of view, we're secured. So we have product coming in, production is ongoing. But that said, from a cost perspective, costs have gone up significantly across the range of products, except the ones in the US at this point. So all the India-based products, the costing has gone up quite a bit. But in terms of profitability, the US contributes a lot more. So we're secure on that front. But the India products, which are also high in terms of profit contribution, we could see a little bit of a blip here and there quarter on quarter, because there is a lead lag effect by when you can pass on the costs. But we are in active engagements with our customers. We have been able to pass on some costs. But that said, a majority of our business still comes from the US, where the dialogue has started. So we will be passing on the costs over the months to come. But I just want to say again that quarter on quarter, this is not the time to look quarter on quarter. We are looking at a yearly level.
Slightly more medium term, you're positioning Granules as a value-led complex generics and CDMO company. So the question is, what percentage of current profitability is still dependent on the legacy commoditized APIs and formulations, and where do you see it moving?
See, if you look at our entire, the formulation change, etc., about 50% of our overall business is still very much what I would say integrated pharma. And that will continue to grow because our legacy products, we're not discontinuing them, and they're actually fantastic. They're actually very good. And with our cost position, our supply levels, etc., we continue to grow in that area. Even 5 years from now, you'll see a big, almost 30 to 40% of our overall revenues coming from these products with improved margins. Now, complex products are giving us not only good margins, but they're helping us position ourselves like a really serious player, especially in the US market. And now, as we keep taking them global, which is only going to start 2 years from now in terms of the revenue contribution, because these are products that are very complex, tech transferring them from the US to here, etc., takes some time. But once you see them, the nature of business is very sticky. So I'm not saying integrated is a bad market to be in. It's a little bit less sticky, more commoditized. Commercials are more sticky. So that's kind of the mix between these two products.
Priyanka, we're running short of time, but one question that I have for you is, you're transitioning from a stable, high-volume generic model to a complex model from here on. And historically, companies have struggled with this kind of shift. So do you think it'll be easy in terms of execution, margin volatility is what will come in, and there could be capital inefficiency as well over the next cycle? So what should you watch out for? A quick answer to that.
I don't think there's going to be capital inefficiencies. First, everything has been factored into our projections, our AVPs, etc. So, like you've seen that we have two first to files where we have, one first to file where we have a tentative approval. We have some really interesting products that have been genericized for a very long time, and people haven't been able to enter the market. So, considering the nature of the products, the margin fluctuations won't be as drastic as, say, some other companies might have, because there's 5 filers launching on day one, etc. So, I do see consistency in the margins once the products go generic. We launch the products.
Priyanka, exciting times ahead, and we're looking forward to seeing it as well. If I be so bold, one of my colleagues, Varsha, would love to come by and meet you at your facilities, perhaps, and take a look at everything that you're doing. And we'd love to tell that story as well. Thank you so much for taking the time for speaking to us.
Thank you.
All right, let's talk about earnings. Federal Bank is something we're focusing on as well. After posting an inline set of numbers in the fourth quarter, there was a one-off, but margins and asset quality actually improved, and gold and CV segment credit growth has added to the NII. Let's go across to my colleague Piyush Shukla, who's in conversation with Harsh Dugar, the Executive Director of the bank.
Mr. Dugar, I want to first start with the bank has posted strong profit, 20% quarter on quarter. In terms of loan growth, the YOY loan growth has been around 13%, deposit growth has been around 16%. I want to understand from a FY27 perspective, what is the growth guidance that you would like to give on both loans and deposits, and among the segment, which are the segments you're wanting to grow on the loan side, and on CASA side, your ratio is at 34%. Where do you aim to take this in the next financial year?
Okay, good morning, Piyush, and thank you so much. Let me give you a broad view as to what has happened in the quarter before I answer your questions. This was the quarter which had reporting very high operating profit numbers. It was the best ever in terms of net interest income, in terms of operating profit, and in terms of net profit. We recorded the highest ever quarterly net profit of 1,259 crores. Apart from that, in terms of some of the milestones which we actually crossed during the quarter was, for the first time we crossed the 1 lakh crore mark in terms of CASA. We are at 1,03,000 crores plus, registering a strong growth in CASA. Our CASA ratio, as I said, is almost nearing 34%. Another milestone which we crossed is the non-resident deposits has also crossed the 1 lakh crore mark, which is at 1,02,000 crores plus. In fact, it's shown a very strong quarter-on-quarter growth of 7% plus. On asset quality, we have been at a decadal low with gross NPA at 1.62% and a net NPA of just 0.2%. We created a floating provision of 456 crores just for the sake of, because we had a interest income coming from an IT refund of 456 crores. So we took as a prudent measure to provide some buffers. So we had done extra provisioning of 456 crores. Our fee income this quarter has been the highest ever at 991 crores. And for the first time, we have touched 1.07% fee to average asset ratio. So these are the broad operating numbers. Apart from that, we opened about 39 branches in the quarter. We launched our wealth offering this quarter, and we did a brand refresh. So this is the broad overview which I want to tell you about the quarter. Has been very strong on operating numbers. Coming to your question on liability and the advances growth. Well, in our chosen areas of growth, which we have been guiding for quite some time now, whether it's commercial banking, whether it's commercial vehicle, it's gold, LAP, we have been seeing strong traction, and we continue to see that, and that will grow in mid-teens in the near term, is what we have been guiding for. On the liability side, we continue to grow our liability book, but we are not focusing so much on bulk deposits or intercorporate deposits because these are high cost ones. But the move very clearly on retail deposits and on CASA remains continue to be high.
Is there any particular number that you would like to guide both in terms of loan growth and deposit growth? This is the target that you're chasing for FY27?
So, like I said, in the chosen areas, we are going to grow much more than the market share. Mid-teens is what we have been indicating for our growth in terms of advances. And liabilities has been growing at a steady growth, which is what we will continue to do that. We will be growing at 1.2 times what the industry has been growing at broadly.
Sure. I also wanted to understand, there was this one-off item in this quarter where it also helped your NII, like you mentioned, it helped you create certain provisions. In terms of margin, what would your guidance be for FY27? Do you feel that the entire transmission of repo cuts has happened on the lending side, on deposit side? Now things will start. Do you have further space? In terms of margin trajectory in FY27, what is your expectation?
So if you look at it, we closed the quarter with a NIM of 3.2. Our exit NIM was actually 3.2%. This is after excluding the one-off gains. If I include that, it's actually 3.74. But let me exclude that for the time being and look at a normalized NIM curve. And if you look at the beginning of the year on year, it was at 3.12. In spite of 125 basis points repo cut, we managed to maintain our NIM. What we have been guiding is that we will be looking at a 5 to 6 basis points improvement in the NIM over the next 3 to 4 quarters, and we are guiding for that part. There is still some on deposit repricing. We will see some benefits yet coming in, and we are also at the bottom end of the rate cycle. So hopefully we don't see a rate cuts happening from here, and that should also give an upside.
Okay, all right. That's the word coming from the management of Federal Bank. Markets, as we speak, at the low point of the day, in fact, down about 320 points for the Nifty 50 at 1.3% lower, and quite a few of the frontline companies are seeing pressure. Even the broader market's losing quite a bit of ground. The mid-cap index now down 1.2% and the small-cap index close to 0.75%. We've got more stocks and conversations lined up on the other side. We're slipping into a very quick break. Stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock.
Welcome back to India Market Open. Now, Waaree Energies, that's one stock to watch out for. Stock is actually down a little over 8.5%, now almost 10% in trade. And the numbers were okay. It was only the margin hit that was a negative, and that's what the street is reacting to. In fact, let's get in Varsha as well, who's, before we hear from the management as to what they had to say. Varsha, what are the key negatives that you've picked up first up in terms of Waaree? And number two, are there any positives that one should look at, because the stock is down nearly 10%?
Yes, let me talk about the positive. The only positive that one should pick up is the revenue growth. If you see, the revenue has doubled and they have also maintained their EBITDA guidance. But margins were clearly a huge disappointment that the company has seen. EBITDA margin fell sharply year on year, well below expectations. Now, there was also realization which was under pressure. Higher non-DCR mix led to weaker pricing, and hence you're seeing the realization under pressure for overall FY26. If you see, the strong top line growth didn't fully translate into earnings, even though the revenue doubled, but because of the decrease in margins, your bottom line also suffered. So bottom line was up almost 80 to 84% year on year. Also, aggressive capex raised concern. So if you see, the debt levels have also risen, almost tripled. So the debt levels have nearly tripled in 1 year, alongside heavy expansion plans, and the volume growth technically overshadowed profit growth. And even the company has given the FY27 EBITDA guidance of around 7,000 to 7,700 odd crore, which is just 30% growth over FY26. And historically, company has seen a strong growth. So maybe company is expecting a slower growth, going forward, and maybe these margins would be the new normal margins going ahead, because we have seen a sharp margin hit, and that's what the concern is, and hence you're seeing that 10% down or 10% pressure in stock price.
Thank you for that. It actually puts a lot of things into perspective. But let's also hear out what the management at Vari Energies had to say in terms of the outlook and the growth drivers. They spoke to Varsha.
Strong revenue growth that you have seen, plus you have met your guidance of EBITDA also. But margins, Mr. Parekh, if I were to talk about, saw a dip. What were the key triggers? Are these margins the new normal for the company, or are the margins expected to dip further?
FY26 has been a remarkable year in terms of growth in revenue, growth in production, growth in overall organization built up as well. We call it as Vari 2.0 integration. FY26, the total production was 12 gigawatt plus. Last quarter was 4.2 gigawatt plus. Our revenues have almost doubled, and EBITDA was more than doubled. Our guidance was 5,500 crore to 6,000 crore of total EBITDA, while we have achieved more than 6,500 crore of total EBITDA last year. So in all the aspects of performance, the numbers have been better than expected.
Sir, still you did not answer my question about margins. All this is fair, but margins, if you see, you have seen a dip in the EBITDA margins. So are these margins new normal, or you're going to see further dip? I mean, are you structurally moving towards low margin products?
So actually, if you see the overall margin of 22% plus in FY26 compared to 18% margin in FY25, margins have improved. Yes, quarter on quarter, there are few margin changes, like in few quarters, margins are 1-2% higher. In another quarter, it could be lower. Also, last quarter was a surprising quarter in terms of the global situation of war, especially in the Middle East. The price of commodities were skyrocketing. The price of logistics shipments were all-time high. We have never seen the logistics choke up the way we have seen in last quarter. Despite all of those issues, we have been able to deliver and ship out the products well in time to our clients. And I think that is something more to talk about. Yes, the commodity prices have bit of say in terms of our margins last quarter, but we believe that with further integration of capacities backward, with new 10 gigawatt of cell capacity going live this year and 10 gigawatt of ingot wafer capacity already started the construction, we are expecting our organization to be further resilient in terms of our supply chain and price volatility.
On that note, Mr. Parekh, so I mean, if you see in Q4 FY26, the margins were 19%, which is down versus I think 25% in March 23% in March 25. So you just said that because of the increase in the cost of materials that you have gone through. But for FY27, what are the margins that investors should peg in?
Our guidance of FY27 is 7,000 crore to 7,700 crores, which against the 5,908 crore of EBITDA, operating EBITDA last year is much higher. We are not given the guidance of the revenue. In fact, for us, what is more important is EBITDA achieved per watt peak. Because in this industry, the prices have remained volatile. The end prices ranges sometime from 15-16 rupees to 18-20 rupees, and sometimes it goes even beyond that range. So price is never in the control. What we can always do, we can build an organization which is more resilient in terms of EBITDA per watt peak basis. And that has remained under control throughout the year.
Right. Sticking to that, Mr. Parekh, when it comes to the EBITDA guidance of FY27 of around 7,700 crore that you have given, if I were to, see historically, I know that you were operating at a lower base also, but from FY26 to FY27, the EBITDA guidance that you have given gives us a 30% growth year on year. But historically, if I were to talk about from FY25 to FY26, you have doubled your EBITDA, even surpassed the guidance. Why this lower growth of 30% from 26 to 27 when it comes to the EBITDA? Just wanted to understand the key levers for that. I mean, does this mean that now you will be seeing the slower growth and not the historical, the highest growth that you have seen?
First of all, we're talking about a company which has achieved 26,000 crore of revenue. In terms of the growth, we have seen around 100% growth in our revenue. Last financial year, we have seen all our new capacities going live. The large capacity build-up has happened a year before, and the outcome was FY26. There are new capacities even this year as well, FY27 as we speak, which are going to go live, especially 3 gigawatt capacity in US, 10 gigawatt of cell capacity in India, and 10 gigawatt of ingot capacity in India as well. But more important to note here is that we are no more a solar panel manufacturing company. We are no more just a solar value chain company. We have gone much beyond that. Over the last 4-5 years, we have been consistently working towards building an organization which is more towards the energy transition and which is helping the clients to secure their energy requirements over the next 20-25 odd of years. If you see our announcement over the last few years, our energy storage project of 20 gigawatt live, 20 gigawatt capacity is already under construction. First phase is even going live this financial year. So that way, yeah, new capacities are certainly going to help us build a more resilient organization.
On that note, Mr. Parekh, so you're also moving to ingots, like you said, doing a huge backward integration also. But how will you compete with the cost-efficient Chinese players that are already into, into this solar chain value supply?
Over last 2 decades, almost 2 decades, when we started our solar journey, we have seen competition has always been there. In fact, till FY21-22, there were no protections also from imports as well. Despite that, company has enhanced the capacity from 30 megawatt to today around 25 gigawatt. We have become the largest non-Chinese company in the world already last year in terms of our overall capacity. So certainly the transition is under progress. We are witnessing 2.0 journey, which we call as strategy and direction. Our storage, like electrolyzers, our power electronics, our T&D, our local US manufacturing and further integration are really going to create Waaree 2.0. In terms of scale, we are much larger, but in terms of integration, will be even more larger over the next 2 years of time.
Let's see if this optimism from the management actually translates into gains for the investors, because the stock has been under pressure on the back of the margin impact. And the conversation is whether, they are moving into low margin products as well. But moving on, let's also get in Mark Matthew, Head of Research Asia from Julius Baer. Mark, good morning. Welcome to the show. This is Hiral on this side. The key concern right now is crude above $120 per barrel. If you have to talk about the rates that are ongoing in terms of June futures, you have been of the opinion that investor flows may remain weak for India if oil stays above $80. We're already above 120. Given this recent spike, at what point does this, would this actually mean a move from a sentimental headwind to a fundamental threat, according to you?
It stays at this level, it's definitely a fundamental threat for India. And that's why, by the way, Asia is underperforming this morning the United States. Not just India, but other countries in Asia as well are net oil importers. America is a net oil exporter. For America, it's more mixed than bad. For Asia, it's just plain bad, and that does include India. And we remain of the view that the oil price is going to come down. I find it difficult to explain exactly how, but we just think if you look back at the history of these political events that have caused big rises in the oil price, that they tend to sort themselves out after a while. I know the news headlines don't suggest that. Just yesterday, President Trump met the CEOs of the oil producers in the United States and told them that the blockade could last for months. But there is a Pulitzer Prize-winning journalist named Seymour Hersh who has very good contacts, including in Israel. And he published a piece on Substack this morning saying that Donald Trump wants to basically pay Iran $25 billion in order for the Strait of Hormuz to be reopened and all of this to be finished. And Seymour Hersh has in the past proven to be quite reliable with his insights. So our view is the oil price will be at $70 3 months from now and $60 a year from now. And if we're right, as much as 120 hurts India today, I don't think it's going to be a long-term issue.
It's well put, and I'm hopeful, Mark, that is indeed the case. And good morning, Alex here. I'm wondering what you made while we're on the subject of oil, and whether this is factored into your estimate or assumption on where crude oil prices are heading. The exit of the UAE starting from the 1st of May from the OPEC bloc, and what it means for supply. They can ramp things up in 2027 to as much as 5 million barrels per day.
Yes, they can. And I think their quota is 3.5 million now. So that's a very large increase. In fact, I was just reading an article by one of your colleagues in NDTV Online, Aditi Baduri, about an hour ago. And she wrote one of the reasons the UAE wants to find buyers. One of the reasons why the UAE is exiting OPEC is it wants to find buyers closer to it geographically. Well, India is the biggest possible buyer that is next to the UAE. So this is very good for India. It should mean a weaker oil price when the Strait of Hormuz is reopened. And by the way, I don't think Saudi will just stand idly by and let UAE ramp up their production to its maximum. Saudi will also want to increase its capacity as well. Everybody knows that we're moving toward a renewable energy future, and there's a finite amount of oil in the ground. You might as well make hay while the sun is shining.
Absolutely, or at the very least, oil. Mark, so therefore, from that perspective, and here I'm talking about the Indian investor that is primarily investing in this market, there has been relative resilience. Of course, volatility has been elevated, but if I look back over the last couple of months, you've seen quite a bit of a retracement from the lows of March that has taken place in April, and that's across the board. So the question to you is, are we likely to see periods of sharp and elevated volatility which settles down, and how much attention are you paying to earnings in the fourth quarter, assuming that Q1 will actually likely take a hit?
I think the way I would answer that is the reason why India has been a laggard globally is the big foreign selling. We know that the domestic investors have continued to put money in. To me, that's a good sign. I would prefer to see local buying than foreign buying, because I think everywhere in the world, locals know their own economy and market better than foreigners. The foreign selling, the first wave of it was really for foreigners to raise their allocation in China back to an overweight after many years of not being present there. And India was really the only big emerging market that they owned in size that they could take money out of to fund a China overweight. And then laterally, it's the oil price spike, which has caused another wave of foreign selling. I don't know how much foreigners have left in India, but I'm hoping not a lot, given the enormous amount they've sold. The shares outstanding in the iShares India ETF, the largest India ETF outside of India, are down over 30% since the war started. I would imagine that there could be some more selling, but the bulk of it is over. And then, yes, absolutely, we need to look forward to the earnings, which I think, assuming we're right on the oil price, can still be in the mid-teens this year. The problem is that the earnings in America are also going to be in the mid-teens. So from a growth perspective, of course, people want to invest in India for its growth. It doesn't particularly look like it has a lot more growth than the United States right now.
So Mark, the question is then, if the FI outflows is something which is narrowing down now, once they start coming back, which are the sectors, according to you, they will start looking at? Because usually the trend that follows is banks and IT. Both of these sectors have high amount of pessimism right now. And a lot of opinion goes that sectors with high pessimism will see a lot of value, maybe not a lot of growth. In that kind of a scenario, where do you see FIs, investing in India?
I'm sorry, I don't feel I can answer that question with any degree of great depth. I think that a lot of the fund flows, the bulk of the fund flows, dare I say as much as 80% in the world today, are no longer fund managers. They are valuation agnostic. It could be retail investors. It could be ETFs, could be quantitative funds, trading funds, algorithms. Anyway, I think they would just buy the entire country's market. I don't know if they would spend the time sniffing around to find what's really deep value. It's unfortunate, but at least in the current environment, that kind of style of investing is not the bulk of investing. It's a small minority now.
Globally, Mark, and I take your point, and it's fair to say what you just said. Globally, though, and I'm asking for a view beyond crude oil, you've said that you anticipate it will cool off. But we've seen the commodity cycle, not just on account of this conflict, even before that, the upswing therein. So do you anticipate that will continue heading into the remainder of this year?
Broadly, yes, excluding energy, because we have a commodity structure globally that was built around a world that was open for trade and capital flow and the flow of people. And that, of course, sadly is reversing. We're going back to a regionalized world, even a highly nationalized world, where countries want their own access to strategic resources, including commodities that they deem strategic. Most commodities do have very important purposes that are vital to economies. And so therefore, yes, we think that as various countries establish new supply chains to make sure they have security in access to those commodities, it will continue to bid up the prices of commodities generally.
So Mark, in terms of India, if you have to look at the small and mid-cap space, are you seeing good amount of value emerging there in terms of valuations right now, if you have to look at the valuation perspective? And if so, which sectors would you look at?
I'm sorry, once again, I haven't really had the time to do the sectoral research that would give me the authority to answer that question. But I would just say I don't think Indian small and mid-cap is a value space. It's a growth space. So there's no harm, there's no problem with that. It's just that typically they are expensive stocks because they're small, they're in growth sectors, be it hospitality or healthcare. There's a dozen of them. And that growth, it will make them good investments over the long term, but they're not cheap.
Okay, so you're saying in terms of valuations, they are not cheap, but there are good growth opportunities coming in there. And my last question from my side coming to you is, overall, with everything said and done, what's happening across from crude to what's happening in the equity markets, any other asset classes where you're seeing that, okay, probably there is value emerging or growth emerging?
Well, I mean, you put me on the spot, but I can think of one. It's probably not of great interest to your viewers. Hong Kong property.
Okay, but that's interesting to look at.
Yeah, it's interesting to look at because nowhere in the world am I more optimistic about the future than Hong Kong. I think it's going to have a very bright future as this new world, this multipolar world we live in, needs bridges of communication between the global West, the global South, the global East. And Hong Kong will absolutely be one of those key bridges, places of meeting. Hong Kong property fell about 30% over the last 7 or 8 years because of all the troubles that city went through. But it's now starting to rise again, and the stocks there trade at over a 50% discount to their net asset value, which is far below the long-term average net asset value for the Hong Kong landlords. That's 30%.
Very interesting. Mark, as always, an absolute pleasure speaking with you. Thanks so much for taking the time.
Thank you.
All right, we're closing out India Market Open, and we're currently not too far away. In fact, at the low point of the day for the benchmark Nifty 50, close to 1.5% down, 350 points. But from Hiral and myself and Tamanna and everybody that put the show together, thank you so much for watching. Up next is Ask Profit. Keep your questions ready and stay tuned. This is NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management.
Hello and welcome back to NDTV Profit. You're watching Ask Profit, a show that solves all your stock-related queries. My name is Puneet Zaveri. With me is Soumit Sarkar. And before we start taking all your stock-related queries, the big numbers out for today for HUL, 16,351 crores in terms of revenue. Seems to have met the estimate that we were working with, numbers of almost 16,200 crores. EBITDA as well at 4,105 crores have also come in line with numbers, and the margins seems to have met estimates handsomely. So HUL after Nestle has actually also come out with decent numbers, and the stock has now come back in the green. So EBITDA margins very strong at 25.1%, gives you that perspective of what we are seeing on the ground from these two large FMCG players. Profit up 21%, coming in at 2,992 crores. We'll of course get you a lot more granular data in terms of volumes amongst others, but these numbers look good on screen at this point of time as well. But let me welcome in Naveen Kulkarni, Chief Investment Officer at Axis Securities as well, joining in now. Mr. Kulkarni, thanks so much for joining in. Just in terms of these first four numbers, it seems to be that the numbers largely in line with estimates, also beating estimates in some sense. Would that be your assessment as well?
Yeah, I think so. The numbers look quite reasonably strong. But more important will be what is the volume growth number for the quarter, right? So that is a critical number which I think we have to look at. Second, of course, management commentary will be very, very critical, because last quarter, of course, the full impact of input cost would not have been there. Going ahead, there will be the significant impact of input cost which will come. So right now, the focus will be on volume numbers and, of course, maintenance of gross margins going ahead.
As we await the presentation where, you'll get the volume number picture as well, just in terms of segmental performance has been quite strong as well. Home care revenue is coming in at 6,300 crores versus 5,800 crores on a YY basis. You've also seen growth in beauty and well-being. That's come in at 3,600 crores versus 3,200 crores in the same time last year. And foods business has largely remained flat at 2,200 odd crores with a similar number last year as well. Mr. Kulkarni, just in terms of both home care as well as beauty, those two verticals continue to show growth at this point of time. Is there assessment that a lot of the commentary also will be looked at from that perspective on these two verticals, or what are the expectations of growth?
See, I think it's important to see what's going to happen in the forthcoming quarters, right? So home care, of course, should start seeing growth, because with the kind of input cost regime that we are in, competitive intensity should come down, right? And that will benefit HUL. So the expectations of growth improving is difficult to gauge, considering that there will be higher pricing. But important factor will be how competitive intensity pans out and nominal growth pans out over the next few quarters.
Also, Mr. Kulkarni, after Nestle, we've also seen another big beat on margins for HUL as well. Now, the reasons, of course, for Nestle were that there has been a very strong focus at this point of time on increasing advertising costs under the new management, and hence that was another big benefit as well. For HUL, likely seems to be the similar case at this point of time as well. But do you feel that that could be a big strategy going into the next year as well, where we will see advertising spends being increased across FMCG players at this point of time?
I am doubtful that advertising spends will increase across FMCG players at this point in time, considering there is going to be serious pressure on input costs. So whenever we see that the gross margins are under pressure, advertising expenses come down. So I would be very surprised if advertising expenses over the next few quarters will go up. But also what happens is that whenever there is high pressure of input cost, the competitive intensity also decreases. So from that perspective, you may not need to spend so much on branding at that point in time. So it's going to be a very difficult tightrope walk for HUL over the next 12 months. But important aspect is that these are times when typically HUL and strong branded players tend to gain market share and they do better. Whether this cycle will be same or not is something which remains to be seen. We'll have to see what the management commentary is on volume growth and the kind of input cost pressure which is going to come in the forthcoming quarters.
Fair point, Mr. Kulkarni. Just wait on as I go across to my colleague Mahima, who's actually at HUL's office here in Mumbai. The press conference starts at 11:30. But Mahima, what the number seems to be largely in line with the numbers with estimates as well. What are you picking up?
Right, so Puneet, overall revenue as well as profit is largely in line with what the street was expecting. But I think it's a big surprise coming in for the margins for sure. Overall, the margins have come in at 25.1%. The expectation was it to come by around 23%. They've always guided for that range of 22 to 23%. But now the question really is whether these margins will be sustainable or not. But I think the big surprise is coming in terms of volumes. The expectation was around 4 to 6 odd %. It's come in at that higher higher end of 6%. So I think that's a big win, overall for HUL. In terms of segmental performance, also home care has done a growth of around 9%. Beauty and wellness saw a growth of around 8%. Personal care has also seen a growth of around 5%. And foods business has also seen a growth of around 5%. So all in all, it's definitely a good set of numbers coming in. Revenue and profit largely in line, but I think margins has seen a good beat. And like you mentioned, advertising expenses for all of these companies have gone up, and that is probably bringing in growth when it comes to the volume as well as top line. And plus, the GST cuts playing its part right now in terms of the overall growth. So this is the overall view of how Q4 has panned out for HUL.
Well, thanks so much for that, Mahima. As you stay on, because we also got the volume numbers now. So for home care business, which is 37% of the company's revenue, you've seen a high single-digit volume growth for this vertical. For beauty and well-being, low single-digit volume growth is what's come in. And for foods, while the revenue hasn't gone up materially, you've seen a mid-single-digit volume growth with a 20% margin profile as well. I'm not sure if we still have Mr. Kulkarni also online. Mr. Kulkarni, just in terms of the volume growth, as you were highlighting, we've seen a high single-digit growth for the home care, and we'll probably wait for him to come back. But seems to be in terms of volume growth that there has been key perspective. But on the personal care side, we've actually seen a low single-digit volume decline at this point of time as well. Now, those are some of the key numbers highlighting, and we'll come back to it. Of course, the presser at 11:30 will get us some more perspective on what the management is thinking. But numbers seem to be in line with the estimates, beaten estimate as well at this point of time, and some key highlights coming in, of course, on your screen for personal care as well as for the other foods business as well. But we of course have Ask Profit. Let me also welcome in Avinash Gorakshankar, founder and head research at Avinash Mentor Research Services. Also Kush Bora in the studio. But Avinash, let me come back to you very quickly on firstly the HUL numbers seem to be a beat in terms of margins. Is that your assessment, and what do you make of the volume growth?
No, I think, Puneet, volume growth has been pretty decent at around 6%, and margins definitely have shown a good uptick. I think that's a good positive surprise from Lever, because, a 7-8% top line growth is not something great. I think the margins was more important, and that is something the markets are happy about. My sense is, markets would obviously like to know that whether this volume growth is going to be sustained, because typically, after the monsoon forecast, there were expectations that possibly the forthcoming quarter is going to be another challenging quarter. So I think most importantly will be the outlook and the kind of growth, outlook which the company will share with its investors. But net structurally, this result is good. I think the stock will remain in the bus today, but I think going forward, any re-rating will entirely depend on whether this volume growth is going to be sustainable and this margin improvement is going to happen. Because if petrol volume growth gets impacted by the poor monsoon, then I think it could possibly face a challenging period in the coming 1 or 2 quarters.
Okay, let's also get in Naveen Kulkarni, Chief Investment Officer with Axis Securities again. Naveen, if you look at the volume growth, it has come in at 16%, which I believe is at a 15-quarter high, 7% sales growth at an 11-quarter high. This is much ahead of what the street was anticipating. Other than advertising cost, what could have aided HUL? That's the very first point. And the second point is that what is the key thing that you would want a clarification from the management on for going forward?
What is the volume growth you said?
6%. 6%.
6%.
There's a 15-quarter high, right? The volume growth?
Yeah, so 6% of course is a decent number to look at. So the important aspect will be sustainability of the volume growth. 6% volume growth, 7% overall nominal growth, I think looks quite okay to me. But important factor, I think, is going to be how the volume growth is going to sustain in the 2 to 3 quarters. Demand environment will also be an important factor, but I think that in typically the categories in which HUL operates, demand doesn't change very significantly in the short term. So from that perspective, I think these numbers definitely look quite good to me at this juncture, and going ahead, I think the stocks should do well.
Got it. Well, Naveen, we'll let you go on that note. Thanks so much for joining in, helping us with the first cut for HUL. Numbers beating estimates. Volume growth of 6% also is quite positive. And we'll, of course, get you more perspective once the presser starts. Stocks slipped back in the red at this point of time. Was up almost 2% at one point of time when the results came in, of course. But some more clarification once the press conference starts. You can catch all highlights here right here on NDTV Profit. But let's go across and start taking your stock related queries now as well. The first question that we have now is from Navendu Sharma. He's holding shares of Kalyan Jewellers, bought at 418, and asking what are some of the key prospects that you could highlight for the long term. Now, Avinash, Q4 update was quite strong. Results we are still awaiting, but what your view of what Navendu should do at this point of time?
I think, see, unless the investor has got a time frame of at least next 12 to 15 months, in the short term, the markets are volatile. We have seen gold prices also easing off. But I think demand on ground continues to be very strong. And I think the April to June quarter is going to be equally good in terms of festival and marriages. So I think, gold jewelry business as a whole is going to grow well. So my sense is unless he can hold on for the next, say, 12 to 15 months, in the short term, of course, the results would do the kind of small re-rating on the stock. But medium-term prospects appear to be quite positive. So I think stay invested. If he has got some surplus money, he could even average the stock. But my sense is this is definitely a growing business and would definitely yield reasonably good risk rewards in the medium to long term.
Right, the next query is coming in from Kumar, and it's on SJS Enterprises. He wants to know whether should he buy this counter for the next 1 year. Avinash, any view on SJS Enterprises?
Well, I think, Amit, this is a stock which is operating in the auto component space, has a very unique product offering. So I think, at these levels, my sense is, the stock appears to be fairly valued. Unless the investor has got a 2-year kind of time frame, I would not be surprised that in the short term, the stock has possibly, risen to its fullest potential. Maybe if he wants to buy, he could still think of buying in, in small pieces. He could try an SIP approach and then stay invested here.
The next question coming in on Oswal Pumps, and this is Kalyani from Andhra Pradesh and wants to know a short-term view of the stock. Now, she's holding shares at 414 Kush and holding 2,000 shares. So it's a material holding she's built up. What's your view on the stock now? Welcome to the show, of course.
First of all, very good morning, guys. I hope it was really indeed a good morning, not turning out to be so. First, let me just give a quick global view. The fact that, we are seeing this correction, we spoke about this yesterday on the morning show, that a lot of stocks are seeing exhaustion, and primarily because a lot of them had run up 30% or more in the last month or so. So it's not a bad idea to take some money off the table if you haven't already. But of course, we'll be here to answer stock-specific queries also. Oswal Pumps very particularly has had a good run. Right now, consolidating on thin volumes. The good thing is that her buy price is not too far from the current price. My suggestion, you should continue to hold on to this. Stop loss around the 390 mark. The first resistance, in fact, for the stock comes in at 425, which is, some distance higher than her buying price. So I think this is fairly comfortable to hold right now. 385, 390, that's the support zone. Continue to hold.
Got that view, Kush. But, some important, filing coming in from Bajaj Auto that they might consider and board might mull a buyback on May 6th. Now, it's been, and stocks reacting also very positively at this point of time. And we've seen a correction from almost those 12,000 odd levels almost 6 to 8 months ago. And those levels haven't come back yet. So recovery from 8,000 odd levels. But it's interesting because, Rajiv Bajaj continues to maintain that the fair value was 12,000 once it got there. He's continued to maintain that it's much, much higher at this point of time. So maybe that's something that could be watched and looked at in terms of Bajaj Auto at this point of time, because in terms of course, valuation concerns, TVS is almost at 30 to 40% premium trading to Bajaj Auto at this point of time as one of the leading one. So is Eicher Motors. But Avinash, just a quick view, if I can, on Bajaj Auto. Do you think that it's a good step right now for the board to look at, because you've seen, of course, that valuation differential with other peers?
No, I think clearly, buyback is positive for the company as well as for the markets, because that actually improves the ROE and the earnings growth for the company. And I think Bajaj Auto has got a lot of surplus cash which it can use for its buyback. But again, Puneet, what kind of size of the buyback is this and what is the kind of price they are looking at is something would determine the trend in the stock in the short term. So I think, it's good, positive news flow. We'll have to wait for the finer details to come in. But definitely, I think in terms of valuation, I think, we need to see very strong numbers from Bajaj Auto if one were to really give it a direct one-to-one comparison with TVS Motors. TVS Motors has been growing very rapidly in terms of volume, in terms of margins. So to that, it will take some time for Bajaj Auto to catch up. But this buyback news flow is definitely good in the short term. we'll have to wait for the finer details to come.
Okay. The next is a caller query coming in from Delhi. Gautam, you can go ahead and ask your query.
Good morning, everyone. My question would be to Kush. It's regarding Siemens Energy. I have around 30 shares that bought at a price of 2,800. Now, most of its counterparts, its peers, is GE Vernova, Hitachi, and ABB. They have given extraordinary returns. Given the future prospects and the solid management, what would be his views on this?
Kush, your view?
Hi, first up, Gautam, I think you've researched this stock very well, so kudos on that. And secondly, kudos on the fact that you've bought it at a very interesting price, by the way. That was where, when the stock was languishing and then just gave a sharp breakout from those levels. So kudos on both these things. And you're right, GVT, ND, ABB, some of these names, in the pair group have done well. They've been, our calls as well on the show if you've been listening to us regularly. So yeah, we've suggested partial profit booking only because they've been overheated in the near term. Now, Siemens Energy, I think you should continue holding on to this one. There are a few technical events which are lining up rather beautifully for this one. 3,400 rounding bottom formation, resistance in the clear. There is already a golden crossover of the 20 and the 50-day moving average. 20 and the 200-day moving average golden crossover just about coming up. I think once that happens, the stock will zoom to 35.25 and 36.50 levels. So if your view is from a momentum perspective, I think it's not a bad idea to hold on to this one. I would, as I always do, suggest a trailing stop loss in your case because this is in profit at 31.50 levels.
Got that view, Coach. The space, has got so much attention now, especially after the Israel-Iran war, that all these energy stocks seem to be buzzing in that sense. But let's go across, take the next question from Arvind, who's a regular viewer on CSC. Now, Avinash, his question largely being a 1 to 2 year view on the stock. We've also seen the election, so his question also is that could we expect a price hike probably post-election? What would be your view?
I think we should continue to hold. I think whether the price hike comes or not, I think we'll have to wait. But I think definitely, if we can give in a little more time, maybe the next 2 to 3 quarters, I think definitely it could be a good decision to hold on. Obviously, numbers could get better once the price hike comes. So I think we'll like to wait and watch. But yes, PSC definitely is a stock where I think a lot of value could crystallize over the next, say, 12 to 15 months.
Next query is coming in from Puneet from Ghaziabad, and it's for you, Kush. He wants to know an entry price and a target price for Max Healthcare for the next 3 months.
Yeah, interesting choice of stock there. The stock is in a downward, sloping channel, but it is trying to find its support near the 935, 940 zone. I would be a little cautious on this one, by the way. There is a good possibility that, this breakout, if it doesn't cross those 1,000 levels, could well fizzle out. So as far as the entry points go, I would suggest 980. That's a good entry point. You get a good room to keep your stop losses at the 950 mark. On the way up, 1,025. And about 1,060. These are your targets. But like I said, the stock is rebounding. You might want to just give it some time, or maybe at least keep your quantities low if you've decided that this is the stock that you're going to go with.
Got that view, Kush. Now we're getting a lot of viewer queries on Vedanta. So I'm just going to club a few of them together. Rosa has actually, bought Vedanta yesterday at 777. And let's pull the stock up because there was a special trading session today to determine the value of the demerged entity. So you've seen a crash today of almost 60%, largely on the back of that. And we are showing you the adjusted price today. So 290 approximate levels were the adjusted price. From there, the stock is down 3% as well. So that is the key aspect. Now, her question largely being if she should buy more today. We also have another one from Jerry Lobo from Pune, who's asking if it's a good time to enter this stock. Now, Avinash, of course, we know the ratios for the 5 companies that will be listing, including the existing one. How are you seeing Vedanta? Because there are a couple of entities like the aluminum business which could drive the higher value. Do you feel that investors can get selective with certain ones that they should have in their portfolio? And what's your opinion?
No, I think, Puneet, you're right. The aluminum and the oil business will get the premium valuation. And I think the residual company, which I think the value has come today, I think we'll have to wait for some time because, today the price discovery has happened. What price the stock will stabilize, we'll have to see. But this will be now an holding company. And typically, I expect that the holding company will get a discount of at least 20%. So to that extent, the holding company will have businesses like copper and zinc in it, which is not included in the 5 separately demerged entities. So aluminum and oil, and of course, if somebody were to buy the holding company, then be prepared for a holding company discount. But yes, long-term prospects for both copper and zinc appear to be quite good. So, from a longer-term perspective, I think one can definitely add this, but you'll have to keep a slightly medium-term kind of time frame.
Right, the next query is coming in from Prashant and it's on Eternal. He's currently holding around 900 shares. Average buying price is 251. He wants to know the short-term view on this counter next 3 to 4 months. Kush, any view here?
Yeah, not very constructive. It could be consolidation with a negative bias. I was, like I've said in the past, constructive on Eternal above levels of 300. Once it gave way, it's seeing some selling pressure, lost flavor with the market, and you are seeing, that selling pressure extend. While the stock is not too far away from his buying price, and if you want to give yourself some chance of recovering, because you have a decent time frame of 3 to 4 months, my suggestion would be keep a tight stop loss at 235. There is a gap, also a support resistance. Support around that mark 235. If that is broken, this recovery attempt could also fizzle out. So while I have my skepticism around this move, just to give the chance for the next 3 to 4 months, I would suggest hold, but with a very tight stop loss at 235.
Got that view, Kush, but time to get into the F&O market setup as well, and Sharad is now joining in to give us that perspective. Sharad, over to you.
Well, yes, yesterday we did see a good gains coming in, but I think there's a reversals at play and some technical levels is something we should be watching out for. Some levels, of course, Eternal, Interglobe Aviation and HUL on back of earnings, all of them are falling more than 3% in the day's trade. Only Bajaj Finance earnings impact and Infosys largely flat is there, but largely you can say 90% of the constituents plus in Sensex are in the red, and the story of course remains the same for BankX also. The VIX has jumped 11%, so that's a concern as well. But let's see stock specific moves, what's happening. Long build up, I doubt the list will be small, and now we just have some tech names, interesting mid cap names. Emphasis and KPIT Tech make it to the list. And let's look at the short covering if we have any, and we have a couple of names, Motilal Oswal and Bajaj Finance. These BFSI numbers are decent, but it's not very big also, at least in the F&O space when it comes to the numbers. Long unwinding comes in for Vedanta and Adani Enterprises, and short build-up. Also, if you focus on that, we have Vari Energies on back of earnings, and Indian Bank also recently that also come out with its earnings, but a big reversal is there on the chart. So these are the important stocks which should be in your radar in the F&O counters.
Well, thanks so much for that, Sharad. But Avinash, Kush, as well as our viewers, it's now time for the rapid fire round in this edition of Ask Profit. The first question that's coming in, it's on Quality Power. This is Raju who's holding these shares, and he's asking if he can book profit or continue to hold. Avinash, what would be your view?
I think partly book profit and continue to hold the rest quarter.
Krish is holding around 1,000 shares of Union Bank at a price of 185. Should he continue to hold this, Kush?
At 185, I think yes, you should continue to hold, but keep a stop loss at 157.
Eureka 4 bought at 646 by Mahesh. Avinash is asking what should he do with his 40 shares for the next 2 to 3 years?
I think he should hold on.
The next query is from Seshadri and it's on TCS. He's holding 35 shares, bought at a price of 3,076. Should he average now? He can hold the counter for the next 6 months, Kush?
No, don't average.
Ramesh wants to enter Ramkrishna Forging at the current levels. We've seen some run up, but do you like this stock now?
In fact, by the way, it was a call that we initiated just this week. Went on to hit target 2. It's cooling off right now. I like the stock. Buy around 575, 580 zone.
Abhin from Kerala wants to know whether should he buy Voltas at current levels for long term, Avinash?
No, I think wait for some correction. That would be a good entry point, not now.
Suvina might be holding on to ONGC and asking Kush what's a good exit price at this point of time.
It is already seeing some run up. My suggestion would be to exit partially right now and hold the rest with a stop loss at 290.
Usha from Bangalore is holding 600 shares of Denta Water, bought at a price of 326 for the next 12 months. Should she continue to hold this, Avinash?
Yeah, I think continue to hold.
PCBL bought by Mr. Chaudhary at almost 540. So Avinash is sitting on considerable losses, asking if he should continue to hold or exit this counter now.
No, I think better to exit.
Next query is on NTPC. Raja from Chennai is holding 187 shares, bought at a price of 357. Should he hold or sell, Kush?
357 buy price, right?
Yeah.
Yeah, you should book profits at least for the near term. Maybe consider a declines. Book profits now at least.
Mr. Rao is holding on to Indian Overseas Bank at 48 for the last 2 years, Avinash. He's asking if he should continue to hold on still to this counter.
No, I think it's better to exit.
The next query is for you, Kush. The viewer, Ramanna, wants to know whether there is more upside to MTAR Tech from current levels.
Yeah, I think Ramanna has been listening to us. There is upside, but it's already overheated on weekly and daily setup. My suggestion, if you have a position, book partially right now and hold the rest with 5,700 as your trailing stop loss.
Aditya Kiran wants to invest in Netweb and Hindustan Copper. Avinash, would you recommend either of those to him?
I think Hindustan Copper would be a better choice. Netweb, I think he can continue to hold. No fresh buying suggested.
The next query is for you, Kush. It's on Praj Industries. Sabita from Hyderabad wants to know a target on Praj Industries at this moment.
Very interesting buy, a very strong momentum. Immediate target would be 435, and once that is taken out, I think even 470 plus levels on the cards.
Well, with that, let's slip into a short break and we'll address more of your queries post that.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we
Well, we are joined in by Shrikant Nadella. He's the MD and CEO at KFin Tech, and a strong number coming in, especially a beat coming on the mutual fund yield side. Just wanted to get to understand how the numbers were in this quarter, and of course there was an operational beat coming when it comes to the mutual fund yield also. So your views on that?
Thank you so much, for having me over. As you said, I think we just delivered a very strong quarterly results. Especially in the context of where the world is, where the markets have been. As you know, the nature of the business we are in, we have a very strong and symbiotic relationship with what happens in the stock markets. So in a quarter which had seen a significant downturn in terms of the mark-to-market movements, we showed a 25%, close to 23% thereabouts top line growth, on a quarter year on year. Which basically consolidates to close to about 20% year-on-year growth on the top line. EBITDA margins, have compressed a bit, to close to about 37% for the quarter, but for the full year, it still is about 40.7%. Again, this is largely on account of the acquisition we have completed in the recent past, which is a very fast-growing international administrator based out of Singapore, which adds certain amount of gravitas to the top line, but also has a little bit of drag in terms of the EBITDA percentages. But it continues to be a PAT accretive, business for us. Overall, I think the last quarter had headwinds in the form of mark-to-market coming down, slightly offset because of mutual fund industry continuing to see net inflows. March in fact was a very good month, probably the second best month for SIP inflows post June or July of the previous year. In continuation with the fact that we have other businesses which are some of them are dependent and not so dependent on the markets. We have a fairly diversified story, so we do believe that we have the ability to absorb shocks such as what we have seen in the past 2 quarters. With the market to turn around, we believe that we have a much brighter quarters ahead of us. More specifically, in terms of corporate registry, also a business where we support the secondary market clients. We have about 10,000 plus clientele, close to 52% market share in the Nifty 200 clients. What we have seen is a reasonable exodus of retail investors from the secondary market, which has an impact on overall business to an extent. But again, despite that, we managed to grow about 10 to 11%.
Exactly, the performance we have understood, but right now, also the March quarter has ended. April, we have seen a good recovery also in the markets, though nevertheless, there is a volatility in the markets, and we can't ignore that. But has the mood changed, in the non-retail clients, especially, looking at April, going into May right now? Because primary market clients are also, there's a lot to be done, and a lot of work needs to be done via your company. So is that backlog also going to start coming in as we usher into the new financial year?
Very early days still. I can tell you from a mutual fund standpoint, definitely the trend has improved. We have seen, quarter over quarter, if you just take, April compared to March, there's been an improvement by about 2.5% in the assets under management. Year on year, it marks a pretty significant, 12% plus, growth, which is also very good. In the space of the primary market issuances, it's still very early days. I mean, we haven't seen a significant turnaround. That said, several large IPOs which have been held back, are about to go live. I would expect sometime from mid-May to third week of May, we should start gaining traction in the primary markets. From a secondary market standpoint, again, obviously with the markets turning around, I do expect the retail investors to come back. Initial trends point to mutual funds AUM growing. I think from a primary secondary market standpoint, new issuances to start sometime around second or third week of May. Retail investors will probably take about another 2 to 3 weeks of a lag time unless something materially changes between now and then.
Well, that was the management of K Fintech. Avinash, just a quick view if you have on the stock. How did you see the results? Avinash, I think you're on mute.
Yeah, sorry. Puneet, results have been in line with expectations, but my sense is that, I think for the stock to get re-rated, I think we'll have to see continuation of this performance. I think the kind of acquisition they have made globally, that is also one de facto factor which I think the markets would be observing, that what kind of earnings accretion comes from that, acquisition. But overall, I think, the business seems to be stable. I think, from a medium to long-term perspective, we are constructive here.
The next query is coming in from Rohit Jain from Bangalore, and he has around 150 shares of Sagility bought at a price of 40 rupees. He wants to buy more 1,000 shares and can hold for the next 2 years. Should he do that, Avinash?
Yeah, I think this is a very stable business, Somit. I think what you need is a little more patience and conviction. And I think the company has delivered earlier also in the past. So I think if the investor can give in a couple of years, definitely I think he should expect a decent risk reward.
Got that view, Avinash. The next question now coming in. It's on Confidence Petroleum. Gaurav has actually asked this question. Kush, he's holding shares at 55 and holding 100 shares. What should he do with this counter now?
Yeah, it's been a while since I had a query on this stock, by the way. Fallen quite a bit. Recent rally has bought it to 55 odd levels. I'm assuming this is a recent buy, by the way. Well, you can continue to hold. The rally seems to be just going sideways right now with the volumes dwindling a little. But structure remains intact. I think 50 to 52.5, that's a support zone. If that is broken, then this rally could fizzle out. But for now, you could continue to hold with 50 to 52.5 being your stop loss zone.
Okay, the next is a caller query coming in from Vijayawada. Bindu, you can go ahead and ask a query.
Hello, good morning. I'm holding 500 shares of Genius Power at 310 rupees. So I want to ask this question to Kush, whether should I hold or should I exit? It's a question for medium term. I can hold like about 6 months.
Kush, what would be your view?
So first, Bindu, thank you for directing the query, to me. This is, a stock that we had given out as a call on our advisory. So that just tells you that, yes, I am bullish on, this stock. It did give a good up move. It was resisting around the 300, 305 mark, gave a breakout close above the 200-day moving average. Right now, what you're seeing is perhaps, some profit booking and some excess is being taken off. My view on the stock remains positive. I know it's slightly below your buy price, but a good, strong support zone comes in at 285. So as long as that is maintained, I think you should continue holding on to this one. Higher levels of about 325, 330, and even 350 very much likely on the cards in the coming months' time.
Got that view. The next question coming in now, it's on Indigo, and our viewers, asking what he should do with this counter now, if it's a good time to buy. Avinash, has been volatile ever since the war. They've started certain flights now, but how do you view this stock now, or is it a call you want to take after the quarterly results?
No, I think my sense is it's better to wait for the quarterly result. But typically, in these companies, whenever crude prices shoot up, there is a problem because about a couple of days back, I think on rising ATF prices, most of the airlines had approached the government for some fiscal benefit. So this quarter is not going to be great. In fact, the coming quarter is also going to be a little patchy because I think with crude touching $125 a barrel, this is definitely going to eat into their margins. But if at all somebody wants to take a call post the Q4 numbers, it's better to allocate say 10-15% of your funds as of now, and then wait for the markets to recover, because in the near term the trend definitely looks negative, but longer term the opportunity is very promising.
Got that view, Avinash. But let's take across the next question now. And of course, Interglobe, Avinash mentioned that it's a good prospect in the long term. Watch out for the near-term key factors and commentary. Padma from Bangalore, actually, Kush is asking this question on Eicher Motors and HDFC AMC for a slightly more longer-term nature. But the question directed to you, asking what's a good entry price at this point of time?
Thank you so much for directing the query at me. HDFC AMC not very constructive. So, my view is not very positive. But just because your question is very specific as to you need a good entry point, I would suggest somewhere closer to the 2600, 2550 zone should be a good entry point. It is right now at the upper end of that resistance band. But like I said, I'm not very constructive on this. I prefer Aditya Birla and Nippon Life, in this space in particular. As far as Eicher goes, good pick. Right now it is consolidating. It's had a stupendous move in the last few years. So this consolidation is a welcome one. Since your view is long term, I think you can start accumulating at the current levels also. In fact, if it slides to about 6750, 6800 levels also, that would be a good zone to keep accumulating. Only if 6450 is broken is when you consider, not adding more or perhaps exiting. But I think from 6750 to about 7000, this zone is a good zone to accumulate for long term.
The next query is from Priyanka from Mumbai, and she wants a long-term view on PG Electroplast. Avinash, any view here?
Yeah, I think if the investor can stay invested for the next 12 to 18 months.
Right. The query is on PG Electroplast.
Yeah, I think Swamit, one can definitely hold on if the view is for the next 12 to 18 months. I think very strong business model, so continue to hold.
Got that view here. The next question now, it's on, coming in now on actually from Satya, and it's an interesting one because he's asking on, the shared co-working space. So we put out a brokerage call today initiating coverage by Kotak Securities, and he is holding on to Office at 610 and asking what he should do with this counter now. Avinash, both those counters actually very interesting because I think WeWork slipped down to 440 and then has seen a revival. How do you view either of those counters? Do you have a preference?
No, I think both these companies should do well. The co-work spaces, the area is doing very good. And I think, looking at the trend in office purchasing now, as of now, I think over the next, say, 1 to 2 years, a lot of growth opportunity is going to come in. I think there's a lot of runway to be covered by both these companies. But I think the outlook has to be slightly medium to long term. In the near term, these companies are priced to perfection. Maybe in the near term, the short-term triggers may not be there. But FY27 should be a lot better compared to last year. So we remain positive on both these companies, but with a slightly longer term kind of time frame.
Got it. The next question that's coming in, and it's actually a caller query from Hyderabad, and Murli has a stock query for us. So Murli, very good morning to you. Welcome to Ask Profit. What's your query?
My query is have BHEL shares 100 shares at an average of 110.
Okay.
So I would like to know if I have to hold for next 6 months or should I put profit and exit and enter into Times Techno class.
And Murli, did you buy this from a long-term perspective, or did you buy this looking at the charts? Okay,
from a long-term perspective.
And you're looking
I
to
hold this for almost...
Yeah, Murli, go ahead. How long have you been holding this counter for?
It's almost 10 years now.
Almost a year, okay. Well, Murli, firstly, many congratulations. You've bought it at a very decent price. But Avinash, on BHEL, he's bought it at 100, 110 odd levels. Would you recommend him to exit that, go into Time Techno Plus, or continue holding BHEL at this point of time?
No, I think he should hold on. His quantity is not very large, and I think his entry price has been pretty decent. So I think, looking at the kind of traction which I believe in the order book and the execution, BHEL definitely can scale much higher, right? So I would say that, he can hold for the next 6 to 12 months. Better prospects are likely to happen in the next 12 months.
The next question, that's coming in now, it's on HDFC Bank, and our viewer, Arun from Kerala, is holding shares at 995. Now, Avinash, let me come back to you because, it's yet again slipped that mark of 800, going back to those lows of almost 740 that we saw. I'm sure we would have asked you at that time also about what the counter is, but anything that you look at in this aspect, because you've also now seen results from ICICI, Axis, is it still a preferred pick in that sense?
No, I think, looking at the banking scenario, HDFC Bank has definitely delivered a decent set of numbers. But if you compare it with, let's say, ICICI Bank or an Axis Bank, I would say that, HDFC Bank will take some time to recover. It's not that the bank will not grow, but the pace of growth has slowed down. And my sense is, at least for a couple of quarters, we could see this happening. Maybe post-September, things could, change for the better. But compared to that, ICICI Bank or maybe an Axis Bank in the private sector space looks more interesting and a better choice. So I would not prefer HDFC Bank. Quite frankly, ICICI Bank or Axis Bank would do much better in terms of outperformance.
Kush, do you also agree? Because we're getting so many queries of it's a good entry price as well on the charts. What would be your opinion?
I agree 100% with Avinash's view here. Is that HDFC Bank, if at all you want to consider, is a long-term story. And I know people have heard this tape over and over again, and it's been testing patience like anything. But the view still remains. It's still long-term story, 12 to 18 months out. If you want to, then this, or perhaps even close to the 735, 740 zone, is a good entry price. And I also agree to Avinash's second point, which is if you want to consider from a momentum perspective a quarter or so, I think you should consider ICICI and Axis in that order.
Got it. Well, the next question that's coming in now, it's on it's coming in now on Praj Industries. Our viewer Aparna is holding shares at 571. He's holding 571 shares at 544, asking if she should hold on to this counter. Avinash, what's your opinion? Should she hold on, accumulate more at the lower price?
So I think, looking at the rise in crude oil prices now, ethanol is again getting back into the limelight. And there have been some reports that the government is seriously considering ethanol blending in a significantly big way from the current 21%. So I think, this is going to be a near-term trigger. Plus, Praj has been working on a lot of new technologies like specialized aviation fuel. So, if the investor can wait for the next 12 to 15 months, I think definitely the growth trajectory looks quite promising. The stock had been a very long underperformer for a very long time, but I think now the stock has started moving up. So I think better to average a little bit now and possibly wait for the FY27 results to come out. But if better tailwinds come in the sector for ethanol, definitely it's a good positive, kind of move for Praj.
Got that view, Avinash. But, viewers, before we move on, there's also, we addressed the HUL numbers at the start of the show where we've seen of course, a decent revenue growth from the company, but just in terms of EBITDA, there was a slight correction that I wanted to make in terms of the numbers. So 16,351 is what we put out, which met estimates. EBITDA number at 3841 crores is the number versus estimates of 3754. Now, of course, its met estimates are 3754, but the margins at 23%, 23.5% is the number versus estimates of 23.1. So that is one key aspect that you wanted to watch, and probably one of the reasons why you're seeing the stock taking a slight knock at this point of time. Profits have also come in at a growth of 21%, but that inch up and then that's selling through because the volume numbers, while strong at 6%, we also heard Naveen Kulkarni talk about how important the volume picture is across key metrics, but the number, especially for EBITDA margins, also very important, Sumit.
I believe the numbers are pretty much in line, but the concern on the street would be on the higher crude oil prices because that did not have an impact on Q4. It might have a big impact in Q1 because for the better part of the quarter, now crude has remained above $100, $110, and that could start impacting them because as I guess Parag sir was saying in the morning, that inventories have started to dry down and now they'll have to buy raw material at the higher prices. So yeah, that will come into play, I believe, for HUL.
Well, most certainly, and a lot of clarification now. Not too long ago, 11:30 is of course the press conference for the company, but go across and take the next query as well now. This one's coming in from Akash. Now, Kush, again, the queries are directed to you, but it's the 18 to 24 month time frame. But I'll try to quiz you on Aditya Birla Capital now. He's looking to add this in his portfolio. What would be your opinion?
You guys are being too sweet to me today. It's a long weekend and I'm already starting to enjoy this. Yeah. Absolutely. Did you mention a buy price on this one?
No, he wants to enter the stock now, Aditya Birla Capital.
Okay, so let me start with the broad view. Primarily, the structure is nice. The reason there's this slight hitch is because 355 for the good part of this year, it's been resisting that level, right? So if you have this conviction that there is a possibility that the stock could knock that out and move higher, then you could make a preemptive buy at these levels also, or wait for 355 to be taken out and then buy. The primary structure is solid, very much intact, golden crossover of 20 and the 50-day moving average. So it's got a few things going for it. If you do buy, I would suggest a stop loss at the 325, 330 zone. Like I said, you could preemptively buy right now or wait for 355 to be taken out.
Okay. The next query is coming in, is a caller query coming in from Hyderabad. Ravi, you can go ahead and ask your query.
Yeah, hi, very good morning. I'm holding 78 shares of KSH International.
Okay.
Bought at the time of IPO.
It's KEC International or KSH International?
KSH International.
KSH. Okay.
Yeah.
I guess we are flashing the wrong chart on the ticker. It's KSH International. Yeah, please go ahead, Ravi.
Yeah, just want to know, shall I hold or shall I sell?
And can you hold for long term?
Yeah, I can hold for next 8 months to 1 year.
Okay. Avinash, any view on this newly listed counter KSH International?
No, I think he should continue to hold. See, they are a very large player of wires and processed value-added kind of products. So I think the numbers have been very solid. It's a large player in this space, and most importantly, I believe FY27 should be significantly better. So the investor can expect a much better decent risk reward over the next say 12 to 15 months. If he's got it in the public issue, then I think my suggestion is continue to hold.
Got your view, Avinash, but Nihal Mohandas from Mumbai is asking the next question on Nestle, and of course he wants to know, he's bought it at 1150, but asking what's a good price to sell at this point of time.
Interesting question. I would suggest a hold approach on this one and sell with a trailing stop loss near 1395. Now the reason I say that is because this has, after its results came out, had a stellar move. It is showing momentum. Yes, of course, it's seeing some profit booking today, but other than that, it's showing good momentum. So if it does move higher from here, you want to ride this wave, right? So my suggestion would be to hold this with a trailing stop loss at 1395. If that is broken, you sell. Otherwise, if it inches higher, why not enjoy those extra profits?
Right. The next query is coming in on HEG and the viewer is holding Udit Guru. Udit Guru from Mumbai is the viewer and he's holding around 60 shares, bought at a price of 528. He wants to know whether should he continue to hold this counter or exit. Avinash, any view here?
I think he can continue to hold despite the fact that, the fourth quarter, Somit has not been great. The company incurred a loss here. But I think looking at the traction in the global graphite electrode space and the fact that, some demerger also is going to happen, I believe that possibly if the investor can hold on for the next 12 to 15 months, he should continue to hold because he's gotten at a fairly attractive level. And I expect that, the numbers for FY27 should be significantly better. Plus whatever demerger benefits, also kick in.
Got that view of Avinash. The next question coming in now It's on JSW Infra. Now, our viewer, Ram from Hyderabad is holding shares at 250. He's holding 8,000 of them. So certainly sitting in some gains at this point of time. He's asking what can he expect from the stock, Avinash, in Q4. That might be a little tougher to answer now, but down the line, what's a longer term play? I think, Avinash, more capex and targets for 2030 is what the company has given. Are you positive on the stock?
Yeah, I think, if the investor can continue to hold for the next 12 to 18 months, JSW Infra is definitely a very promising opportunity. But I think, to give a target price would be difficult. But my sense is, yes, we are structurally positive on the company, on its growth prospects. But I think you need to stay invested here for the longer term.
Right, the next query is for you, Kush. It's from Sundar. He is holding few shares of NCC, bought at a price of 220. The stock is down nearly 30%. He wants to know whether should he continue to hold or exit.
Thank you, Sundar. It's just that, it pains me to see the kind of loss that you're making right now. And honestly, the view is not very constructive on NCC. It has been seeing selling pressure, not from now. It's, that's been the case since mid of 2024. Every rise has been taken as an opportunity to sell or exit. My suggestion would be look at opportunities of exiting this at current and maybe slightly higher levels of about 175, 180. And then close to those 195 levels. You might not want to wait for your buy price. So like I said, exit at every rise. I would suggest a stop loss near the 148 mark.
Got that view, Kush. The next one coming on Aegis Logistics, and Kirtana is holding shares at 719, holding 1600 shares. Now, Avinash, this counter has been a rank underperformer in that sense. The last 5 year, absolutely no returns. It's actually down 10% in 5 years. Would you recommend her to sell out, probably look at some other counter at this point of time?
I think clearly, the underperformance is quite visible. So I think, Puneet, clearly, I think, we could look at maybe some of the banking counters. I think, I've been positive on the private sector banks, but if at all, the investor is keen to put money on the PSU bank side, I think something like an SBI or maybe a Canara Bank or maybe a Bank of Baroda, these could be better bets, compared to Aegis Logistics. So I think, the investor could possibly hope to get a much better return in the next 12 to 15 months if he shifts into these banking names.
Got that view, Avinash. But the viewers as well as Avinash and Kush, now time for the second round of the rapid fire round. You know the rules. The first question coming in from Dilip. It's on Kirloskar Pneumatic at 1250. Can you hold on for the long term, Avinash?
Yeah, continue to hold.
Mahesh from Hyderabad is holding few shares of Coal India at a price of 461. Target on this one, Kush?
I think you can continue to hold on for targets of 495 and about 520.
Amit Banerjee is holding on to Reddington at 230, Kush, and he's asking what he should do with his 500 shares.
Yeah, you should keep a very strict stop loss at the 200 mark.
The next query is for you, Avinash. It's from Balaji. It's on BPCL. He's holding a few shares at a price of 367.75. Should he continue to hold or exit?
I think continue to hold. I think near term, I think you should hold on.
Suman from Kolkata is holding on to PFC at 474. Avinash asking if he should switch out of that to Aadhar Housing or PNB Housing Finance.
I think PNB Housing would be a better choice.
The next query is for you, Kush. It's on Cochin Shipyard. It's from Sudipto from Mumbai. He's holding 100 shares of Cochin Shipyard. For the next 2 months, should he continue to hold?
Yes, you should continue to hold. Very optimistic targets of about 1875. Once that is taken out, 2100 also. And you should keep a stop loss near the 1600, 1575 zone.
Our viewer is holding PPL Pharma at 90. Avinash's question being, should he continue to hold or switch out to Loris? Results also today. What's your view?
I think he could switch over to Loris, but keep a time frame of say 12-15 months. Yeah.
The next query is for you, Avinash. It's on GMR Airports and GMR Power. Sai Kiran wants to know whether should he hold both these counters for long term.
Yeah, I think both these companies qualify as a good long-term choice.
Camlin Phi Sciences bought at 156, and this one is from Sukhbir. He's asking if he should continue to hold on or exit this counter, Kush.
Exit.
The next query is for you, Kush. It's from Sneha. She wants to know whether is it a good time to exit or continue to hold shares of HCC. She has bought few shares at a price of 37 rupees.
I think you can continue to hold, but I would suggest 19.5 as a stop loss, but exit at rise, don't wait for a buy price.
We spoke about Confidence Petro, but Kush, also on Chennai Petro, Sachin from Uttarakhand is asking this question, if he should continue to hold on or switch out and get into Vari Energies.
That's a good choice, by the way. On declines, Wari becomes a good buy, but right now you can continue holding on to Chennai Petro. Trailing stop loss on this one, 1065.
The next query is for you, Avinash. It's on Ashok Leland. Srinivas from Hyderabad wants to know whether should he buy Ashok Leland for long term.
Yeah, I think he can definitely buy it. Keep a time frame of 12 to 15 months.
Rani from Tirupur is actually holding on to Indian Bank Kush at 962, asking a 3-month view.
On Indian Bank, is it? Yeah, well, you can continue to hold. It's consolidating. Stop loss near the 785, 790 zone.
The next query is for you, Kush. It's on IKS. Raidu from Hyderabad is holding 1,550 shares at a price of 400. Should he continue to hold? Any targets here?
He perhaps already knows my answer and has heard my view. Yes, you should continue holding on to this.
Vinati Organics, Raghav Joshi from Hyderabad wants to buy into it. Avinash, would you recommend that?
Again, from a longer term perspective, one can buy into SIP mode. Definitely long-term prospects appear to be good.
The next query is for you, Kush. It's on HFCL. Shiva from Bangalore is holding 425 shares at a price of 103. Should he continue to hold this counter?
Okay, this is good momentum but overheated. I would suggest partial profit book and then a trailing stop loss at the buy price.
The next question is coming in, from Vikram from Bangalore. He is asking a question now for the long term, Avinash, between Shriram Finance and Jio Finance. What's a better pick?
I think Shriram Finance.
Got it. Well, that is, curtains on this edition of the Rapid Fire as well as Ask Profit. Avinash as well as Kush, thanks so much for helping us solve 52 queries that we have in the last 1 hour. But viewers, that's all the time on this edition of the show. For the second leg, we'll see you at 2 p.m. for the afternoon edition. Thanks so much for watching.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show.
Hi, you're watching Earnings Edge and we're laser focused on HUL results. In fact, the press conference has just begun. Let's listen in to what the management has to say.
Revenue growth this quarter. This was supported by a 7% underlying sales growth, primarily driven by volumes. Performance was broad-based across all categories, as you would have seen. This marks our highest growth in the last 12 quarters and reflects both the ongoing portfolio transformation and stronger, more consistent execution on ground. Our EBITDA grew 6% year-on-year, and our EBITDA margin was at 23.7%, which was at the higher end of our guidance. Our profit after tax, before exceptional item, grew 4% year-on-year. Moving on to the segment performance for the quarter, Home Care delivered 9% USG, driven by high single-digit UVG, marking its strongest performance in the last 11 quarters. The growth was broad-based, and market shares continue to strengthen in Home Care. In this quarter, Surf Excel partnered with 2 IPL franchises to further drive visibility and consumer engagement. Moving on to Beauty and Wellbeing, this segment delivered 8% USG, driven by mid-single-digit UVG. Within this, Hair Care recorded strong double-digit growth and continued to strengthen its market leadership. In Skin Care and Color Cosmetics, the premium segment continued its strong growth trajectory, driven by market development actions. This was offset a little bit by soft performance in mass skin care. We continue to build our Masstige portfolio, with Minimalist delivering strong double-digit growth and Simple scaling to an annual revenue run rate of more than 160 crores. Health and Wellbeing, though soft during the quarter, delivered strong double-digit growth on a full-year basis. Let me talk about Personal Care. Personal Care delivered 5% underlying sales growth during the quarter. Within this, Skin Cleansing posted high single-digit growth, the highest in 12 quarters. Premium skin cleansing, including body wash, delivered double-digit, volume-led growth and gained robust market share. Oral Care recorded low single-digit growth for the quarter, with Close-Up delivering competitive results. Coming to Foods, the segment delivered 5% USG, driven by lifestyle nutrition and coffee. In beverages, tea posted low single-digit UVG, while coffee continued strong double-digit growth, supported by both volume and price. Lifestyle nutrition delivered double-digit growth during the quarter, driven by both Horlicks and Boost. Our actions of relaunching Horlicks and expanding into new demand spaces are delivering early positive outcomes. We also launched Horlicks ready-to-drink format protein in select online stores in the quarter. You will hear more about that in the forward quarters. Packaged foods reported mid-single-digit growth, driven by Unilever Food Solution ketchups and mayonnaise. Kisan's expansion into chutneys is seeing encouraging early traction. Overall, for the financial year 2026, we delivered a turnover of 63,763 crores with 5% USG, driven by 4% UVG. The EBITDA margin for the full year was at 23.6%, remains at the higher end of the guidance, and absolute EBITDA grew 2% year-on-year, and our profit after tax before exceptional item stood at 10,324 crores. The board has recommended a final dividend of rupees 22 per share, subject to approval of shareholders at the AGM, taking the total dividend to rupees 41 per share. This translates to a total payout of 9,633 crores. Importantly, our growth trajectory strengthened throughout the year. We exited March quarter with 7% USG, accelerating against a 2% USG you saw in fiscal year 25. Over the last few quarters, we have taken a series of decisive actions to unlock this growth momentum that you see now. First, we crafted key priorities to drive volume-led growth. Secondly, we stepped up our omni-channel capabilities with the setup of a dedicated quick commerce organization while continuing to strengthen execution in general and modern trade. Thirdly, we are sharply allocating resources behind fewer and bigger bets, including the recent commitment of around 2,000 crores in capex towards premium format, which will get deployed over the course of next 2 years. Fourth, we have been more active in sharpening our portfolio through actions such as ice cream demerger, 100% acquisition of Oziva, and scaling up of Minimalist. And we've also reorganized the company under a unified India organization to bring agility in execution and speed in decision making. We are seeing encouraging results through these actions and are committed to stay the course. Our strong balance sheet remains our key strategic advantage. For financial year 2026, we've ended with the reserves of close to 49,000 crores and a cash flow from operations close to 10,500 crores, providing the flexibility to navigate volatility and invest in growth. Both return on capital employed as well as ROE improved 270 bips and 110 bips year on year respectively. Together, these metrics reinforce the robustness of our financial model. Before closing, as I said, let me briefly turn to the current external environment. The Middle East crisis has disrupted the global crude oil supplies, as we know, driving inflation in crude and crude-linked commodities. We've responded with strong operational discipline, leveraging our supply network to secure supplies, stepping up savings, calibrating media spends, and taking judicious pricing actions, all while maintaining an attractive price-to-value equation for consumers. In response to elevated crude-linked commodity inflation, we are taking calibrated price increase, as I said, across the portfolio in the range of around 2 to 5%, which may result in some short-term balancing between volume and price growth, although the categories in which we operate are less elastic. In terms of coming to the outlook, we recognize that the geopolitical tensions can create some short-term disruptions. However, our strong and resilient financial model, operational agility, and our ability with our local global supply chain, and our ability to navigate the P&L across the lines, and supported by our robust brands and portfolio, we are maintaining our guidance of FY27 to be better than FY26. We expect margins to be around our guided range, the midterm outlook which we had said, which is 22.5 to 23.5%. And while navigating this, the volume-led growth will remain our number one priority. With this, I conclude our prepared remarks and will now take questions.
Right. Thanks a lot for the opportunity. The fourth quarter, we saw a noticeable uptick across the consumer sentiment. So my question is a two-part question. One is on the demand environment. Has there been a noticeable shift in the demand environment for consumer companies to report better than expected numbers? Is this a one-off because of GST or is this structural in nature? That's part one. And the second part is on the operating environment. You do say that 22.5 to 23.5 is what your margin band will be. But as we speak, crude is at 124, 125. Raw material prices have only increased, and a lot of the companies have exhausted some of their low-priced inventory as well. Is there a risk in the next couple of quarters it may go below your guided band, even though for the year it stands?
So as far as demand outlook is concerned, we have seen uptick in demand. Okay. And that's been a continuous feature that we have seen over the last couple of quarters. We wouldn't say it's aided immediately by GST because GST has impact in FMCG categories over a longer period of time. So this should be a structural movement uptick in the demand as we see. When we come to the pricing and the guidance, we need to remember that one, we've already seen an inflation. We are seeing, let's say in June quarter, close to around 8 to 10% of our cost base. We are able to navigate through balancing between partly pricing, partly accelerating our savings program, equally calibrating our media spends and efficiency. We operate with a large, significant amount of media spends that we can optimize. And Of course, as we go through with our portfolio and the pricing power that we have, we are confident of continuing to maintain the guided range of margin.
So just to follow up on that, because your media spends are likely to be, calibrated, that's not necessarily great news for media channels like ours, but you have a guided band on the kind of spends that you want to do as a proportion of sales on advertisements. And when you say FY27 is likely to be better than FY26, if you could say by what degree?
So as far as we don't give a number guidance, so we'll continue to say that FY27 better than FY26. I think it's important to recognize that this guidance reiteration comes despite the Middle East crisis. Because earlier our guidance was pre-Middle East crisis, and we have seen uptick in our December quarter and March quarter numbers, actual numbers, and we're still maintaining the guidance. So there is that confidence that we have backed up by our portfolio, that we have our pricing power, the demand uptick that we see as a combination. So therefore, that's the confidence that guiding our numbers moving forward.
And maybe I'll just add one thing to what Niranjan said. I think, we are in uncertain times. We are in uncertain and volatile times. But we remain confident for three reasons. One is the strength of our financial position, the operating agility we have as a large organization, our supply chain procurement strength that we have as a large company, and mostly because we have brands which we straddle the pyramid, right, from mass to premium, and really ensuring that we rotate our portfolio to where consumers go. So we remain confident on our ability to be able to do that, while continuing to drive savings across the portfolio, including on product savings, media savings, but really that's business as usual. I think what's important to remember is, we are best placed to really ensure that we navigate this short-term volatility, but remain focused on our long-term growth potential and really ensuring that we leverage that. So that's really how we will look at it.
Okay, so hi Priya and Niranjan, morning. I want to understand, first of all, at the parent level, the food business demerger has been announced. Now I understand there's been a clarification from HUL saying that we don't have any plans like that. Is that maintained? No plans for the food business demerger?
So I think it's important firstly to remember, understand what is HUL's foods business. Mm-hmm. Our foods business in HUL is firstly a beverage business, tea and coffee. The second is it's a lifestyle nutrition business with Horlicks and Boost. In foods, Kisan is our largest brand, a big local jewel, culturally super strong in the country. And if you look at packaged foods in India, the per capita opportunity in packaged foods is huge. So we continue in HUL to remain focused, and we've clarified that HUL Foods is outside the perimeter of the transaction that was announced.
Understood. And also, in your remarks, you did mention 2,000 crore rupees investment to advance your premium categories. Could you help me understand what portfolios are you targeting, what some of these products could be?
Yeah, so these will primarily be, let's say, the liquids portfolio, and the liquids portfolio across home care, beauty, and personal care. So you could take, for instance, the body wash, you can take the liquid shampoo format in the detergents, the shampoos. So all of those is where the premium formats that we're talking about is where the capital expenditure will be. So it's again in the same spirit of focusing on fewer, bigger bets, and therefore participating more and more on high growth spaces, high premium formats as we move forward.
This is in line with your previous quarter commentary of fewer, bigger bets.
Absolutely.
Asking you that.
Absolutely. So the capital allocation continues to be in line with the stated strategy we talked about.
Hi, good morning, Priya. Hi, Niranjan. First of all, congratulations on good set of numbers. My question is on volumes, because this time it's a 15-quarter high number that you've seen, right? Considering that you've said that you will be taking, calibrated price hikes, that could impact volume going forward. But at the same time, you've also said that, volume growth is our top priority. So going forward in FY27, I know you will not talk numbers, but any range in which you will be seeing volume growth coming forward?
So firstly, we won't offer a short-term guidance, right?
Yeah.
But let me get into firstly, what's the step up we are seeing?
Yeah.
I think the first thing is, what are we working on? The first is fewer, bigger bets. We've talked about this before. We will continue to focus on scaling up a few priorities so our resource allocation is becoming sharp. So that's the first thing. The second is working on our brands, modernizing them, premiumizing them, both in terms of communication, but also in the segments in which our brands play. creating higher exposure to the higher growth segments is what we're working on across all our brands. Remember, HUL, we have 20 large brands and 55 total brands. So across our brands, really systematically ensuring that our brands we step up. The third is in terms of building the capability of our channels, really doubling down behind execution, because it's much more an omni-channel market India than ever before.
Right.
So whether it is QCOM, e-commerce at the top, or actually we are now investing also in general trade. So we're actually investing in building our footprint in chemist channels and open format general trade stores, and we have created a new specialized force to go to market in these channels. That combined with, continuing to drive our leverage, our operating leverage, is what sets us up for the next year.
Got it. The other aspect is on demand. We've seen FMCG companies post very good set of numbers this quarter, and this is largely on account of, as Mangalam was mentioning earlier as well, that the GST pushes come in. But from my understanding, if I'm not wrong, urban demand has also picked up as compared to where it was 2 quarters ago, right? But the other aspect is that the harsh summers are going to take over this year, and that could impact rural demand. So how are you seeing that play?
So as far as seasons is concerned, the good thing is that our portfolio in HUL straddle across not just price pyramid, which you say. I think I would say straddles across the seasons as well. So you have a winter season portfolio, you have a summer season portfolio as well.
Yeah.
So when you talk about skin cleansing, you talk about detergents, you talk about sun screen, so cream. So across this thing, right? RTD, which we have recently launched. So you have portfolio that benefits from summer as well. So I would say it balances out to an extent in terms of season, not a big impact given the wide portfolio that we have as far as summer is concerned. Consumption demand doesn't actually go down. I would say if you have a wider portfolio, it actually sometimes could act in your benefit.
Okay, so on that note, I just wanted to take a follow-up. Given that you have such a big portfolio and everything has done well in Q4, but we continue to see a little bit of weakness when it comes to volumes for the personal care segment. Any outlook on, any outlook on the improvement over there?
So as far as personal care segment is concerned, if you look at it, that there was, because of the inflation, a lot of price increases that we had to take earlier. And that reflected in the volume growth, not just for us, but across the categories. But within that, if you see, the way we have been reshaping our portfolio is more and more towards the premium end. So if you look at within the personal care itself, if you look at brands like Dove, brands like Lux, they've been growing at double digit. So actually the portfolio is getting shaped more and more towards the premium end, which is what growing at double digit.
Right. Beauty and wellness, that's been one of the bigger bets of HUL going forward. The street this time around again was expecting a double-digit growth coming in largely because of the focus that the company has shown. A large part of your portfolio there has done double digits, but there is still some weakness in the mass brands that you spoke about. How long before that portfolio goes into double digits? And the price volume equation going forward in FY27, you've already taken a 2 to 5% price hike, so that comes in. How should we look at the price volume equation next year going forward? Because the last couple of years, we didn't have much.
Yeah, I think I'll answer first on, our portfolio on skincare. I think when you look at our skincare portfolio, I think firstly remember that at this moment of time, we don't have minimalist as a part. It's a part of revenue, but not a part of our USG, because it's not. We actually anniversary the base as we come into the quarter. So we will actually, if you look at the total beauty business underlying, we will be close to double-digit growth. So that's one of the ways for you to think about it. The second is we are continuously focusing on the premium end of the market. So because that is really how the beauty market is shaping, right? If you look at the shape of the beauty market, we now for quarter on quarter have double-digit growth on these premium segments, including minimalist, including simple, and including Oziva. We now have close to a 1,400 crore ARR business, to give you a sense of the size of those businesses. So that's really our focus in beauty. We continue to see challenging results on segments like talcum powder for the quarter, where we have to see going into the season this quarter, how that does. But overall, those markets are softer in comparison to the premium markets.
Right. And on the price volume equation?
Yeah, so as far as price value equation is concerned, price volume equation is concerned, as I mentioned, there is some balancing between a price and the volume, not to a large extent. And simply given that elasticities of our type of categories is very low, because essentials and consuming categories will be the last one to be cut from a consumer point of view. And that also happens if nationally the inflation level starts rocketing to, let's say, double digits. We are talking about India country inflation still at around 4%. Probably it may go to 5 or 6%, which the economy at a growth of even 6.5 can absorb.
I mean, think of the categories in which we play. You're going to wash your clothes, you're going to take a bath, you're going to shampoo your hair, you're going to have your cup of tea. So essentially, given that we're talking about staples and everyday essential categories, unless, like Niranjan was saying, inflation gets to levels in the country, and that's not the outlook that we see at this point, it will be more challenging than it has been, but we still are in everyday staples, and that's the way to think about it.
I'm just back calculating because your volumes have slightly higher than mid-single digit, 6% right now. You have a 2 to 4% price hike that you've taken already. Assuming that 1 or 2% volume slips because of the price hike that you've taken, one should not, worry about revenue growth being any less than 8% in the very near future.
Yes,
right?
what we've guided, so I don't want to get into quarterly guidance, right? What we've guided for very clearly is full year 27 will be better than full year 26. And we keep focusing on driving, the competitiveness of our portfolio. I think what's very important in these uncertain, volatile times is to ensure that we stay focused on consumers, we stay focused on being competitive in the market, and we really leverage both our financial position as a large company, the operating leverage that we have as a large company, and continue to stay focused on building the FMCG categories.
एक मेरा सवाल है हिंदी में सो अभी प्राइस हाइक देखने को मिली है जो डेली यूज आइटम्स हैं साथ ही इसके जो वजन है वेट जो है वो भी उसमें कम हुए हैं तो ऐसे में किस तरीके से जो मार्जिन प्रेशर है उसको कैसे आप लोग टैकल कर रहे हैं और इसके पीछे की वजह क्या है
तो ये जो फिल लेवल्स और पुट डाउन प्राइस है ये दोनों कॉम्बिनेशन यूज करते हैं हम एफएमसीजी में अक्रॉस द कंपनीज और ये हमारा एक तरह से स्टैंडर्ड ऑपरेटिंग तरीका है डिपेंडिंग ऑन कंज्यूमर टू कंज्यूमर डिपेंडिंग ऑन प्राइस वैल्यू इक्वेशन कैसा है उसके हिसाब से हम फिल लेवल या फिर पुट डाउन प्राइस को करते हैं अलग अलग सेगमेंट्स में जहां तक मार्जिन का सवाल है जैसा कि हमने पहले भी बताया कि जो कॉस्ट प्रेशर है उसको हम बहुत ही जुडिशियस तरीके से बैलेंस कर रहे हैं ताकि कंज्यूमर पे भी सारा का सारा इम्पैक्ट डायरेक्ट नहीं आए जैसे हमने 10% प्राइस इन्फ्लेशन के जगह हमने 2 से 5% की प्राइस इंक्रीज ली है और बाकी जो है हम ऑप्टिमाइज कर रहे हैं अलग अलग लाइंस जो हमारे पीएनएल में है चाहे वो मीडिया हो चाहे वो हमारा ओवरहेड एक्सपेंडिचर हो चाहे वो हमारा सेविंग्स प्रोग्राम हो जो बाद में आने वाले थे उनको हम एक्सेलरेट कर रहे हैं ताकि पहले सेविंग्स प्रोग्राम आ जाए हमारा जो ऑपरेटिंग मॉडल है क्योंकि हमारी स्केल इतनी है और ग्लोबल स्केल है तो इसके कारण हमें ये फायदा मिलता है कि हम पूरा का पूरा उसको लेवरेज कर पाएं और ओवरऑल एक बैलेंस क्रिएट कर पाएं प्राइस वैल्यू इक्वेशन का सो दैट प्राइस और वॉल्यूम के बीच में इक्वेशन में बने
इसी का एक फॉलोअप है जो वेट कम हुए हैं जो भी डेली यूज आइटम्स हैं तो क्या ये इस तरीके से बाद में फिर से वेट बढ़ाते हैं या फिर अभी वो कम ही रहने वाले हैं
नहीं ये डिपेंड करता है जैसे जैसे इन्फ्लेशन के साथ साथ मूवमेंट होता है तो हम ये कॉल लेते हैं कि प्राइस बढ़ाना है या उसमें क्वांटिटी को एडजस्ट करना है तो ये एडजस्टमेंट एक डायनामिक नेविगेशन का पार्ट होता है इन्फ्लेशन के साथ साथ और हमारी टीम जो है वो जैसा हमने बताया कि डिसीजन मेकिंग एग्जीक्यूशन डिसिप्लिन जो हमने शुरू में बताया ये सब क्राइसिस के टाइम पर स्पीड सबसे ज्यादा इंपॉर्टेंट होता है और हम हर चीज काफी स्पीड से कर रहे हैं डिसीजन ऑन ग्राउंड एग्जीक्यूशन एंड ऊपर से ऐसे हमने बताया कि हमारा फाइनेंशियल स्ट्रेंथ जो है वो हम लेवरेज कर रहे हैं एंड इनफैक्ट पूरे अभी तक पूरी क्राइसिस में हमारे प्रोडक्शन में हमारे सप्लाई में हमने कहीं भी डिसरप्शन नहीं होने दिया है अभी तक
You mentioned that you are growing your general trade, but just want to understand from a quick commerce and e-commerce point of view because all of these channels are in a very high competitive environment, right? They are pushing huge in terms of discounting. So how are you maintaining that versus the profitability that you've shown this quarter?
So I mentioned this last quarter, but we have actually set up a completely now separate team, an integrated team to look into quick commerce and e-commerce. And this is really helping us ensure that we build the right capabilities which is right for this channel, as different from the capabilities that you require to navigate general trade. And that's the reason we're getting those, getting the right growth, but it's also the right shape of growth, ensuring that we drive the right portfolio, the right, availability. It's very different in quick commerce, very different what's required in a modern trade environment, and very different what a general trade shopkeeper looks for, and how we go to market. So really segmenting and building those segmented capabilities is what we're focusing on.
If I could squeeze in a quick question. HUL has always been on top of things in terms of identifying trends. You've gone all out on quick commerce. Nutraceuticals, supplements is also something that you have big participation in now. What's next in terms of trends? What are you spotting at the moment?
We've called out many of them, right? We see, I'll give you an example. We can take it category by category. We've called these out. So, for example, if you take home care, where, we are large, we are by far the leaders of home care. Our critical focus in home care is, in the end, firstly, the per capita consumption of home care in India is still, 1/3 of what it is in neighboring countries. So huge headroom for home care. And how will it grow? Because it's 99%, 100% penetration of some home care product. It happens through format upgradation, which gives consumers better benefits for better products. And the big trend we're seeing in home care is really liquids entering. And the liquids consumption and the liquids per ml cost is significantly higher and more premium compared to powders and bars. And therefore, in that manner, you see a growth in consumption. And there are two vectors which make a big difference in a category like that. Let's take laundry, for example. It's when people start using washing machines, they change their behavior in how they consume. So really driving those trends as a leader of the category, that's our key focus, is developing the market. So if you say, what's HUL's number one priority as the leader of the categories in which we are, is really developing the market. So that's our critical focus and how you should think about it for every category in which we operate.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore. This is all about connected ecosystems, EVs and AI that you can use in your daily life. That's what we do on Tech 360. Real talk, real reviews, tech that you can actually use.
Tech has changed. So should your tech show.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company, weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced of the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit.
Benchmarks are under pressure with Nifty trading well below 24,000. Sensex also gave up more than 1,000 points. PSU banks and autos are the top sectoral losers, with all the major sectors trading in the red. Oil is on the boil. Brent crude has surged past $120 a barrel after reports that President Donald Trump is set to review fresh military options against Iran, reviving the escalation fears and pushing crude to a wartime high. HUL has delivered a steady set of numbers, beating the street expectations across key matrices. Net profit, revenue and EBITDA all came in ahead of the estimates, while margins held firm at 23.5%, reflecting steady execution despite a volatile cost environment. Waaree Energies remains in focus as the street punishes the stock after its Q4 earnings. Margins were under pressure despite the rise in production and strong revenue growth. Bajaj Auto shares move higher after the company announced its board will consider a share buyback on May 6th. The prospect of a capital return cheers the investors there. Hello and welcome. You tuned into Markets at 12. I'm Nisha Poddar, and yes, it's a weekday in trade today, but let's get you first an NDTV Profit exclusive. Well, sources tell us that amid the looming Mythos AI threat that the banking sector is faced with, the IBA has started meetings with the bankers. Let's take it across to Piyush to understand what are the measures and what is the discussion like. Tell us, Piyush.
Absolutely, Nisha. The IBA has started engaging with Indian banks on to assess the threats which are linked to Anthropic's new AI model, Mythos. We understand from our sources that IBA officials met with bankers on April 29 yesterday to discuss whether they should appoint external global leading software IT firms such as Microsoft or IBM. We understand that the Indian Finance Ministry is not content with our Indian banks having direct access to Mythos. It is in this context that appointing a third-party agency to prepare for the risk posed by Mythos becomes essential. We are aware that last week, responding to NDTV Profit's question, Union Finance Minister Nirmala Sitharaman had said that the IBA has been tasked with dealing with the preparing banks for the potential challenges arising out of Mythos. CS Sethi, the chairman of SBI, also the chairman of IBA, is leading this committee which is dealing with Mythos. We do understand that the RBI has also engaged with global regulators to figure out what can be done to prevent risk. What is Mythos, Nisha? It is essentially AI model which can spot vulnerabilities in leading operating softwares globally. It has been able to find a bug as old as 27 years old in recent past. So Mythos bankers are worrying that they will not be able to plug in the vulnerabilities in their IT system which Mythos spots on a real time. That is the concern which bankers and global policymakers and regulators are having, and discussions are on to put in some countermeasures for this particular AI model. Back to you, Nisha.
All right, thanks so much, Piyush. Keeping a close watch on what the impact of Mythos scare is going to be on the banking sector. Let's take it to the markets. And yes, it's Nifty 50, which is down about 1.4% in trade. And there is no let up in sight for Nifty 50 and for the overall market. So take a look at almost all the sectors in the red. It's the auto space, which is really putting the most amount of pressure along with the PSU banks as well. Now, bank index, that is also underperforming the key index by a slight margin, and is really coming in as a dampener. The only sector which is showing a tinge of green is the IT sector, which has already been beaten down a lot during the earnings that were really announced by the top IT companies. But apart from that, take a look at the advanced decline ratio, and that's not a pretty picture. It's 3:9, only 3 advancing stocks to the 9 declining. The trend is heavily pressured at the moment, and the weakness is really showing. When we look at the components of Nifty 50 and the top companies and how they are really performing, it's only the earnings-led momentum and some bit of IT recovery that is really playing out in terms of it adding some contribution on the green side. So Bajaj Finance, after its strong numbers, are getting rewarded, and that is adding about 9 odd points to Nifty 50. Apart from that, Infosys, Bajaj Auto, Tech Mahindra are some of the others, but largely it is a down day of trade. And yes, 2 concerns really weighing heavy on the markets today. First is, of course, the concern of rupee touching a new low below the 95 rupees mark against the dollar. And on the other hand, it's the crude worries, which is at a very elevated level. So that's the picture of the market. Let's take it straight across to an expert to understand how to really play this market. Mayuresh Joshi, who's the Head of Research, Market Smith India, joins in. Mayuresh, always a pleasure to welcome you on NDTV Profit. Your first reactions to the kind of concern we are seeing in the market, a lot of it really led by the Middle Eastern crisis and its impact.
Absolutely, Nisha. No, absolutely. I think with crude prices, which is showing an upward elevated move, along with the depreciation that you've probably seen in the rupee, I think that is a cause of concern, not just for India, but for most emerging and global economies as well. And therefore, I think a resolution is something that the world is probably paying heed to at this juncture. Looking at Trump's tweets, I think it does not seem to be that way. And therefore, I think the markets have become jittery, because if prices remain elevated at these levels, obviously, I think there is an impact both from a macro fiscal perspective, which will then start seeping in terms of second order effects, ultimately hitting corporate earnings and retail pockets as well. So I think that is where the concern is emanating from.
Right. You mentioned that in 2 areas it will be impacted. One is the retail side. So probably consumption is going to get impacted, even though Hindustan Unilever and some of the other results show good momentum so far. What are you picking up in terms of the inflation that will be caused by crude and other supply chain constraints, which could really impact this particular space?
Tanisha, I think the first order effects will be obvious if this elongates and continues. Obviously, I think with crude and crude derivative prices remaining higher, for FMCG companies, I think packaging costs definitely go higher. At the same time, logistic and freight costs also start moving higher. Now, we all know it's a demand-supply dynamic scenario as far as FMCG companies are concerned. And with the cost increases coming through, how much will they pass that through on an immediate basis, and how much of an impact does that have on demand is something to be watched out for. The other worrying factor is that the expectations are that monsoons might be below par this time round. And if they stay, or the analysis and the forecasts turn out to be actually true over the next few months, in terms of monsoons below the LPA forecast, what really happens in terms of demand dynamics, specifically in tier 2, tier 3 cities, is something that one really needs to comprehend at this juncture. And therefore, I think Q4 numbers more or less in line with estimates, better in some cases as well. But as we head into the first half of the next fiscal year, I think these are a few challenges that FMCG companies might actually be seeing as posing problems.
So this particular quarter didn't see much of an impact, Mayuresh, of the concerns really seeping in into the inflation as well as raw material concerns. But for the next quarter, and also considering that monsoons will be below the normal levels as has been anticipated and announced, putting both these together, how do you estimate the trajectory of the market and how much downward trajectory could be baked in going forward?
No, so to a large extent, I think if these perspectives play out, Nisha, I think the expectation in terms of what we began at the beginning of the calendar year in terms of a 14-15% consensus earnings growth, that obviously starts heading lower. And then the base case scenario starts getting built in for a 10 to 12% earnings growth. With the kind of moves that we've probably seen in terms of the overall headline number as far as the market is concerned over the past few weeks, I think a large part of the gestation has already happened in terms of some respite happening as far as the Middle Eastern crisis is concerned, and some element of resolution expected to come through. However, if it elongates and if earnings probably take a downward trajectory at 10-12%, I think certain sectors might get hit more, which are probably dependent a lot more in terms of supply chains, crude derivatives. And therefore, one really needs to understand the perspective that if earnings are headed downwards, the forward multiples for the market will also probably head downwards on an FY27 exit. So I think a large part of the moves have probably happened for the headline number as we speak. But here onwards, I think it will be more sector and stock specific moves that I probably foresee.
All right, more sector and stock specific moves when it comes to the impact of the global uncertainty and the supply pressures. Thank you so much, Mayuresh. Always a pleasure speaking to you. Thank you. All right, that was about the market and the immediate concerns that are really playing out on the market and the pressure points. We'll talk more about the market, the rupee concerns and the news developments of the day right after this short break. Don't go anywhere.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Presenting the all-knowing, all-powerful Tech Guru.
Whoa. Guru? I'm no guru.
Okay.
I'm just a guy who loves his tech.
A show where the mysteries of megabytes and motherboards shall be unraveled.
Bro, nobody talks like that anymore.
Welcome back. You're watching Markets at 12 and let's put our focus on rupee, which has touched a new record low today, and the concerns are really mounting about that, and also various economic concerns are also the pressure points because of which probably rupee is really at depreciating levels. Now let's welcome Sakshi Gupta, who is the principal economist at HDFC Bank, joining in. Sakshi, pleasure speaking to you. First of all, overall economic headwinds that you see because of the Middle Eastern crisis that's coming in, and what's really impacting rupee in your view?
Right. Good afternoon. Thanks for having me on the show. So look, when we are looking at, how the rupee has been moving since the West Asia conflict began, there's been this continuous, depreciation pressure on the rupee. Of course, today we've seen rupee touch, new lifetime low. There are a couple of points or factors that are weighing on the rupee. One, of course, India is a large oil importer, and the increase in oil prices that we have seen directly has an impact on our current account deficit, primarily because of higher import bill. Secondly, overnight, what also happened was that the US central bank monetary policy announcement came through. And while the central bank has kept the policy rate unchanged, there was, some signs of a slight move towards a hawkish signal from the central bank. So, of course, that led to a rise in US yields and the the US dollar index, which is another factor that is weighing on the rupee currently. So all in all, I think it's a mix of the pressure that we are seeing from oil prices, as well as the capital flow story, where we have seen capital outflows from Indian markets, bond market as well as equity market. And the new pressure point there is, of course, that, global central banks seem to be turning a little bit more hawkish, when they're trying to address the imminent risk to inflation going forward.
So in terms of imminent risk to inflation currently, Sakshi, and also the way the rupee is behaving, are we anticipating RBI's intervention, which has been coming from time to time, and there has been some unconventional measures also recently taken by the Reserve Bank of India at the worrying levels of 95 to the dollar? How do you see the RBI's really actions and the impact?
Right. I think that, the RBI strategy has been that, look, they don't have too much tolerance towards excessive volatility in the rupee, right? So I think that they have tried to come in and, kind of curtail that volatility as much as possible. So, with the global situation or the geopolitical tensions not abating, and, signs of further escalation, clearly this is, a time period where I would anticipate the RBI to put up some sort of defense, through intervention to kind of manage the rupee. Of course, not target any particular levels, but clearly this calls for, some amount of intervention to stall the depreciation pressure and calm sentiments. Whether we are at a point where we could see further unconventional measures from the RBI, I think that, it would clearly depend on how the situation evolves over the coming days. If the pressure on the rupee is extreme, and we continue to see large outflows from the capital market, then yes, I would say that, you could see space for further unconventional measures, kind of to come in over the coming weeks. But it completely depends on how the geopolitical situation pans out from here on.
So, Sakshi, my pointed question, above 95, is that a worrying level for the RBI to take action? And the second part is the inflationary pressure that we are about to see. Will that be also uncomfortable for the Reserve Bank?
Right. So to your first question, whether, 95 per se is an uncomfortable level. Look, as I said, they are not targeting, any particular levels on the rupee, right? This is a, continuous communication that has come in from the RBI and is very reflective in their actions. So I think it is more about the pace at which the rupee is moving. So, whether a quick jump to 95 plus levels, of course, as I said, warrant some amount of, could warrant some amount of intervention from the RBI, but they do not have, 95 is not the line in the sand for them. On the second bit, on the inflationary front, I think at this point, while yes, inflation is a concern, and we are estimating close to 5% inflation for FY27, which is higher than the central bank's forecast, I think they still have headroom before they decide, in terms of turning hawkish, because we must remember that the current supply disruption can also have an impact on, demand, as you were earlier discussing with your, previous speaker. That there's, of course, a growth hit that can also play out. So I think it will be a balancing act between what's the impact on inflation vis-a-vis growth, and that would determine whether the RBI necessarily this year, turns hawkish. I think it's too premature at this stage to price in rate hikes from the central bank.
All right. So interest rate hardening cycle is not what you are anticipating right now, Sakshi. Probably it's too early, and also the Fed has also held the rate. So that momentum also is reflective probably of the central bank moves across the world. But Sakshi, also HDFC Bank has come up with a focus and an authored report on liquidity in the banking sector, which has improved significantly. Give us a sense on where it's headed, and with this uncertainty, will that be also impacted?
Right. So, what we are seeing is that, of course, over the last 1 month, liquidity in the banking system has been in a significant surplus, averaging close to 4 lakh crores. Of course, a part of this is the seasonal effect where every April, because of, government spending, etc., at the end of March, you do see a buildup in liquidity. Now, going forward, our sense is that, look, over the next 2 or 3 months, I think that the focus from the RBI will be to remain growth supportive, given the supply disruptions and the probable impact on production and demand that could play out, and support liquidity conditions going forward. I think they will try and let the transmission of past rate cuts to kind of continue to flow through the system, and in that sense be growth supportive, in some shape and form. I think they would want to prevent any premature tightening or jump up in money market rates or the bond yield curve, and I think that's exactly the strategy that we are anticipating. So from a liquidity perspective, I think that we remain fairly confident that for the banking system the liquidity conditions could continue to remain comfortable, both because of of underlying factors as well as RBI's efforts. The risk to this forecast, and now since we spoke about the rupee and capital outflow, is really if we start seeing a lot more intervention from the RBI, which is not sterilized, because that would be a net drag on domestic liquidity and then could end up pushing interest rate upwards. So I think we'll be watchful of that over the coming days. But as a baseline, we do think that right now the first course of action from the RBI would be to support growth, through maintaining liquidity comfortably, at least between 0.6 to 1% of NDTL.
All right. So, Sakshi, that was a word on liquidity and very important aspect there. But looking at, most of the experts penciling in now, starting to pencil in the next quarter to be substantially impacted across many sectors because of the crude oil prices rising and also supply chain constraints and intermediaries of crude also impacting various raw materials, and that also impacting consumption. Looking at this in the short term, what are the macro data being penciled in-house at HDFC Bank, and also what will be on your watch list at this particular time? A quick outlook on that.
Sure. So you're absolutely right. I think a lot of the macro data that we have tracked so far up till March, I don't think we've seen a major impact coming through, be it inflation, industrial production or trade. But I think for Q1 FY27, as the conflict prolongs, I think some of the impact on the production side and the supply chain side should start kind of showing up in data. So of course, we'll be tracking, PMI, IIP index, and more importantly, of course, the trade data. What happens to India's import bill, and whether there's any sort of impact on things like remittances or on our exports to, the West Asia region. So that's one bit of it. Overall, at this stage, we are estimating that real GDP growth for Q1 could slip closer to 6.3, 6.4%. Of course, this is an initial, estimate, assuming that some of the impact of this conflict plays out in Q1. Lastly, just a point on inflation, since we discussed this before, I think what's something we'll be watching out very closely over the coming days is whether there's a revision in petrol and diesel prices, because that could determine the inflation trajectory going forward and the kind of pass-through that you see at the retail level.
All right, Sakshi, very well made all those points. And of course, on the watch list will be many factors of macro data as the global uncertainty and crude oil prices really put pressure. Thank you so much for joining us with all your expert take and perspective. All right, let's shift focus to equities, and we are in the thick of the earnings season. HUL had come up with its results, and the stock is down over 3%, about 3% in trade. and HUL's growth trajectory is likely to strengthen through FY27, with coffee segment growth to be supported from higher volume, says Priya Nair, who's the CEO and MD of HUL. Let's listen in to what else she had to say about the company's volume growth guidance. Listen in.
My question is on volumes, because this time it's a 15-quarter high number that you've seen, right? Considering that you've said that you'll be taking, calibrated price hikes, that could impact volume going forward. But at the same time, you've also said that, volume growth is our top priority. So going forward in FY27, I know you will not talk numbers, but any range in which you will be seeing volume growth coming forward?
So firstly, we won't offer a short-term guidance, right?
Yeah.
But let me get into firstly, what's the step up we are seeing?
Yeah.
I think the first thing is, what are we working on? The first is fewer, bigger bets. We've talked about this before. We will continue to focus on scaling up a few priorities so our resource allocation is becoming sharp. So that's the first thing. The second is working on our brands, modernizing them, premiumizing them, both in terms of communication, but also in the segments in which our brands play. Creating higher exposure to the higher growth segments is what we're working on across all our brands. Remember, HUL, we have 20 large brands and 55 total brands. So across our brands, really systematically ensuring that our brands we step up. The third is in terms of building the capability of our channels, really doubling down behind execution, because it's much more an omni-channel market India than ever before. So whether it is QCom, e-commerce at the top, or actually we are now investing also in general trade. So we're actually investing in building our footprint in chemist channels and open format general trade stores, and we have created a new specialized force to go to market in these channels. That combined with, continuing to drive our leverage, our operating leverage, is what sets us up for the next year.
All right, so that was HUL. Acutaas Chemicals has just reported its number, and the stock has spiked about 2% in trade. So keep an eye out on those numbers, and market has really reacted very aggressively to that. All right, apart from that, there are many other stocks to watch in the market. Parth is joining in with the whole list. Parth, which all counters really make it to your list today?
Thanks, Nisha. So there are three companies that are in focus today after they have reported their Q4 earnings. The first one is SEM India Projects, which reported a strong execution, which drove their growth across various metrics, with margins expanding thanks to the operating leverage that the company received during the quarter. The company saw an order inflow of over 5,000 crores during the quarter, with an order book of almost 25,000 crores, which is ensuring strong revenue visibility for the company going ahead. The company's diversified infra exposure is also going to support their sustained growth in the future. Then the second one is Fino Payments Bank, which saw a growth in revenue, but their core profitability was still under pressure. Their throughput has declined, which indicates that the transaction momentum is on the weaker side, during the quarter. The company has faced some operational challenges which impacted the overall performance, and the transition to small finance bank is a positive, but it will give a little bit more execution uncertainty going forward. And the last one is HEG, which saw its losses widen due to weak electrode cycles and the realizations which remained under pressure on the global side as well as on the national side as well. The cost pressures have impacted the company's operating performance, while the demand environment continues to stay weak. The company also saw an impact of around 194 crores, which was due to their investment in Graphite International, listed on the New York Stock Exchange. The earnings visibility for HEG still remains on the weaker side and still uncertain in the near term. So these are the three stocks that are in focus on the back of their Q4 results.
All right. Thank you so much, Parth, for getting us all those details. Thank you. And with that, it's a wrap on this edition of Markets at 12. And that is a standard disclaimer on your screens. All right, with that, it's shutters down on Markets at 12, but news, views and market action continues on the other side. Stay tuned to NDTV Profit. Thank you.
केसरिया से मन जोगी हुआ रे, दिल झूमे देखो
सिंपल बनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only.
Hello and welcome to NDTV Profit. You're watching Trending Stocks with me, Hiral Dadia, and Sharad Dubey, who's standing at the NDTV Profit market pit with all the action in the markets today. Sharad, it is a Thursday. You know, from that day's lowest levels as well, it's almost 100 points recovery that has come in. But the volatility continues to remain high. You have the rupee, which is not in favor to some extent. Brent is somewhere not in favor as well. Though from 126, you have Brent, which is again cooled down to 123 in terms of June futures. How is this entire setup actually putting you in terms of where trade goes?
Right. Good afternoon, Hiral. And yes, that trade, it seems like there is a negative sentiment getting impacted. Remember, it's a truncated week of trade. We saw a gap down opening, but a minor recovery is coming in. But nevertheless, the overall trend is still negative, at least on the technicals. So Nifty Bank also, the story is the same. Let's just pull out the Nifty Bank to see it's down almost 660 points. A minor recovery attempt is being made here as well. But important triggers to track is definitely the geopolitical developments which have happened. And that is, giving an impact to most of the markets. The Nifty support levels, immediate 23,800, that's where the bounce has come in. Nifty Bank also very tight range of support I have got. The range ranges between 54,500 to 55,000 levels. That's where the support is coming in. Apart from that, let's talk about the rupee. That has hit its record low levels. That's the concern which Hiral was mentioning. And the Brent crude above that $120 barrel per mark. That is where the concern starts coming in. But as we get into much further details, remember the basket sell-off is happening in the small and mid-cap space, and this trend has overturned after a lot of days, and that's a little bit of profit booking maybe there. Yields have risen, and the VIX that has spiked. India VIX is up almost 8% today, near that 19 mark. It's not a major concern, but if it goes past that 2022 mark, that's where the concern happens. But remember, avoid carryover trade for this long weekend. Lot of things are happening right now. First and foremost is the state elections announcements on Monday, the results, especially on West Bengal. That is where a lot of eyes are there. And apart from that, remember geopolitical developments for the next 3 days. US and Iran, it's very much important, and we don't know, there's no clarity yet. And tomorrow itself is a market holiday also on 1st May. That is why we are seeing a truncated week of trade, but definitely there is no clear trend coming, and we are going into this long weekend in a very uncertain manner. Over to you, Hiral.
Okay, so we're getting into that long weekend with a little bit of uncertainty. But let's quickly look at the watch list as well. You have HUL, steady Q4 earnings. That stock, however, under pressure as we speak. Apart from that, you have Bajaj Finance, which has posted an inline set of numbers. Likewise with Shriram Finance as well, but the numbers came in much earlier for Shriram Finance. The stock is down in trade. Vedanta, strong set of numbers that have been reported. SEM India, where strong Q4 profits are up 114% on a year-on-year basis as we speak. You have Misho on the JP Morgan note that is in focus. RPG Life as well reacting to the numbers. Syngene, where Macquarie has maintained an outperformance, again reacting to numbers. MTAR Tech. You have Bloom Energy, which has reported a strong set of numbers as well. And you have IQ Tech, where volumes are very strong. Brent crude above $120 per barrel, and that's the reason why Interglobe Aviation is in focus. Realizations have remained subdued for HEG. That stock is under pressure. And you have Fino Payments Bank, Wari Energies, K-Fintech, CET, all reacting to numbers, along with the Eternal, where the volumes are pretty strong. So that's what the watch list is looking like. But Sharad, over to you to take the rapid fire with Deven Mehta, from IDBI Capital.
Thanks a lot, Hiral, for that. Deven, it's a good afternoon. It's always a pleasure to have you on our show. And Deven, we'll start our rapid fire segment. The first stock in focus would be Shriram Finance. What are the key levels to watch out for here?
Okay, so for Shriram Finance, I think the overall structure remains weak until and unless stock do not cross 1060 levels on the higher side. The structure remains weak. On the lower side, there is a strong support at 870 level, which coincides with 200-day exponential moving average. So on the lower side, 870, strong support. On the higher side, resistance is placed at 1060. Fresh buying is recommended only above 1060 level after breakout.
Right, Deven, broking upgrade coming in from Misho, and now it's near that 200 level marks. Good time to do a little bit of profit booking, or do you see more strength in the charts?
No, I think the chart overall looks positive. We have seen a strong breakout above 188 levels into this particular counter. We have seen a rounding bottom breakout. So one can accumulate this particular stock on dips towards 188 levels. The strong support is placed at 172 on the lower side. So one can place a stop loss at 172, and this stock can further move towards the target of 225. So overall structure remains positive. One can accumulate on dips.
Right. Okay, Deven. RPG Life Sciences is the next stock we are talking about. We saw the earnings also doing well. Stock is doing well in the trade also. Anything in the volumes which is looking good here?
Definitely, the stock has given a strong breakout above 2120 levels, which was also its 200-day exponential moving average. I think the breakout is positive. The volumes are stronger compared to other days, and I think the stock can further rally towards the next resistance of 2360 can be the target. Definitely, one can hold this particular counter with a trailing stop loss near today's low of 2050 levels, and one can hold for the target of 2360.
Deven, look at MTR Tech's chart. The stock has been on a one-way rally, and after Bloom Energy, one of its key suppliers, they reported a very strong numbers last night. Now we're seeing a good move here also. It's a good time to take some profits off the table if somebody is holding it, because stock has had an unprecedented rally here.
Definitely, stock has been moving continuously higher, and we can see higher top, higher bottom formation from last 4 consecutive weeks, right? So I think one should definitely book some profits right now, and for we can say a partial profit booking will be more good at this particular level, and the trailing and for the rest of the quantity, I think there can be one can keep a trailing stop loss of 5500 levels, and one can hold this particular counter for next up move towards 7000 levels as well.
Right, Fino Payments Banks, the next counter, weak set of numbers coming in. What are the important technical levels to watch out for? Is there any trade to be made here?
No, I think one should avoid this particular counter. Overall, the structure remains weak, and on the higher side, it was unable to surpass the resistance of 145 levels, and we have seen selling pressure from those level itself. So I think until and unless stock is trading below 145, the structure remains weak. So one should avoid any fresh buying position in this particular counter. In fact, one should try to exit on bounces on the higher side, whereas support is placed at 111 levels, 111. If it breaches that particular level, we can see further correction in this particular counter.
Right, and the next counter is Wari Energies. Your views on this? Of course, the numbers were on the stronger side.
Yeah, sure. So Wari Energy, I think we have seen a strong profit booking in this particular counter today. The stock is down by around 10%. On the higher side, it has faced resistance around 3540 levels, and we have seen a correction. I think on the lower side, there is a strong support at 3000 levels. Those who are holding can keep this counter with a trailing stop loss of 3000. And think on the higher side, one should keep booking profits, and one should try to exit towards 3300 levels.
Right, and last 3 trading sessions, Eternal has been in focus after its strong earnings also. Good time to add some positions in this. Any fresh positions can be added for Eternal?
No, I think Eternal we have seen kind of a profit booking into this particular counter, and overall structure remains weak for this particular counter. It was unable to surpass the resistance of 270 levels, which coincides with 200 exponential moving average. I think one should avoid buying any fresh trade into this particular counter. One should wait, and on the lower side, 235 is the strong support. If it breaches, then we can see some further correction. So no fresh buying is recommended for Wari.
Alright, okay. Alright, that's the end for Rapid Fire segment. Over to you, Hiran.
Thank you for that, Sharad. Let's also look at which stocks are trending on Google right now, and if Deven is of the opinion which if he likes any of the ones which are trending. Today we have names like Metallist Forgings, Federal Bank, Websol, Siet and HUL which are trending on the charts. Deven, anything that you like specifically if you have to take a call on Siet or HUL?
I think overall HUL and the FMCG counters have done well. So I think HUL is one of the counter I'm looking for. But currently at this particular level, I think one should avoid fresh buying. If the stock surpasses the resistance of 2370, there is a falling supply trend line coming over there. So I think one should look at this particular level of 2370. If it surpasses and holds above that, then only one should look to buy Hindustan Unilever. Other than that, I think one should wait and watch for other particular counters.
Okay, so that's with regards to stocks which are trending on Google. Thank you so much for joining in. Always a pleasure to speak to you. But moving on, Emphasis is another one which is surging in trade after reporting a decent performance in the fourth quarter. Our colleague Puneet caught up with the management to discuss the quarter gone by and the outlook. The stock at the day's highest levels as we speak. Let's listen in to that conversation.
Mr. Rakesh, let me start off with, how do you view this quarter gone by? Because we've seen in February, the India AI Summit led to a lot of reinvigoration essentially of India's place in the world relating to AI. But then we've also seen those models come out from Anthropic as well as ChatGPT, and you've seen essentially an impact on stock prices across the sector, across the world. In this kind of demand environment, how have you performed and how do you view this quarter gone by? I'm sure it's been a tough one, but any views to start off on that?
Yeah, I think we can talk about all the problems with macro geopolitics, the AI-led disruption. But, from our standpoint, to be honest, we are pretty pleased with the way we've delivered the quarter. It's been a very steady performance quarter. The growth was obviously led by our flagship verticals of banking and insurance. TMT also grew on a YY basis quite nicely. Healthcare did well. But I think the highlight for us really is the AI-first, AI-native mindset of driving transformation across not just the IT value stream, but also starting to think about how can we impact outcomes for clients that go beyond IT. So from that perspective, we finished the year with a 2.1 billion TCV deal wins. Highest ever for us. For our revenue, for our net new TCV wins to be higher than the company revenues tells you that we have the ability to not just find opportunities, but create large deals and then close them. From the standpoint of demand environment, I think the two basic nuances and pivots that we are seeing in the market and clients are thinking about. Firstly, the focus on AI and innovation is driving a certain sense of urgency. They are also fairly open to, looking at propositions that drive the adoption of AI at scale. There's definitely reprioritization, but the reprioritization is in line with what can we deliver that can scale and how do we justify the ROI for that. So I don't think they're pulling back. but there's definitely a fair amount of scrutiny on what's the value that's being driven. And the reason for that scrutiny is because almost all of them have done, AI pilots and use cases and experimentation, and that hasn't really scaled. So I think it's an interesting time because for the right set of propositions, there is a right demand, and if it's an outcome-driven ROI generating model, then pricing is not the constraint and budget is not the constraint. So fairly pleased with the way we delivered the quarter. I think our Neo IP stack is driving a lot of opportunity, and we're able to close those deals at a pretty steady clip.
Mr. Rakesh, the other aspect, because you mentioned about AI innovation driving urgencies, budgets being largely what they were. Now, within the other companies also that have come out with results, a common theme has been that AI is leading to, of course, newer conversations. Some have also resulted in deal wins, but largely continue to be cost optimization deals as of now. So what we've seen over the last 2 to 3 quarters, that cost optimization deals were driving the conversation. That seems to have been accelerated or at least maintained at this point of time. What would be your assessment in regards to emphasis with this regard?
Yeah, I think almost 70% of our deals are AI-led, which means, yes, efficiency and productivity is an important element because that's the lowest hanging fruit when it comes to deployment of some of these solutions. Whether it's in software engineering, automation of the QA process. We are also able to unlock new opportunities coming out of the adoption of AI, especially around things like value stream modernization. If you think about an underwriting process, you could actually modernize the process without necessarily modernizing the underlying core platform of the tech. So to me, driving an outcome where you can impact the business, the reason to modernize the underwriting process will really be higher throughput. Hence, you can write bigger book of business, and hence you have higher revenue. So I think 80% of AI spend, as per McKinsey estimates, are likely to drive outcomes that will be either an operation transformation or a business reimagine, client experience reimagine. They will be routed through the CIO's office, but they're not going to be constrained by just the tech budget that the CIO has to drive these opportunities. So to me, I think the narrative has to move beyond just cost and productivity and efficiency. And for whatever reason, our sector was traditionally playing on the cost side of the house. But today we have an opportunity to go up the stack and actually start driving business transformation. And that's really where the excitement is coming from. And we started to see that play out quite nicely in our deals as well.
Okay, so that's the view coming in from the management of Emphasis. In fact, let's get in Girish Sodani, co-founder at Ensure Capital. Girish, welcome to the show. And how are you looking at Emphasis as well as any other mid-cap IT companies basis what has been announced so far?
So let's talk about the Emphasis first. Let's completely deal pipelines as well as the geographical tensions. I think this particular counters have already done all the cross these type of issues what already faces from the mid size of the companies. You come to the banking and the financial sectors, they are performing very, very strongly, like a more than a 7.5% growth on quarter-on-quarter basis, and a little bit of strong build-ups for the longer period of times. But again, there is a headwinds ahead by the macro environment side now. So we are a little bit cautious about entering current levels for the short midterms of that type of companies. But if we talk about the comparison between all of these companies, I'm looking out that the Emphasis is a more familiar rather than the Persistent as well as the Coforge. Because the deal size, apart from that, the revenue goods, we are just expecting that the Emphasis is the better ones in the terms of 10 to 20% of the annual expectations, what we are looking out for the financial year 27-28.
Right. So that's the view coming in the mid-cap IT space from Girish. But moving on, a focus on Bajaj Finance. Of course, company has come out with its numbers also, some broking upgrades also. But to give an entire perspective about it, we are joined in by Shivam, who is tracking this space very closely. Shivam, what were the numbers in Bajaj Finance? How is the street taking it?
Bajaj Finance has posted a mixed set of numbers for Q4, and wherein the net interest income has grew by a very strong numbers, and on the back of strong AUM growth, and in which it was led by the growth in commercial vehicles, tractors and gold loan segments. Also, the GNPA and NPA metrics have reduced significantly, which reflects a better asset quality. The provisions have lowered, but the company has created additional provision for ECL of amount 142 crores. Now, looking at the con call highlights, the company is very much confident on customer addition of around 15 to 17 million in FY27. Also, the company estimates a growth of 22 to 24% in AUM, which will be aided by its new business segments, and also it expects that there will be a marginal moderation in margins going forward.
Right. Thanks a lot, Shivam, for that. And Hiral, what's buzzing for HUL there?
Okay, so that's with regards to, HUL is very interesting, Sharad, I would say, because the stock is under pressure in spite of numbers being pretty much in line with what the street was estimating. The key over here is the volume growth, which has come in at almost a 15 or 16 quarter high, but net profits at 2,992 crores versus an estimate of 2,658. Your EBITDA has come in at 3,841, which is pretty much in line with what the street was looking at, and margins at 23.5% versus a 23.1%. If you see in terms of where the other commentary goes, your one-time gain of 247 crores is what they're seeing versus a loss of 134 crores. So I think that is one of the one-offs that we should be watching out for in today's session. Girish, how are you looking at a HUL? Because volume growth has been very strong at 6% versus the street expectation of 4 to 5%. But it seems that the stock is not, investors are not really happy.
So again, we have to see the complete scenario as of now, because come to the HUL as well as all of the FMCG companies, we are just expecting that these type of margins are a little bit positive terms, not for the shorter period of time, but for the longer period of time. We come to the expansion point also. The companies have strongly expansion plans for the financial year 27-28. The premium focus on the new product lines of the skin care, hair care. Apart from that, the growth projections for the Tier 2 and Tier 3 cities. So looking out a strong build-up, if we talk about the actual perspectives, yes, the investor should be view for the next 3 or 4 years down the lines. Then it will be given strong build-ups for their portfolios.
Of course, you are looking at CEAT's numbers also. The numbers were strong, but I think it's reversing. And why is it happening? Is it profit booking? Is this something else? Joining is, we have Puneet with us. Puneet, you're tracking CEAT. What's the view initially coming on these numbers?
Well, the numbers were very strong, as you rightly highlighted, but it's the fact that the commentary has been very weak in this particular quarter, and that's leading to the downward momentum. Now, EBITDA was up 50%, while profits have almost up 140%. But the cost headwinds is one of the key factors. Now, natural rubber prices have already inched up from 190 to 244 rupees per kg. And the rupee has depreciated in this quarter from 91 to 94. Those were a couple of key factors that the management highlighted in terms of impacts. Now, we've also seen that the broader market also remains uncertain, according to the managing director, and H1 could see that impact. They've also said that they feel a 15 to 20% hike in raw material prices will be the other key aspect that will impact the company as well. So they've already taken a 5% price hike. Another 5% is in the annual. But overall, that's the reason why Nuvama and MK has actually downgraded the counter. And there's a 40% EPS cut based on this weak outlook.
That's a massive cut coming in. Girish, just wanted to get your views on this. The tire companies might take the pressure in the first quarter of FY27 because, of course, the Brent crude and the crude derivatives and everything else comes in. Your views on that in entire tire space?
So for the tire space, yes, there's a huge pressures for the short terms. I'm looking out for the next 3 or 4 months down the lines. So for the current positions, yes, the CEAT is facing the heavy profit bookings right now. Not because the results are looks like a very bad, but it's because that the management is concerned about the margin pressures still going on, as well as. But if we talk about the longer period of time, yes, CEAT has a strong build-ups. The strategically expansions mode are still going on in the Chennai expansions, as well as the 1,300 crore investments in the next 1.5 year time down the line, as well as the truck and the bus tires also are moving to the expansion modes as well as the export focus. But if we talk about the tire segments, yes, we have to concern for the next 3 or 4 months at least to settle down the each and everything for the macro environment.
Right. Thanks a lot, Girish, for giving your fundamental views on the stocks we are discussing. but there is a little bit of discussion left on the auto sector. Bajaj Auto comes out with its buyback, and we had mentioned earlier this trend. There are a lot of buybacks expected to come in because of the changes which are expected to come in. Is this the first buyback or something else has happened earlier?
No, they've announced a couple of buybacks over the last 2 years, but on May 6th, when the company is meeting for quarterly results, the board will be mulling a buyback this time around as well. Now, the key aspect is that the previous buyback was in February of 2024. This was almost a 4,000 crore buyback. And at that time, the buyback happened at 10,000 rupees per share. Roughly around 1.4% equity was bought in 2022 June. The buyback price was 4,600. So, and the amount was roughly 2,500 crores. So we could expect a similar amount yet again. And the company has almost 15,000 crores of cash with it, and generally gives a dividend of almost 140 to 200 rupees per share. So those key aspects could come in very soon.
Thanks a lot, Puneet, for both of these talks. Interesting analysis, and Puneet tracks the auto sector. But we are running out of time, and that's all, folks, for Trending Stocks from me, Hiral, and the entire team who have put together this show. Stay tuned to NDTV Profit.
केसरिया से मन जोगी हुआ रे, दिल झूमे देखो मतवारा हुआ रे। केसरिया से मन जोगी हुआ।
हर पल मनाओ केसरी त्योहार, विमल बोलो जुबां केसरी।
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Reports with me, Gauri Dwivedi, weeknights on NDTV Profit.
New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
Today, the investors can invest in the real estate sector with the help of REITs. A new offering is coming in this space. Blackstone-backed Bagmane Prime Office REIT is coming up with its IPO. And what can the investors expect on this? Joining me to talk more on this is Hugh Andrew, CEO, and Ashish Shah, who's the CFO of Bagmane Prime Office REIT. Thank you for joining us on NDTV Profit.
Good morning. Thank you for having us.
I want to start by asking you that why this timing for the IPO with a 3,400 crore IPO in the market?
The Indian real estate economy continues to grow year after year, and the REIT, this will be the sixth REIT in the marketplace. We believe that the REIT is a fantastic opportunity for the Bagmane Group, a well-renowned Bangalore-based developer who've completed over 35 million square feet since the early 2000s. It's a great opportunity for them to bring their quality product and their quality investment returns to a broader marketplace.
So the offer has an offer for sale around 1,000 crore and a fresh issue of over 2,000 crore. Where will the IPO proceeds be used, and how can the investors read into the offer for sale?
So the primary proceeds are being used for acquisitions. So as part of formation transaction, which happens after the REIT is successfully subscribed, all the SPVs and assets move to the REIT, right? So majority of the usage of the primary proceeds will be to acquire an SPV and an asset from the sponsor group. And the secondary is being done by Blackstone. So Blackstone was a minority investor with us since 1.5 years. And they are selling down partial stake of theirs.
All right. How does the inventory look like, the incremental inventory which could come in the markets over the next 3 to 4 years? And how will that affect the pricing and the yields of the REIT?
I think it's important to consider two factors. And we use in the industry the term absorption. So that's a combination of the supply that's coming to the market, but then also the demand and the take-up. And the two markets that we operate in Bangalore are the best performing micro markets in the world by absorption. So we have a very positive outlook on the demand, and we have a very positive outlook that India will continue to build, and Bagmane will continue to build the product that provides those corporate solutions for the GCCs and for those global companies that we know want to come to India.
On GCCs, if you would like to tell that, how do you plan to expand in this sector, and are there any challenges, and what are the timelines we're looking at?
Bangalore has about a 38% share of the GCCs in the Indian market. It's over 100 million square feet. And only 35% of global GCCs actually have an existing footprint in India. So we see huge potential for growth. And there's no reason why that demand will change. All the indicators are in terms of the RFPs that are being issued and in terms of the take-up are very, very positive. One of the most important things and one of the skills that the Bagmanet Group have is to work with our tenants and identify their needs, not just for today, but also for the future. So our tenant retention rate and the growth of tenants within the portfolio is second to none.
What's your take on the valuations? Because REIT is a fairly small space, and compared to the peers, how can the investors assess the pricing and valuations?
So valuation is a result of multiple things. It's the expected returns, it's the quality of assets that are going in, and the safety that the asset provides, right? Because the REIT is not just a growth story. It is a growth plus a safe investment combination of that. And we had an extensive discussion with our BRLMs, and BRLMs, went to the market and they felt this is the right number at which we can launch the IPO, which also, showcases the strength of the portfolio and the quality of the portfolio. Typically, in a REIT product, an investor in a long-term basis can expect lower to mid-teen kind of returns with a lesser standard deviation is what we talk about, generally lesser risk. And that is a mix of the yield that is given to the investors on annual quarterly basis, plus the growth that comes out of rental escalations and additional development coming into the portfolio.
All right, and there you go. So that's the word coming in from a very important player that's going to be coming up, the newest kid on the block. And May 5th is the date that you're watching out for when it comes to this particular IPO. But with that in mind, let's kick off the show. Lunchtime Trades is what you're tuning into right now. And this is the show that gets you a highlight of everything that is happening with the markets, as well as the world of commodities. But first things first, let's quickly take a look at what the markets are up to. When you talk about Nifty, about a 250 odd point cut is what you're seeing. That cut is actually much deeper when you talk about Sensex as well, and when you also talk about the sectoral picture. In fact, that's also tilted very, very sharply in the favor of red. So it's metals, PSU banks, auto consumption, and FMCG exactly in that order that are under a lot of pressure. But what's holding up a little more resilient right now is perhaps IT, with the sole sector in the green as well at this point in time. But with that in mind, let's also talk about the key talking point this afternoon, and that without a doubt has to be oil prices, because you do have Brent that has soared past $120 a barrel. Let's quickly take a look at Brent prices as well, and also get talking on the triggers. When you talk about the key trigger, it's the renewed Iran action chatter. And as you can see on your screens, about $122 a barrel is where Brent is at. You do have the prompt spread between the Brent contract as well as WTI that is also widened, as you can see reflected on your screens, with WTI close to $108 versus Brent at $122. When you talk about what makes it to investors' radar, like I mentioned, it's that renewed Iran action chatter that you're looking at. Other than that, the energy inflation risk is very much back in focus, and the war premium is very clearly back in the barrel as well. Let's also get talking about some of the factors and the takeaways coming in going forward that you should be keeping in mind when it comes to oil prices. Ajay Kedia, Director, Kedia Advisory, is joining us on the show right now. Mr. Kedia, it is a fabulous day to be talking to you right now, given that oil prices have actually managed to surpass some of the levels that we've been talking about for weeks at this point in time. You do have that Iran action chatter and the possibility of active combat and some of those options that are being mulled on the state side that could really bring the supply squeeze really back in focus when it comes to oil.
Very good afternoon, Shaji. Yes, you have rightly that we were talking about 120 and Brent on June future has crossed that level. We still expect this logistic issue will continue to be there and supporting the prices. See, we have seen even UAE exiting OPEC because the supply has to come down in the market, but really I'm expecting the choke points are more important. So I think demand side is also slowly and steady things have been done. Important would be the how Trump and Iran will be solving this problem, because US is under impression that if we blockade this whole route, the import and export for Iran will collapse, and ultimately it will impact Iran much more But I think the Caspian seas are open. Even the pipelines options have been open. But I think unless until things doesn't looks good as of now, we may see price moving slowly and steadily towards 128, 130. But be cautious. Any positive or ceasefire news can again result with a fall of around 10 to 15% as soon as some news comes. But as of now, prices are heading towards 128, 130.
Absolutely, Mr. Kedia, and we'll take your word for it because you did call this particular price action that we're seeing being reflected right now as well. $120 a barrel is something that we were talking about on the show as well previously. But when you talk about the key triggers, do you think that it's just the geopolitical premium, or do you think that it's also the fact that the Brent contract that we're currently looking at, the June contract that is going to be ending soon, and you'll soon be looking at the July contract?
Yeah, see, there are both the things, because generally if we talk about the spot, it is trading with a premium of, let's say, $4 to $5 only, but it's a June contract where we have seen positions have been there, and premiums have been there for, we can say contango is quite high because of that decision. But yesterday I was just having a talk with someone that December contract, you can check, still it is in discount. That clearly shows this is a temporary phenomena where we can see prices moving on a higher side, but as we move to Q4, things has to come down. So I think it's a temporary phenomena that maybe next 1 week period, if we get a level like 120, 130, but that levels would not be sustained because we have enough supply, but immediate concern is the logistic part.
No, absolutely. So are you saying that higher for longer oil prices is not something that you should be penciling in because, brokerages and the street alike, that seems to be the assumption very clearly here?
Yeah, see, this is not an issue with the supply. We have already seen OPEC used to cut down their production in order to absorb because demand post-COVID has been totally disturbed. Today also in the morning, we have seen manufacturing numbers from China and other economies that has not showing a very viable jump. So I think demand side has been constant. Yes, this is the impact of 13 million barrel that has been out in the market, and that is why prices are getting supported. But as we move further in Q3, Q4, again, the supply would be more than the demand, and prices has to come down. But forget about $60, $62 what we used to see last year. Now the new normalcy would be around $75. So ultimately, it will impact the inflation.
Absolutely, that makes sense in terms of those rising concerns when it comes to not just oil, but also energy prices as a whole, as an entire pack. But let's also talk about gold as well. Couple of things that are happening here, Mr. Kedia. On one side, you do have gold snapping that 3-day decline streak. On the other side, you do have prices that are set for a second monthly decline in the month of April. How are you looking at all of this, balancing it, and what do you then expect for gold prices going forward?
Jaji, I am bearish on gold as of now. Last time also I have mentioned that unless and until $5,000 doesn't break and hold, we may see prices moving towards 45, 45, 50, and even a dip towards 41.50. See, important is the interest rate scenario. Yesterday we have seen Fed has clearly, we can say, in fact, Fed members are also separated with the view. So I think previously everyone was expecting a severe rate cut as Donald Trump was continuously pressing. Even the new Fed chairman, Kevin Ross, is in favor of aggressive rate cut, but this April month we have seen Fed would be working independently against this senator. They have updated. So I think interest rate cut has been, I don't think we can see in 2026. In fact, a rate hike possibility that is creating pressure. Secondly, because of energy pinch or energy concern, we have seen Russia, Turkey and major other economy are also cutting down their long holding. So I think things are not good for gold. It is a temporary phenomena. After a couple of months, maybe we can see good buying because recent World Gold Council report suggested buying has been there in India, China. People are buying still. So I think market would be slowly and steady in a consolidation zone with a slight tint of weakness. So maybe a support like 41.50, 4200 we are expecting.
No, absolutely, and that makes sense in terms of the way that you should be seeing some of those commodities. Very quickly before we let you go, Mr. Kedia, I just wanted to get a word going in terms of what are you then bullish on, because you're bearish on gold prices right now and you're a little bit cautious when it comes to oil as well.
So I think you are clearly nailed because bullions are slightly weaker and volatility is there in crude oil, natural gas. Safer side is base metal, where we can see copper right now on domestic market trading at 1280. We have seen sulfuric acid concern. We have seen Indonesia and Chile output concerns are still going on. I'm more bullish on copper, zinc, and aluminum, where we can see another, let's say, 5 to 6% gain in next 1 month period. I'm more bullish in the month of May, where copper currently trading at 1280. In LME, it's around 12,800, 900. We can see 13,500 on the higher side. Even zinc, we have seen prices after getting some corrected 340 is going to be a good level to re-enter, targeting 360. And most important would be the aluminum, as 9% of global aluminum price has been dictated by Middle East. And right now the supply concern and energy concern both are impacting these metals. So more bullish on aluminum, where we can see prices moving closer to 380, 385, that is around, let's say, $4,000 on LME. So overall, out of all commodity, agri and base metal, both are looks prominent as compared to gold, silver, and crude.
Absolutely, and we've been talking about copper as well for quite some time, and you've been right about a lot of those forecasts when it comes to this particular metal as well. Thank you so much, Mr. Kedia, for taking time out and joining us this afternoon. So there you go. That's the word coming in. The clear bullish call is coming in on some of those agri commodities, aside from copper, of course, and that's something that makes it to the top of his list as well. A little bit bearish when it comes to bullion against this entire backdrop and volatility. But let's also talk about US-Iran war entering the third month and Hormuz blockade that continues to haunt global trade supplies. Like I mentioned, oil is one of the top stories this afternoon as well, and Indian OMCs have maintained a strong front, holding fuel prices despite mounting bills and under recoveries. For how long can OMCs really sustain without raising some of these prices? Somit is joining in with that answer.
Brent crude is now trading at around $120 per barrel. Now, is it the highest price that we are seeing? In fact, no. Back in March 7, 2022, when the Russia-Ukraine war had started, in fact, at that time on intraday basis, Brent crude had hit a high of around $139 per barrel. And what happened post that, from March end, we did see some price hikes coming in from March end to April first week. Around 10 rupees per litre was hiked in around 16 days. 14 increases is what we had seen. Post that, government had cut the excise duty on petrol and diesel by around 8 rupees and 6 rupees, and this was completely passed on to consumers. So net the impact on the consumers was largely neutral at that point of time. Now, at that point of time, Brent continued to remain above the $100 per barrel mark for nearly 6 months, but we had not seen any change in the retail fuel prices, that is petrol and diesel prices. So there were no changes in petrol and diesel prices back then as well, when Brent crude was trading above the $100 per barrel mark. But there was something different at that point of time, and that was the fact that India was getting Russian crude, that too at a discount. And this is not happening at this moment. So OMCs were able to absorb this shock coming in. But despite that, there was a big impact that came in onto the books of the oil marketing companies back then. In the 2 quarters where oil prices continue to remain above the $100 per barrel mark, the combined loss that HPCL, BPCL and IOCL reported was close to 18,800 crore rupees. And HPCL, which has the highest exposure to the marketing business, alone had to book a loss of close to 11,000 crore rupees in the couple of quarters where crude prices continue to remain above the $100 per barrel mark. Now, what happened post that? Post that, retail fuel prices continue to remain unchanged, but Brent crude, that had come down, and on an average, the prices that we had seen from 2022 till 2026, till Feb 2026, the average prices was close to $77 per barrel. But retail fuel prices continue to remain on the higher level. And because of this, oil marketing companies were able to recoup all the losses that they had bared in those 6 months back then. And they were earning supernormal profit when it comes to the marketing segment. In fact, because of this supernormal profit, the company's reserves jumped nearly 57% during that time frame and came at close to 3.27 lakh crore rupees. This is the combined reserves for oil marketing companies, IOCL, BPCL and HPCL. But what is happening now and what is different? Firstly, is the INR depreciation, and because of that, despite the fact that Brent crude in dollar terms is not the highest, but Brent crude at rupee term is the highest ever that we are seeing at around 11,000 rupees per barrel, and that is the biggest impact that is coming in on the country and on the oil marketing companies. Apart from that, crude is now available at a premium. Even Russian crude is available at a premium, which was not the case back in 2022. So these two are the main reasons why it is more impacting the oil marketing companies at this point of time. Now at $120 per barrel crude, oil marketing companies are seeing a burden of nearly 27,000 crore rupees. This is the loss as per Kotak Securities that these companies are bearing every month, and they would require a price hike of close to 25 to 28 rupees per litre. But given the fact that these companies have so much reserves at this point of time, around 3.27 lakh crore rupees, at least if they do not take a price hike and continue to see this impact coming in onto their books, at least theoretically, oil marketing companies can bear the burden for the next 10 months at least. And this is completely theoretical, and it does not mean that they will do this or not. But what the street is expecting at this moment is that there might be some price hike coming in, not immediately. Government might want to see how crude price moves on going forward. If they continue to remain above $100 per barrel, street is expecting a price of hike of up to 5 rupees per litre that could come in, and in that as well, diesel is something that will see a sharper price hike as compared to petrol, because petrol is largely used by common man, and diesel is used more by factories and for other purposes. So that is what the street is expecting at this moment, and theoretically, oil marketing companies can still have a positive net worth and sustain without taking any price hike for 10 months. But do remember that is just a theoretical exercise that we're doing.
Well, absolutely, and thank you so much, Soumit, for getting us that entire detailed analysis as well. So that's oil prices that are soaring in trade right now. But when you talk about some of the counters on the flip side in the market that are under a lot of pressure, something like a Vedanta makes it to that list, even something like a Vari Energies, HEG, KFintech, or a CEAT also. And that's one counter that we should be talking about right now, because auto space, in fact, is in focus. CEAT is reported its fourth quarter numbers. Puneet is joining in with some more details when it comes to this one.
Well, the company reported a decent set of numbers. Actually, EBITDA was up almost 50% in this particular quarter, and profits have almost up 140%. But despite that, the forward-looking commentary is something that's been very weak, and hence the stock is down in trade today. You've seen consistently that for CEAT specifically, the commentary by the management in terms of raw material price increase has been quite material. So natural rubber prices are up from 194 all the way up to 244 rupees per kg in this particular time frame, and all of that has happened within the quarter. The rupee is also depreciated from 91 to 94, and that has had another key impact on CEAT and its numbers, especially led by what they've seen in terms of raw material in sourcing. So that has been the second key factor. Now, when you look at the company in terms of the numbers specifically, of course we spoke about it, but a broader demand environment remains uncertain even in the first half of the financial year, is what management has said in commentary. This was hit by West Asia crisis as well as the fuel price concerns currently as well for all the tire makers. Crude oil is a key raw material as well. Overall industry growth is now expected to moderate, and the management expects a further 15 to 20% raw material price impact in this particular quarter as well as the next one that will come by. Overall, when you see the growth in this quarter, the radial bus tires have grown decently as well. MHCV saw a high single-digit growth. Truck bus radial were double-digit growth, but the price hikes is something that the street is focusing on now. 5% is already done. Another 5% will be taken in a staggered manner between May and June, is what the management has said. But finally, this has not given enough respite to the street. So brokerages like Nuvama has actually downgraded the stock now to hold from a buy earlier with a target price of 3,900 rupees per share. They are seeing limited potential and reckon that the EPS will fall by 4% because of the delayed price hikes by the company while they are absorbing costs and applying a 16 times price to earning multiple for FY28. MK as well as the last brokerage that has downgraded the stock, and a massive target price decreased to 3,600 versus 4,900 earlier. So this is another key aspect. They feel that the FY27 EPS has been slashed by 47%, and hence a big loss. The counter is trading down by almost 4.5%.
Absolutely, and thank you so much, Puneet, for joining us with that entire update when it comes to something like a CEAT that's in focus on the back of uncertain management commentary also, bearish, some comments also coming in from the brokerages. But let's also move on, talk about FMC major HUL that reported a steady set of numbers. Mahima is joining in with that earnings fine print.
Yes, so overall, good set of numbers from HUL. In fact, a steady set of growth is what we are seeing. The revenue saw an uptick of around 8% EBITDA has overall seen a good growth of around 6% Margins have come in at a higher end of guidance at that 23.5% mark. The management, in fact, has gone ahead and said that the margins will remain in that range of 22.5% to 23.5% despite of the raw material inflation that we are seeing overall. And net profit has seen a good growth coming in at 21%. The focus, I think the key takeaways from the management interaction as well as the press conference were that the management remains focused on fewer and bigger bets, remain focused on volume-driven growth. They remain focused on premiumization as a whole. They've said that they are going to take calibrated price hikes anywhere between 2 to 5% because of the West Asia conflict. Margins, again, like I said, they said that it will remain in that range of 22.5 to 23.5%, and to maintain that, they will be taking calibrated cut in other expenses like media, advertisement, etc. In terms of overall, trade-wise perspective, they said that they're investing in general trade as well as they've, have had a separate team which is also managing quick commerce and e-commerce. So all in all, it's been a good growth. A volume growth coming in at the 6% mark at a 15-quarter high is most certainly a positive one coming in from HUL. The stock probably is seeing profit booking, but a good set of numbers coming in for FMCG as a whole this quarter.
Well, absolutely. Thanks, Mahima, for joining us with that earnings fine print. That stock is seeing a little bit of profit booking right now, but let's also move away from HUL. That's reported a steady set of numbers overall. Dhan has introduced its Gold Vault offering, which is aimed at simplifying gold investing for retail users. In fact, my colleague Ridhima spoke with the management. Let's go across and listen in to a slice of that conversation.
I want to start by asking you that what is this Gold Vault about, and how is it different from other digital apps or the physical buying of gold and silver?
Yeah, well, thank you so much. See, first of all, when we thought of launching Dhan Vault, there were three primary things which we thought that we should solve for. One was when you spoke to users or the users of today, the biggest problem which they face is when they go and buy gold is about the transparency of price, the quality, the purity, and when they receive gold, what kind of packaging it comes into. I think, and we thought that if we are able to solve this, why not link it with a market infrastructure which is robust, which is efficient, and can we do that? So that was one of the problem statements. Second thing which we wanted to focus on, if somebody has bought gold, can they keep gold or rather store gold, without worrying about any kind of risks associated with it. And third was, can when somebody needs gold, can they get it at their own convenience through a very trusted logistics network? I think we felt that if we are able to solve these three problems, I think the user of today, a buyer of today's time, where you feel that people are more tech savvy now, the youth of today want better control, transparency, they would really appreciate that. And we went back, we sat with our team, we debated on this, we thought through. And we also consulted with market infrastructures, exchanges, and also kept the regulatory aspect into mind. And that what led us to develop and bring today Gold Vault. So Gold Vault today solves all the three problems. The first problem of price transparency, the purity, what carat you gold, what carat of gold you will be getting is getting solved, where what we provide on our app is we give you the exchange traded contract, which is where the price is disseminated live from 9 a.m. in the morning till 11:30 at night. A user has a choice. They can buy gold at whatever time they wish to, whatever price they feel is the right price to buy.
All right, then there you go. So that's all the time that we have on this edition of Lunchtime Trades. Thank you so much for tuning in.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and
Good afternoon, you are watching Small Cap Buzzers on NDTV Profit with me Somit Sarkar and my co-anchor Mahima. In the next half an hour, we'll take you through the most important small cap stocks that have been buzzing in trade either on the back of price or volumes. So let's see what's on the show today. Firstly, we'll be speaking with the management of Capital Small Finance Bank. Now, the stock is up nearly 21% in the last 1 month, and the company has given a strong growth guidance of nearly 22% for FY27 when it comes to their loan growth. Apart from that, we'll also be speaking with the management of Baheti Recycling. Now, the stock is up nearly 24%, and if you look at the second half PAT for the company, it has nearly doubled compared to what it had reported on a YOY basis. So strong performance coming in for Baheti Recycling as well in the second half of this financial year. And apart from that, we'll be also discussing a couple of stocks. Firstly, IRM Energy. Now, this small cap stock has nearly doubled in the last 1 month. So what's fueling this rally is something that we'll discuss on the show today. And we'll also be speaking about IQ Tech because this stock has been gaining for the last 4th consecutive session on the back of strong volume number. So what could be the potential reason behind this jump in the stocks and the volume is something that we'll try to decode with our fundamental guest on the show today. Now, if you look at the markets, Nifty, we were down at least nearly 400 points at one point of time, and since then we have seen a stellar recovery coming in, nearly 200 points recovery from the day's lowest point. Nifty is again very close to its 24,000 level. If it continues to hold the 24,000 level, there is hope for more upside, but below that there could be more downside is what Street is anticipating. But a stellar recovery coming in from the day's lowest point, 200 points, very close to 24,000 level right now. If you look at the sectoral indices here, on the gainer side, firstly, on the gainer side, if you look at, it's only Nifty IT index which is in green. But on the losing side, we have Nifty Metal and PSU banks which have been losing out in trade today. And when it comes to small cap index, obviously it's not a great day. But a few stocks is still where we are seeing some signs of buying activity coming in. Mahima, could you just take us through that?
So Somit, overall, as you rightly mentioned, the picture is not looking very nice in the broad end of spectrum, but yet there are counters that are standing out. You have RPG Life Sciences, which is seeing a gain of about almost over 10%. You have Dwarikesh Sugar, which is also doing fairly well, up 10%. India Bulls continues to rally, up 10% as well. Something like Mavana Sugar. So a lot of sugar names doing fairly well, up 8% as well. Shakti Sugar also up 8%. BL Kashyap also seeing gains of about 6 odd percent. Dhampur Sugar also seeing gains of about 6 odd percent. Gujarat Kidney is the other counter which is doing fairly well, up 5.8%. DCM Srirang seeing gains of about 5% as well. Something like Globus Spirits is also up 5%, and something like Magad Sugar is also doing fairly well. But on the flip side, you have counters like SR Shipping, yet another day of profit booking for this one, down 8%. KSOLs down 8% as well. Something like a DP Abhushan is down 4%. Followed by something like an NIIT Learning, which is down 3% as well. Aclia Solution also down 3%. Greenply is also seeing profit booking today after the rally we saw yesterday, down 3%. And something like a Borana Weaves is also seeing a downtick of around 2.5 odd percent. So of course, that's with regards to where the broader end of spectrum goes. But as promised, let's bring in the management of Capital Small Finance Bank. We're joined by Sarvajit Singh. Samara was the Managing Director and CEO of Capital Small Finance Bank, joining us now. Thank you so much, sir, for taking out the time. My first question is, of course, Q4 has been a good quarter for you. Overall, asset quality is improving, but cost is putting pressures overall. But just want to understand from a margins point of view, you're expecting margins to improve despite of deposit repricing. Just want to get a sense, considering rate cuts into picture, how confident are you with regards to your NIMS guidance?
Actually, the deposit repricing, some impact, positive impact has already been shown in the Q4. The rest is to come in Q1 of the current financial and more in Q2 of the current financial. So by Q2, total 100% deposits would be repriced. So this will have a favorable impact on the NIM, of course.
In terms of MSME, that is one of your fastest growing segment. If I'm not wrong, it's grown 46% year on year this quarter. Just want to understand, do you think that overall, having such a big exposure to MSME will kind of underpin growth going forward, or this is the run rate at which you're going to grow in terms of MSME?
No, we are very bullish about MSME and the type of customers we are catering to. So it's showing a good traction. And I think for the current, say, financial year 2, the MSME would be the key driver, followed by mortgage and then by agriculture.
Growth is not going to translate to higher slippages?
No, of course not. Of course not. If you see, even in Q4, we have improvement in say the net NPAs with regard to MSME. Yeah.
Right, but just wanted to understand, given the fact that the current situation that we are seeing because of war, a lot of businesses are getting hit, and larger banks have also pointed out is that there could be some concerns if crude continues to remain above the $110 per or $100 per barrel mark and the war situation continues. So any signs of such issues that you're seeing or you're expecting?
Actually, Somit, like we are mainly focused towards the middle income group segment for whole of our business, whether we talk about loans or the deposit. So the MSME into which we are into ticket size of starting from 25 lakhs to 3 crores of rupees. And mostly these MSMEs are small businesses and their entire business is domestic focused, catering to the domestic market. Well, so I don't see any challenge on ground with regard to this. Yeah. Okay.
And if you could just share some guidance on your credit cost, what are you looking at? What is the number that you're looking at? And also on the cost of funds side, is there further room there that the cost of funds could come down?
Yeah, if you see that there has been an improvement, the cost of deposit has already started showing improvement. The first improvement has come in the Q4 itself, where it has reduced from 5.86%, the cost of deposit, which was in Q3, and in Q4 it has come to be 5.75. Since slightly above 50% of the deposits are still to be repriced in Q1 and more towards Q2. So I see a further improvement, the cost coming down. So with regard to credit cost for the year is 0.26, and we always remain range bound. Even if we talk about the entire 10 years after we converted to small finance bank, even I'm talking about the COVID period as well. So for the current fiscal also, our range which is we kept for ourselves is 0.15 to 0.25. I'm very confident we'll remain range bound with regard to the credit cost.
And wanted to understand on this front, the ECL norms which have been largely proposed and might be the final norms from the RBI side. What could be the impact of the same on your books?
Actually, still we are examining that, but from the preliminary, what our team has given us a feedback that we'll have a favorable impact. There will be no negative impact on us.
So you've guided for an ROA expansion to 1.6% by FY29. What is, can you break down the key drivers for us as to what will cause this expansion?
This expansion, of course, as said, the last financial was the reverse interest rate cycle. So more or less the rates are stable now. And as now the repricing of deposits will translate into expansion in NIM, but major expansion will come from the CD ratio. There was a good opportunity available for the retail deposits last year. Our advances have grown by 21% and deposits has also grown by 20%, and that also retail deposits. So there's the average CD ratio is around 81 to 82% for us. So still there's a ample legroom available to grow the CD ratio to mid or high 80s. So with the growth in CD ratio, another kicker will come to our margins and the NIM. So for, of course, there was a reduction in margins for the last year with the Q4 has improved. In Q3, the ROA was 1.6, which for Q4, it has improved to 1.33. And for the current fiscal, by keeping the entire scenario, which is quite bullish around, say, especially the geopolitical, by keeping all this in mind, I want to give a range bound of that. It will translate to 1.32, but our endeavor is to take to 1.4 in the current fiscal. And of course, improving it to 1.6, as you have rightly said, the guidance that we have already given for March 29.
One last question from my end. Your non-Punjab book has been growing quite significantly, almost 24% of your loan book, if I'm not wrong. Further plans of geographic expansion, and how is the asset quality and profitability in these new geographies as compared to your Punjab loan book?
Yeah, it's heartening to share that if we talk about all the business parameters, starting from, say, the deposits, advances, CASA, and even the quality book, the book outside Punjab is showing better results than the Punjab. Even the Punjab book is very good, I would say, but even outside Punjab, we have been able to replicate the same business model, which originally we were confined to very limited geography within the Punjab itself 10 years back when we were a local area bank. But now we are all over Punjab and in the new geographies, and more expansion going ahead is happening out of Punjab.
Right. Well, thank you, sir. Thank you for joining us and giving us the way forward for Capital Small Finance Bank. Moving on, before we go on to our next small cap stock, let's get in Sharad here to understand what's been buzzing on the F&O side. Sharad, a stellar recovery from the day's lowest point.
Well, yes, there's a good recovery coming in for both Sensex and BankX. Remember, there is a Sensex expiry at play also. Earlier, there was just only Infosys and Bajaj Finance in the green, but now we are seeing at least 7-8 companies in this green. But of course, the sell-off is definitely there for Ultratech. Eternal has actually moved up a bit. Tata Steel and HUL still sell-off pertains. Let's just have a look for the long build-up stocks, what's happening here. And of course, we are having Bajaj Auto on that news flow of buyback and emphasis also doing well in trade. Apart from that, the short build-up, we have Vari Energies and KFin Tech. There's a good profit booking happening in both of these counters as well. A weak set of numbers also coming in from KFin Tech. Let's look at the long unwinding names. KI Industries and PFC makes it to the list. Remember, the second straight day of big sell-off happening in PFC. And lastly, let's look at the short build-up. The stocks, I mean to say the short covering, this is your Motilal Oswal and Bajaj Finance. They're still holding it, and a good volume is coming, and a kind of a technical reversal is at play as well. So these are the important stocks which should be on your radar in the F&O space.
Sharad, thank you so much for getting us those details. But viewers, time to slip into a very, very short break, but we'll be addressing more small cap buzzers on the other side, so do stay tuned.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Reports with me, Gauri Dwivedi, weeknights on NDTV Profit.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm
Welcome back. You're watching Small Cap Buzzers here at NDTV Profit, and the next management that we're going to talk to is Baheti Recycling. This is an interesting play because they are into aluminium recycling, and to understand the business and how Q4 and FY26 has fared and what lies ahead for the company, we're joined by Yash Shah, who's the Joint Managing Director at Baheti Recycling, joining us now. Yash, thank you so much for taking out the time. Mahim, at the side, my first question to you is that Q4 has been exceptional for you. You have seen profit double almost. Just want to get a sense how sustainable are these numbers going forward as well. Do you think that this growth run rate is going to continue in FY27 as well?
Hi, good afternoon, everyone. So this H2 performance, the growth in H2 was a combination of demand and industry tailwinds because of the geopolitical tension. And we are quite sure that this is a sustainable EBITDA which we are working on. And we are working on very sustainable and consistent EBITDA margin, as you have seen an increment.
Just want to understand, Yash, here, considering the way aluminum prices have moved up, the way we are seeing, supply and demand gap in terms of aluminum, you being an aluminum recycling company, how much of a benefit has already been, kind of earned in this quarter, and going forward, what is the kind of growth, like the benefit that you see because of this entire, geopolitical uncertainty that we're seeing?
Ma'am, as you can see, the geopolitical tension has arrived in the month of March. So only in 1 month we have seen the increment in the prices of aluminum, and we have received the benefit only for the 1 month. So the actual benefit will come from Q1 of current financial year.
In FY26 is when you have started to, foray into cables and wires as well. Give us some perspective as to what's the plan to grow this segment, because it's one of those segments which is very competitive. But what are the growth plans here?
We are coming up with 25,000 tons plant capacity for aluminum wire rod to meet the increment demand of cable and conductor industries. And we'll phase our expansion in 2 phases, one with 12,500 tons and another with 12,500 tons. These 12,500 tons will be implemented from the month of Diwali in this current financial year.
Yash, in terms of your overall capacity utilizations, where are they at right now, and overall, where does this go in FY27?
If you see, ma'am, we are consistently putting up new capacity. If you compare it with the FY25 capacity, then we have run the plant at 80% capacity utilization, but we have increased our capacity to 38,000 tons in this financial year. In the previous financial year, in the month of Jan. So on that basis, we have utilized 60%, and if in FY27 we are targeting somewhere around 80% of 38,000 ton capacity utilization.
What is the order book looking like, Yash, right now?
We have an order book of already 200 crores in hands with us.
And what is the execution timeline like for this order book?
The execution timeline depend upon the client to client. It may be quarterly, half yearly, yearly, depending upon client to client.
Okay, so Yash, I want to understand, from a 500 odd crore in FY25, you've gone to 700 odd crore in FY26. What are the internal targets set for FY27 in terms of top line growth?
In terms of top line growth, we have internally targeted ourselves to achieve somewhere around 4 digit.
Okay, 4 digit is where you are aiming at. All right. In terms of inventory gains, are we going to see that further in H1 FY27 because of this aluminum shortage at play?
Well, see, we need to keep and operate a minimum or a optimum inventory level. So this inventory level is altogether different part. We are cover ourselves into buying and selling hedging facility. But you can see this this inventory gains in Q1 of the current financial year also.
Yash, in terms of your migration plans, if any, from SME to mainboard, any timelines in place? Are you planning to do that?
We have completed all the formalities, and will be putting up shortly the EGM notice to migrate ourselves and take the approval of the stakeholders. And most probably by the end of Q1, we'll migrate ourselves into mainboard.
In your presentation, you've mentioned that there's 5 acres of total land that you possess right now, of which 2.5 acres is still idle available. What are the plans with respect to that idle land that you have, capex plans going forward? And if yes, what's going to be the amount?
Yeah, our focus is completely on the aluminum wire rod project on that idle land, ma'am.
Okay, all right, got it. And what is the kind of capex that you're looking at for that particular plant?
20 to 25 crores.
And that will be completely via internal accruals?
Some part of term loan, and maximum part would be from the internal accruals.
Is there a defined ratio?
70-30 you can say, ma'am. 70 would be loan. Internal accrual, 30% would be term loan.
Got it, okay. In terms of operating margins, in the last 3 odd years, you've seen significant uptick in those margins from a 5% to now FY26 ending at around 8%. Give us a sense as to how margins will fare in the next 2 odd years, considering everything that you're doing in terms of growth, in terms of doing capex as well.
Well, the margins would remain in the same range. we have achieved an optimum margin. As you can see, we are the highest in the industry. We are working on 26,500 tons per ton of EBITDA. So we are the highest in the industry and will remain consistently on this margin, and will try to improve maximum margins.
Right, sir. Thank you, sir. Thank you for joining us and giving us the way forward for Baheti Recycling. Moving on to our next small cap stock, that is IRM Energy. Now, if you look at this counter, why we have selected this counter? Because the stock has nearly doubled in the last 1 month. Now, this is the gains that the company has reported is higher than any other stock in the Nifty 500. So what does this company do? It's a city gas distribution company which operates in 4 areas, has around 221 industrial customers. Apart from that, it has 463 commercial customers and nearly 80,700 domestic customers. It also has 127 CNG filing stations across those 4 geographical areas. Now, what is the outlook for this counter? It expects volume growth to be in the range of around 12 to 15%. It's better growth compared to what other listed companies are doing, but this is also because the penetration level is low in these 4 geographical areas, and hence this kind of growth is expected. It will also be spending close to 250 odd crore rupees in the next 1.5 years. And it might see some cost savings coming in because of the lower pipeline tariffs which was proposed by the PNGRB. But do remember that the near-term earnings could be on the weaker side, specifically for the 4th quarter and for the 1st quarter of FY27, largely owing to the gas shortage. Volumes could be lower, while gas sourcing cost could also be on the higher side for IRM Energy. Now, if you look at the valuations post this run-up that we have seen in the counter, the stock is now the most expensive compared to other state-owned city gas distribution companies. MGL, IGL and Gujarat Gas trade anywhere between 12 to 22 times, while IRM Energy is trading at a valuation 12-month forward PE of around 24 times. Now, what could have led to this rise in the share prices of IRM Energy? Firstly, the chance that, or the fact that the promoter has bought shares from the open market. Around 2.8 lakh shares were bought by the promoters of IRM Energy from the open market in April 2026, which is nearly 0.7% of the equity. And the second probability that analysts believe is the fact that the company is a good takeover candidate, given the fact that it's a very small size company. Still, the market capitalization is less than 1,500 crore rupees, and hence it could be a good takeover candidate by any larger player. So these potential are the 2 reasons why the stock might have run up so far in the month of April.
All right, so okay, that was of course the entire brief about IRM Energy, but the other counter that we're putting spotlight on is Ekiotech, if I'm pronouncing that correctly. The stock is up 1.5% as we speak. Of course, off from its day's high point, but we have Shivam joining by to give us a perspective on why the stock has been buzzing. Shivam, over to you.
Well, yes, the Ekiotech has been up 15% in last 2 sessions. But let's first get about the company's business. The company is operate as a original device manufacturer and as an electronic manufacturing services provider, where the main focus of the company is to manufacture LED lighting solutions, product display lighting, and diversified electronic products. Now, coming to the Q4 result, actually, this Q4 result is yet to be announced by the company and is scheduled for release on May 2nd. But if you look at the 9-month FY26 results, the revenue has seen a growth of 15%, whereas the EBITDA has declined by 4% to 52 crores. Now, this decline in EBITDA was due to increase in operational expenses as the company has operationalized its new manufacturing plant, and resultantly, we have seen a decline in PAT by 27% to stand at 24 crores. Margins stood at 12% versus 14.4% on YY basis. Now, the roadmap the company has made for the upcoming period is that the company is working on 4 fronts. So first one is the expanding in Gulf market and mainly in Dubai, where the company will export its product display units, and on initial stages the company has seen a good traction here. The company is also foraying into various new product categories such as hearables and wearables, and the company has set up a new plant of a greenfield project which spans over around 5 lakh square feet. And also the second block has been ready to start operationalizing activities. Now, last one, the focus of the company is on backward integration, which will aid them in their margins improvement and also the cost efficiency. Looking at the geographical revenue revenue split, currently the company generates around 79% of the revenue from India, whereas it generates 21% of revenue from outside India and mainly from US and Middle East.
Right, Shivam. Right. Well, thank you, Shivam. Thank you for all that information on IQ Tech. Well, with that, it's a wrap on this edition of Small Cap Buzzers. Stay tuned and keep watching NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel.
Hello and welcome to KYC. I am Sharad Dubey and you are watching NDTV Profit, where I get to the hottest companies which are buzzing in trade, and to get more details about it in our special segment KYC. But before that, let me give you a hint. Try to guess this company, and if you are from Mumbai, maybe you might have guessed this by now. It's a Mumbai-based realty and an EPC company. Interestingly, the company has secured a large deal in South Mumbai, or as we call it, Sobo. The stock is up 52% from March lows. That's the third hint for you. Try guessing the company, and of course the company is having other listed play as well. And the company's name in focus is Man Infra. This is the company which we are going to talk about. But why are we calling this company? क्या नया न्यूज़ आया है कि हमने इस कंपनी को बुलाया है? First question is definitely going to be a major announcement, acquiring the project in South Mumbai with a sales potential of 2,000 crore rupees. Now remember, this is the third important acquisition happening in this space, and of course we will ask the management about the key areas of expansion in Mumbai, and is there any alpha when it comes to the redevelopment of projects. That's an interesting area to look at. Another important question to be asked would be the progress for the key projects and the timelines in the residential segment, and the growth outlook ahead. Of course, we'll ask the EPC segment also, where the order book status and where does the alpha lies. The management has stated that they're going into the PMC business, and if the growth outlook improves, the margins also improve. Apart from this, also an important question to be asked for Man Infra is the new launch pipeline and the growth outlook for FY27. That is something we'll be asking for. And of course, the raw material prices, the construction cost, have they gone up because of rising oil price? That's a key area to ask. But to give entire perspective, we'll join in by Manan Shah, the Managing Director of MICL Group, where he'll give us the entire strategic viewpoint of the company and the industry as a whole. But let's try to understand MICL karti kya hai? Man Infra. Of course, there are two sides of businesses. One is the EPC business and another is the real estate business. They're already there more than 60 years in this industry as well. But the real estate portion, that is where the value is coming. It's of course helmed by Manan. The company has expanded in this segment and also is going global. There is Miami, Florida and other places in US where they are having their projects, multiple major ports. That's the EPC business. That's the old business, the legacy business as I call it. It's there in Navi Mumbai, Chennai, Gujarat and Kochi. So definitely there are two levers of growth coming for this company. Now they are also building one of the tallest residential towers. It's called Aradhya Awan. It's in Tardeo. It's in the South Mumbai district, and that is where the street is trying to understand how big this project can get. Of course, remember, company works in an asset-light model like a JD or a JV, that's joint development or joint venture, and that makes sense as well. MICL Group has recently acquired its third residential project in South Mumbai, and that's what we're going to talk about. These are the important recent announcements, and the sales potential would be roughly 2,000 crore rupees for the next 4 to 5 years. लेकिन साउथ बॉम्बे में तीसरा काम उन्होंने उठाया है. The projects, the names are Aradhya Awan project, that's at Tardeo. The second one is of course the culmination of 3 projects, and the total value comes in at roughly, you could say, 8,000 crore rupees is the Tardeo 2.0 project, and this is the expected value. This is the 5.75 million square feet. That's what the company has stated in the exchange filing. Now they recently received a 512 crore fundraise also via the preferential route, of course, for the working capital and the expansion plans as well. Let's talk about the 9-month FY26 numbers. आंकड़े क्या कहते हैं? 711 crores worth of collections. When you judge a real estate or an infra company, collections matter more than revenue recognition. Almost 4 lakh square feet sales led by projects in Tardeo, BKC, Ville Parle and Dahisar. These are the places in the Mumbai metropolitan region. Company is largely net debt free at consolidated level, and this is a very positive point for an infra real estate company. The portfolio, let's look at it. It's roughly 3.8 million square feet of ongoing residential projects, and if you look at the realty business also, that's around 4.9 million square feet of carpet area, to put that in perspective. So we spoke about the portfolio, we spoke about the 9-month numbers and about the company. But why is Man Infra in sweet spot? As per my analysis, higher collections and realizations are likely in FY27, especially from their expensive premium projects. Another important reason for Man Infra being in sweet spot is company is largely debt free. I spoke about the net debt angle. Also, let's talk about the third important reason is the strong volume buying has been seen amongst HNIs and DIs over the last 1 month. So yes, smart money is moving in this counter because there was a massive sell-off. Valuations are still very much attractive, and I'll explain you the important price to book ratios to track for this counter. And apart from this, there is an important segment, the premium segment, the ultra luxury portfolio as we call it, near the western suburbs. That is where the alpha lies for most of the developers, and we have heard that. So this is the reason why Man Infra is in a sweet spot. But let's understand the company a little bit more. But before that, there are some rules in KYC, and we follow them thoroughly for every company. These are the rating parameters we give to the company. This includes income statement, balance sheet, cash flow. These are the core numbers to look at. Also the return ratios, how that has panned out over a period of time. Let's get in the shareholding. Let's get in the street cred. It's one of the favorite segments where we understand पैसा कितना बना investors का, छोटे समय पे, medium समय पे और long term. Valuations, we'll compare that with the history of the company itself and the outlook ahead. This is very much important because future is something where the discounting happens for the share price. Let's talk about income statement to start with, and let's see what's happened here. And largely we say the 3-year CAGR numbers are in single digit, not much happening here on a long term basis. There is a little bit of lumpiness also comes in because you have these businesses, and collections and receivables is always a tough fight for any real estate or a EPC player. but the numbers also, the Q3 numbers were also not that great. They had seen some kind of lumpiness. Maybe the fourth quarter generally is a strong quarter for the real estate and these EPC companies for a lot of new work, so maybe we might see a good up move in those numbers as well. But net looking at the margin trajectory, that has been good and they have maintained that self. And remember that JV angle is there, and because of that the operational margins do well, and they are concentrated in Mumbai, and remember land is very limited here, so that is something to watch out for as well. So net let's give a neutral rating when it comes to the income statement. The second reason is balance sheet, and this is what I like about a player like them. The net debt is roughly zero, and the borrowings, just look at the amount, it's just like a working capital as just at the lower side, and that is where the street finds comfort. And they recently did a fundraise also where a promoter stake was diluted, but nevertheless the momentum seems good. Of course the cash balances are very volatile because it's the nature of the business, but net looking at the debt ratios and a good servicing is a strong thumbs up when it comes to the balance sheet. So we discussed income statement, we discussed balance sheet, but let's talk about cash flow. What's happening here? And of course cash flow is largely, we can see a neutral kind of an approach coming in. There seems to be a downtick in FY25, but 9-month FY26 numbers are improving, and also the operation to cash PAT flow, that has also been decent here. But net for a business model like this, let's take a benefit of doubt in our analysis and give a neutral rating for the cash flow segment. Let's get into the return ratios part. I explained you the margins earlier, and remember the company is also holding its ROC numbers quite strong. For a company like that, having 20% plus ROC is something which is strong, but there is of course a concern. It is slightly falling down, and it depends on the seasonality aspect also, and if the collections start improving, which is expected in FY27, this might come back to that 28 to 30 mark. So let's give it a neutral rating for return ratios as well. Let's talk about shareholding. What has happened? I had mentioned you that the promoter stake will fall down because of the fundraise which has happened. There was a pref and a warrant conversion also, and that is why you are seeing this promoter stake falling to 62%. But interestingly, FIs have still holding their faith in the company. They are having 4% stake, and same thing for DIs, whatever this exposure is. So net it's a neutral rating when it comes to the shareholding aspect. Let's talk about street cred. कि stock में कमाई कितना हुआ, that's the most important thing to talk about. And remember, from the lows in 2026 itself, we have seen the stock going up 52%, but remember there has been a correction also. From 2025 highs, the stock is down 37%. And congratulations if you're holding the stock for long term. Last 5 years you have made 354%. So to balance things out, I'm going to give this a neutral rating. Let's talk about the valuations. So what happens, and this is where I feel there are the attractive valuations. Are there 5-year peak valuations? The price to book ratio जो हम लेते हैं वो 8 गुना था. Right now you see it's just at almost 2.5 times. Why? Because the average of these valuations is also at 4.3 times. That means it's grossly undervalued as per its own history. This is the price to book ratio I'm talking about. So it's a strong thumbs up when it comes to the valuations for MAN Infra. Let's talk about the outlook and see what happens. Of course, they're expanding in South Mumbai area for the realty projects. This is a very prime real estate of India for the folks who don't stay in Mumbai. Also, the company is in talks with redevelopment proposals in the Mumbai metropolitan region. That's also the company is looking out for. Of course, the focus mainly is in real estate, but they do have their old legacy businesses like in the EPC also. The company is doing ongoing international expansion projects in US also. That's a pretty much interesting trigger for the stock. And apart from that, of course, going ahead, let's talk about the revenue visibility and the order book also, where the numbers are very much important. The EPC order book is at 300 crore as on December 2025. We'll get the updated numbers once the company comes out with its Q4 numbers. And look at the revenue visibility, 11,600 crore plus for the real estate sales business, and of course a major chunk of it expected to come from South Mumbai projects. So an outlook, is very positive for here. But let's do the revision of the ratings which we are giving MAN Infra in our KYC show. Let's see what are the key triggers, and largely balance sheet has been decent. Most of the parameters have been neutral. And if you take a more perspective when it comes to the shareholding in Streetcred, they are neutral, but valuations are attractive, and so is the outlook. And that is where further alpha could be there. And that is why I've taken out the main reasons why the company is in sweet spot. Let's give in the total addition of the KYC ratings. Number kitna banta hai? It's around 5.5 out of it. It's largely in line to positive on the average of the KYC numbers which we generally give out to. But to understand more and get in more perspective on MAN Infra, we'll be joined in by Manan Shah. He's the managing director of MICL Group, and there are some interesting snippets about him. And remember, he has taken the company over in 2013 itself, and the real estate business, what we are talking about, that is where he has founded it, and he has scaled it to, of course, a bigger heights as well. And interestingly, he became the MD in the year 2019. That's the date to look at, and that is it. A young dynamic promoter and interesting company, especially with the real estate segment. And joining us, we are having Manan Shah. He's the managing director at MICL Group. Manan, it's always a pleasure to have you here. A very important announcement coming in for South Mumbai. This is a third announcement coming in. Just could you give us some more details about it? What's the revenue potential, and what do you think about this entire area and your group's focus on?
Good morning. See, this is the further penetration in the South Mumbai market, especially in Mumbai, where Sobo ideally commands the main, the premium segment and commands the luxury segment. We had the first project, Aradhya Avan, which we had acquired a couple of years back. Then we had the Marine Lines project, and now we are expanding in Tartev as a region. And this project is, intended to start in like next couple of months. We've done the DA basically, and now we intend to launch it in this financial year itself. Things are moving very, very positively in terms of the permissions have already been applied for, and we would soon start breaking ground as well. Regarding the numbers, we are seeing a top line of around 2,000 crores coming in from this project itself, and the total consolidated portfolio of South Mumbai would now become 8,000 crore out of the entire 11,000 crore projection that you mentioned.
It's a very interesting take, and Manan, you are taking the cream of real estate, and of course, as a Mumbai, real estate developer, that is something which we have seen in Sobo. But just wanted to understand the industry perspective. How does the Sobo realty market different from Gurgaon? Of course, it seems like it's less speculative. Also, just wanted to take your industry view also on that.
If you have always seen Mumbai specifically as a location, Mumbai's South Mumbai side has always been in high demand because of the oceanic views, because of the gentry that's been residing there for not just 5 years, 10 years. In fact, if you see the past 50 years track record, South Mumbai has always been like a dream destination for a lot of people across the country. That's the reason MICL is specifically focused on South Mumbai to become one of their pioneer locations where we would be expanding further. We have almost bid for more than 5 projects over and above this, which is on the discussion stage with multiple different societies. And we are seeing very positive signs coming in from societies because the kind of iconic buildings that MICL is doing with the kind of intention and the response that we've received from customers is phenomenal. So I think South Mumbai would definitely be in focus. Alongside Mumbai, if you see how it's different, it's mainly different because of luxury being offered. That's the most important factor. So the sizes of the apartments are significantly larger is what we've always been seeing compared to the rest of the city. So, and South Mumbai is one of the few locations where you get beautiful sea views from the higher floors, and sometimes you are like on the ocean front line also. So that is what is creating that surge in demand to move towards Sobo.
Right, of course, it's an aspirational play, and we have seen that all your 3 properties or 3 projects are expecting 8,000 crore of gross development value. But other than that, other key areas of expansion in Mumbai, and I just want to take that redevelopment angle also. There has been projects across this segment. What are the growth plans looking like for that for FY27?
See, we are standing at approximately around 5.2 million square feet of RERA carpet area portfolio. with the current discussions going on, I'm very, very confident that we would be nearly reaching around 7.5 to 8 million square feet in the next upcoming year. And we've kept a vision 2030 in mindset where we are looking at a 20 million portfolio coming in very comfortably across Mumbai city, which includes the US division as well. And right from South Mumbai to western suburbs like Ville Parle, we've been operating. We're operating at Dahisar, Ghatkopar East, we've been operating. We've recently launched a project at BKC, and we're soon going to launch a Pali Hill project also. That is also part of our ultra luxury portfolio. And there are a few more projects under discussion which are almost on the final pipelines, which hopefully we'll be announcing it soon.
Okay, so we'll be announcing, expansions in the Mumbai metropolitan region as well. But just to understand a little bit, Manan, we have spoke about the crude going up almost $120 per barrel right now, and definitely over the last 2 to 3 odd months across the infra space and realty space, there are talks of rise in construction costs. There are of course second order effects coming in. Are you feeling that pinch also? Is the industry feeling that? Just industry perspective I don't want any numbers right now. Q4 is a silent period, I respect that, but Manan, what's the ground reality here?
See, yes, definitely the industry is feeling the pinch right now, but if you see the contribution of that pinch on the overall project cost, it's not even 4 to 5%. So it's frankly, it's negligible. And this curve will also decline soon with situations, becoming better. The temperament of the consumers have also changed a lot. People are now much more positive. In fact, the travel towards UAE has also happened, which is a big significant sign that people have confidence that the war is actually stopped. There's a ceasefire which has happened since a couple of days, and hopefully it would sustain. So I think the prices of the construction materials would also go down significantly, because these kind of sharp curves we'd seen during COVID also, which I recollect that post-COVID, the steel had shot up, aluminium had shot up. So now I think it's a similar time. It's just a couple of months which, the developers are bearing it. But I think every developer is taking it very, very comfortably because everyone's cash flows are healthy, and I'm seeing industry being still more positive. And especially India as an economy is much more on the positive side compared to the rest of the world, which is a big positive sign for real estate guys.
Right, but there seems to be one more positive for the Mumbai developers, and I was just checking with my friends, especially the broker friends, regarding, there is a little bit of stoppage in the real estate properties in the Middle East, especially Dubai, and a lot of buyers come from Mumbai itself. Now, are we seeing that trend a little bit of reversing and, coming back to the luxury projects in Mumbai as well? We have seen some good data coming in from Worli also. So Manan, your views on that? Any new inquiries coming in rather than, buying properties in Dubai right now? Has inquiries picked up for South Bombay?
See, all the people who had made money selling gold in past couple of years or made money in stock market, a lot of times they tend to invest in real estate. Dubai was definitely a lot more attractive market because they had all of these 2%, 5% payment schemes which had come in. But with this war situation, people have realized that, like you exactly said, your broker friends have been speaking to you, that investing in your own country is a lot more safer bet compared to, like in outside countries. So I feel that sentiments will continue positively. Even we've received a lot more attraction. In fact, we've been getting a lot of calls in the past 15, 20 days from a lot of brokers, especially the NRI brokers who are focusing on selling UAE or Singapore properties, that they're looking for some luxury portfolio. Even people who are residing in Dubai are wanting to pick up a lot of stock in Mumbai.
Oh, that's pretty much interesting. So the demand, Manan, is coming from NRIs also, and is it coming from other nationals who are generally investing in Dubai?
It's both. So usually what happens, any Indian real estate company who's gone international focuses on Singapore, focuses on Hong Kong, focuses on UAE, and US to some bit of an extent. Now, these people who have been selling multiple properties in those local regions are seeing Mumbai also as a location, because Mumbai has always been an aspirational city and comes in the top 10 in the world in terms of, luxury, oceanic views, and one of the best livable cities. So that is one of the reasons which is attracting consumers, and people have seen the appreciation on the price in the past 3 years. So they are more confident on the price surge also happening, where investors would come back into India and be investing more.
Right. I'll just take a little bit of gears and I'll shift that. Manan, EPC business is also a part of your, portfolio in your company. I just wanted to understand, because you have been doing a lot of port-related work, and the way the government is pushing the port infrastructure, the port economy, especially seeing the current geopolitical situations. How is your company placed in this EPC business, and likely that larger orders will start flowing in, at least for the port segment, because you have a specialization in that. I just saw the history of your family and your business. Just wanted to understand, Manan, how is that shaping up for the company?
So there are two aspects to EPC. We've ancestry been an EPC company. I diversified into real estate barely around 12, 13 years back. So port has always been a pioneer division, and we are one of the only few companies who's done and worked upon more than 8 private ports. We are currently also working on at Nhava Sheva. The port is going on, and the delivery is expected to be soon. And with the boost in the port industry, the kind of Vadwan also coming up, it's a next 10 years, 15 years vision. Company has already eyes on that. We are very aggressive in terms of the tenders being coming out and pitching and bidding for it. And the other aspect regarding, apart from port, is our own real estate division. So we work on our own real estate projects also. And with the 2030 vision, I'm seeing at least nothing less than 35 to 40 million square feet of construction area coming up, which indirectly or directly would hit the EPC division for us.
Right. We spoke about the EPC division also, and Manan, just to give that in perspective, what's the business cycle like for the EPC business? I think the real estate business cycle or the payment cycle is much favorable, and that's of course aiding your company also when I do the SOTP valuation for both of these businesses. But for the EPC businesses, are there any overhangs at times, or the long gestation periods are there? How is that business changed, what was earlier there and now what you are seeing as a second gen entrepreneur?
So earlier we used to work across segments, right? From ports to industrial estates to other real estate developers. What we've now significantly moved out in the EPC is we do not work for other developers, just as an EPC contractor. So a lot of cash flow control is absolutely in our hands because we work for our own projects. And the other side where we're working for ports or good infrastructure projects, that is something where the margins are also better, and we've got good payment clients, so there is no delay per se. So that's a very specific call which we've taken forward, where we do not intend to work with clients who are not being able to pay me on time, and eventually the margins comparative to real estate in EPC is a lot lesser. So we do not intend to work for other developers at the moment. That's what the principal call has been taken. We will work for our own projects, but regarding good infrastructure jobs and where there are good clients, we would definitely be bidding for those.
Right. Manan, the focus of course EPC is pan-India, which MISCL group does, but the real estate totally focusing on Mumbai side and the Mumbai metropolitan region. Anything outside this? Are you looking at any tier 2, tier 3 cities, land plotted developments? That's also become the flavor, especially for the HNIs in this tier 2, tier 3 cities. Are you looking at some of those ideas also? Because you recently did a fundraise also, which of course, you're using it in your current purposes as disclosed. But Manan, anything else apart from Mumbai in real estate? And of course, the US expansion is there that you had mentioned a little bit. So you can just give us a view on both of them.
So most specific thing which we intend to follow is we've always been a healthy bottom line making company. So if you see, my profit margins have been consistent across years. Even during our EPC days, the margins were, compared to normal industry standards, much better. Even right now in real estate, like we are upwards of 25%. So in Mumbai, a lot of times it happens that my per square feet margin is not even the sale price in these other cities. So I would want to not just create unnecessary volumes. I would like to create better profit margins. And that's the reason the main focus has always been Mumbai as a developer. Regarding second homes, plotted developments, I have seen always curves happening that sometimes it's the flavor of the month and sometimes it's not. And this is a very speculative market to enter. A lot of competition has already been there. I've seen competitive developers buying 500-acre land and 1,000-acre land, but the income is nearly 8 years, 10 years down the line. So the company does not intend to focus something so long term that I cannot encash on it in the next couple of years. So that is the reason we've been away from plotted developments. But nevertheless, we've been businessmen. If the opportunity is great and if there's some other city which is performing significantly well, MIC would definitely intend to move to other locations as well.
Fair enough. We'll keep it at that. But yes, profitability is important, so is growth, and that's what Manan has stated with us. Manan, it's always a pleasure to talk with you, and thank you very much for coming in KYC, and best of luck for the future. Well, that's the promoter Manan Shah of Manan Infra talking about importance of realty in South Mumbai and the growth prospects ahead, especially for the EPC business and the residential business. For interesting companies like this, tune into KYC only at NDTV Profit.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market opening, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight.
Welcome, you're watching India Market Close, and as bad as this screen looks, it's actually a good one. This is recovery that you're seeing. 166 points down on the Nifty is better than it's been through most parts of the day. Advanced decline ratio has been negative, and a few factors that are weighing down on the markets. Alex, I would say crude, rupee, that deadly cocktail on top of the mind, because crude spot price is above 112, June futures at 122, thereabouts. Rupee at 95, it's not something the street is going to like.
No, none of those things. And also, let's not forget, of course, we're heading towards a long weekend. And if there's one thing that the street is allergic to, it is uncertainty. It certainly does not want to take over positions for a weekend when one tweet can change the narrative completely. So intraday chart of the Nifty 50 will showcase what Tamanna was talking about, because we have climbed quite considerably from the low point of the day. We're still losing about 150 points, but it's a significantly better picture than what we were talking about. Before we get to the other aspects of the market, I do want to pull up the India rupee, because this is going to be a talking point certainly as we go through the show. It is off the low point of the day, and remember the chart is flipped, so that is actually not a good thing. The higher you go, the worse it is. 95.12 is where we are at, and this is likely heading towards a closing low.
You know, I was seeing a figure today that in the last 4 months, FIIs have sold more than they did in the entire year earlier.
2025.
And there is this really no reason for them to come back with this kind of combination. Let's pull up the Nifty heat map for you and see what's holding on this afternoon and what's not. Now, on the winning side, Bajaj Auto, very smart recovery over there. Sun Pharma coming to the fore. IT Pack is surviving. IT Pack is actually doing okay today. So Infosys, Tech Mahindra, HCL Tech, that whole line is fine. Bajaj Finance actually pretty decent numbers, and that's coming through. HUL had an okay set of numbers, but there's again concern with the entire FMCG pack. The question is that can you really continue to move forward? Tata Motors PV taking a knock today, as is Adani Ports, Eternal, HUL. We talked to you about HUL. We heard from the management. The numbers were out today, and the numbers were largely in line. But again, that question about how the impact twofold: one of high crude prices on packaging costs and raw materials, and the other demand getting pressed down. That's also going to come in. So overall, it's looking fairly tough. Nifty contributors, if we can, and really the only saving grace is coming from your IT pack. Infosys there, 12 points up in pulling up the Nifty. Bajaj Auto as well, while ICICI Bank, L&T, SBI, Axis Bank, all of your banks are down today.
I do also want to pull up the sectoral indices, because that will complete the picture, and you'll see a lot of red on the screen, perhaps less than morning, only to the extent of the pharmaceutical index popping into the green. But you have metal, you have PSU banks, you have the entire banking pack. I'm looking for the Nifty bank, it won't be too far away.
Yeah.
The private banks have actually recovered from the low point. So there's something there, down only about 0.7%, but the PSU banking index has been a laggard just throughout this week. And that continues to be the case. It's not even earnings that is turning the tide for these guys, because ultimately they are seeing those treasury losses, and the NIM deceleration is evident in a few cases. The question is, has that bottom been hit? And you can't say that, which is why some of the confidence that had emerged earlier on the BFSI pack seems to be dissipating a tad bit.
Yeah, and I think if you want to add one more factor that is maybe not making the markets break out or giving them that much confidence, is that the confusion about the outcome of the 5-state polls. And a short while ago, we had the story about how one of the leading pollsters, My Axis India, has decided not to release its data for phase 2, because they say that 60% of the respondents are not giving them an answer of who they voted for.
Wow.
So if you have just 4 out of 10 telling you who you voted for, you have bad data. And the fact that the voters keeping everyone guessing, I think is quite interesting to actually see. Let's look at the advanced decline ratio and that line graph through the day, and what that is telling you. And yeah, you have the declines quite above. This gap is actually narrowed a bit, and let's see if it continues to do so. So here's what's been happening in the markets. Market recovery is at play, at least in the last half hour, 1 hour or so. The Nifty and the Bank Nifty both are responding. Nifty support at 23,800 to 23,900. The Bank Nifty support at 54,500 to 55,500. The IT pack is holding strength among sectors, even as the rupee hits a record low. That's positive directly for IT because they bill in dollars. Brent crude is at more than 120 per barrel, and investors want to avoid carrying over trade for the long weekend. State election results are on Monday, market holiday is tomorrow, so all of that is also adding to some of the nervousness. I wonder if we could quickly pull up the Brent before we get to our conversation with Jay Bala, founder and chief market technician at Cash the Chaos. There you have it. This is the Brent June futures. Remember, it's not the spot price. That's at 121.75. That's uncomfortable. Jay Bala, for the Nifty, do you see enough strength there to go long for someone who has faith that when this is all over, you will see a rebound and they may have missed the last lot of that opportunity?
That's right, Tamanna. I'm from a medium-term perspective, the markets are bullish, and even from the short term, the markets have a very limited downside. I would anticipating the markets to print somewhere about 23,500 and then recover. The April low is very comfortably sealed, and I don't think the markets are going below it. So my 29,000 objective for the Nifty is still on the cards, and that's I would anticipate the markets to be trading at around 29,000 somewhere about August to September 2026. So I'm bullish on the market. So dips are, in my opinion, buying opportunity.
Let's talk about individual stocks as well, Jay, and good afternoon to you. What's looking good?
Hi, Alex. The best space to be there is the capital goods space. I'm anticipating the Nifty capital goods, BSE capital goods index to scale somewhere about 99,000 from a 3 to 6 months perspective. Your Siemens's, ABB, Thermax, all are in a very good space. And if you want a fresh bet, I would go with something like RR Cables. It's breaking out of an inverse head and shoulders pattern on the weekly time frame. So with a stop loss at about 1398, I would expect the stock to scale fresh record highs closer to 1900 plus. And you also like Wari Energy. So that's also looking good from the capital goods space.
One of the big talking points amidst this conflict has been physical availability of crude oil. Because from India's perspective, considering its dependence on imports, with a major line closed, that is the Hormuz Strait, the question is, how does India source its energy, and specifically crude oil? A report by Kepler suggesting that alternative sources are indeed coming through. In fact, the latest report is that 11.8 million barrels of crude, which amounts to 2 days of India's consumption, is on the way from Venezuela, and it's coming through around the port, the Cape of Good Hope, and into India. We're joined by the lead analyst of Kepler, who is Sumit Ritolia, just to give us a sense of what this means and whether this has been happening for some time and whether it's likely to build going forward as well. Sumit, thanks so much for taking the time. Alternative sources were expected to pan out. This is a suggestion that is taking place. What can you tell us about how important this is and whether other alternative routes also exist?
Yeah, I think that's a good question. And it's not new that India is diversifying, like being dependent 90% of our energy requirement of crude. Like India has been diversifying from quite a few years. And given now the situation around Strait of Hormuz, diversification is very important. And as you pointed out, Venezuela, it's a welcome move, I think. And if you look at our data also, Venezuelan crude import, India used to import around 300, 400 KBD. And as of now, what we are tracking in May and April, we might be at 6 years high of Venezuelan crude import. But that said, overall import has dipped, like we see around 15 to 17% of dip, like what India was importing around 5 million barrels per day, 5 to 5.2. As of now, we are importing just around 4.2 to 4.4 million barrels a day of crude. But yeah, I think India has stepped up imports via Russia, Venezuela, and even if you look at overall volumes from Saudi Arabia and UAE, like given the dip what we have seen in March, like April volumes are more or in line with what India used to import, given Saudi is loading their crude oil from Yanbu, that is their east to west pipeline, and UAE from Fujairah.
Sumit, just to understand about this lot of oil making its way from Venezuela via the Cape of Good Hope, would this have been a response to what we've seen with the Strait of Hormuz being closed? Would this have been orders placed earlier? And what is the feasibility really of Venezuelan oil from an Indian perspective, both in terms of the quality and nature of that oil and the distance it takes to reach us?
Yeah, that's a good point. And I think it's a mix of both. India was engaging with Venezuelan producers and the different traders pre-war also. Like if you look at like whatever India is importing in April and whatever India imported in March, that's not of any result with respect to what Strait of Hormuz has happened. Deal would have closed already in February. And given the voyage time, how much Venezuelan crude takes to come off to India, it takes around 35 to 40 days depending on the ships and all. So yeah, it's a mix of both. And talking about Venezuelan crude mix and what it is, I think Indian refiners are well complex, and it's one of the difficult crude they out there in globally, like, and not much of all the refineries can process it. So whatever India is getting reduced from Iraq, that again in Middle East, Iraqi crudes are one of the heaviest around, apart from Iran. India doesn't buy anything from Iran, so this is a good replacement, like replacement, as Iraqi crudes have dipped a lot. I think India didn't import any in April, and Venezuelan crude import has stepped up. So yeah.
Sumit, the other question you mentioned that the kind of imports in April have gone up, right? And the question is, what is the mix as things stand right now? And is it likely to shift further? You spoke about the fact that diversification was at play already. These are things that will only accelerate going forward. So what are the sources and what are the routes that are going to be most predominant in this mix in the near term and then potentially in the medium term?
Russian crude is one of the very important strategically, economically, and more of it politically also. Like given the situation, we have been hearing about some dryouts in some places of India, and if you look at how much India has been importing, Russian crude stands out at around 30 to 35%. It's the core center, and given past history, even at the extreme pressure of US, like January and February, Russian crude was the core center of India's diet. So in the near term, in the short, even in the long term, I think Russian crude will remain at the central part. And apart from that, Venezuelan crude reopening in India's refining mix, it's a welcome move. I think that gives more caution to diversify from Middle East, like since these cargoes and the route is not via Strait of Hormuz. So yeah, again, Russian crude, Venezuelan crude, even US crude, I think is one of the factor. But given India's refining mix requirement, it doesn't suit that much. So yeah, I think apart from Middle East, Russian crude, Venezuelan crude, Atlantic Basin, African crude, yeah, they have stepped up well, and that is one of the reasons why I said diversified was already in the mix, and now with whatever the situation around.
Sumit, if we're just doing the broad math, if I have to look at how much of India's crude supply got impacted because of the shutting of the Strait of Hormuz, and how much we've managed to diversify, have we made up for everything that was lost or impacted?
No. I think we are still short by around 800 kbd to 900 kbd. India is not importing anything from Iraq, so that has been lost.
So put that in percentage terms, just to give us perspective. How much of our total volume?
15 to 17%.
So we're still 15 to 17% short of what we require. And is there a clear alternative to this crude being available?
I don't think so as of now. Globally, if you like, around 15 million barrels a day of crude is short in terms of Strait of Hormuz getting choked. I think Indian refiners have been doing their best, whatever they can. And one of the important factor to note is that India is one of the largest exporter of refined product. So whatever we need in terms of refining, we are more than what we consume domestically also.
Okay. So that becomes a question. Now we're going to have to start squeezing in on some of those exports, etc. So Sumit, sorry, one more question. From an Indian perspective, is there any concern or fear that we run out of crude supplies anytime soon?
No, not at all. I don't think so. even at the height of the war, there was not any concern in terms of our understanding that India is sort of refined product. Not at all. I think India's crude strategy, India's crude volume, refiners are well equipped, even with whatever storage capacities we have. There is not an issue we are seeing in terms of refined product shortages and crude oil shortages for the refining. Yeah, we might not be at 100%, but our requirement for domestic was never 100%. We used to consume around 85 to 90% whatever we refine.
All right, Sumit, absolute pleasure speaking with you, and thanks so much for that clarity of thought. It helps us as well put things in perspective.
Yeah, thank you.
All right, let's talk about NALCO and earnings front and center, because you're seeing the reaction play out. This is, of course, the first cut we're getting you off the NALCO numbers. The PAT number coming in at 7.3% higher, 1,718 crore rupees. The revenue is seeing an uptick of about 6%. The EBITDA has also grown by about 7.4%. These are all sequential numbers that we're talking about. The margins coming in slightly higher at 46.8% compared with 46.6%, 46.1%. More than anything else, I think this is likely to be a situation where it's missing the estimates on a couple of those factors. Pull up the intraday chart for NALCO and you will see that it's dropped quite precipitously from where it was, now trading with cuts of about 6% as well. We've got Sameer Dalal of Natvarlal and Sons Stockbrokers joining us right now. Sameer, thanks so much for taking the time. On NALCO specifically, it's seen a pretty sharp drop on those numbers, and the numbers flashing on the screen, I've just read them out as well. If you've looked at these, what seems to be the reason why the street is disappointed?
I actually haven't looked at the numbers, so I mean, to comment on the numbers would not be right. Having said that, everyone's been talking about the fact that the aluminum and alumina prices have been rising. Now, I know NALCO does a lot of exports and a lot of sale of alumina. And because of the aluminium refineries in the Middle East probably being shut, it could have impacted their last month's sales with shipments and payments or whatever and delays. So it could be because of that, but I don't have an answer because I haven't seen the numbers.
Sameer, we'll come to you for more on what you're expecting in the markets, but I want to just talk about and to Enviro Infra. They're a leading player in the water and waste treatment sector through their subsidiary EIE Renewables has entered into a share purchase agreement to acquire controlling stake in Suyog Urja Limited. That's a wind energy EPC company. Manish Jain, MD of Enviro Infra, is with us to talk more about this development. Mr. Jain, thank you so much for your time. Tell us about this stake in Suyog Urja Limited, the cost of it and the strategic importance for you.
Good afternoon and thanks for having me. The acquisition of Suyog, it is a strategic step and it aligns with the vision of the company in developing itself across the various sustainable segments. We started this renewable company in around 1 year back, and within a year, we have developed ourselves across 3 verticals of the renewables, which is solar, BESS, and wind. So basically, we are aligning all these segments so that we can further move on for the hybrid solutions in the renewable segment.
What is the timeline for integration, sir, with regard to this this agreement that you've signed? So it's a share purchase agreement. When will the transaction be completed, and what is the integration plan?
51% of the shares have been acquired already. This acquisition has happened yesterday, and the balance 49% that will be acquired over a period of 2 years. So there will be 2 components. A part will be purchased in the next financial year after the performance in FY27, and then the rest of the portion will be acquired in FY28. So this is how the acquisition will get completed.
Mr. Jain, also talk to us about how this is going to be funded, both the initial tranche that you've signed yesterday and the remaining stake.
The total deal size as we envisage is 3,311 crore rupees, and the first tranche is 111 crore. The entire deal is going to be funded with composition of equity and debt in 50%. And so we'll be going for a debt of somewhere around 55 crore for the first tranche, and similar will be what will be through equity and the internal funds of EIE Renewables. The best part of it is we had invested 75 crore from Enviro Infra in EIE Renewables, and we still maintain that level. And there is no further investment which is further happening from Enviro Infra to EIE Renewables. It is from the internal resources of EIE Renewables only.
Okay. And so at the peak, once you've taken on as much debt as you need to complete this transaction, what will the gearing levels be? What will the ratios be?
It can be slightly heavier as we say renewables. The total debt size as we envisage will look like somewhere around 400 crores. And the total investment in form of equity and CCDs was 120 odd crores so the profit margins which may get added. So 200 crore can be the equity size which may look in the FY27 balance sheet, and 400 crores. So it will be 2:1 that which can be the debt to equity.
Okay. And so therefore, if you are to look forward, Mr. Jain, and just give us a sense once the entire integration takes place, and you're talking about now 2 financial years, right? So how will the group then look? What will the revenue profile look like if you were to talk about, say, in the 3rd year when you've completely consolidated? What is the plan?
So we look forward to this segment as a consolidation of renewables with solar, wind, and BESS. Right now, I do have an EPC order book of 1,000 crore plus from the BESS segment, which is its EPC. And then another 150 odd crores, which is an IPP, which we have acquired recently. Apart from this wind EPC segment order book is somewhere around 650 odd crores. So if I say a revenue of somewhere around 800 crore is what we are expecting in the current financial year, and a growth trajectory basically for the first 2 years, the trajectory will be means the sales growth will look quite high, and then it will get stabilized. So I can look forward maybe to a revenue of around 800 crore and then 1200 crore for FY28. So this is how the entire integration would look like. There are a lot of opportunities which are now available in the wind segment. The BESS segment is also growing. So basically, this is how we look that the entire integration will happen and we can grow in totality in the renewable space.
Got it, Mr. Jain. All right, wish you all the best for that transaction and indeed the path that you've laid forward. Thank you so much for speaking to us.
Thanks a lot.
All right, let's talk about the other stocks that you should keep on your radar, and particularly in this segment that you probably look forward to. It's heard on the street. And Soumit Sarkar joining in to tell us just that, what he's hearing on the street. Soumit, market's a little bit cautious ahead of the long weekend, but what are the individual stocks you're hearing about?
Actually, not much of an action that we are seeing in dealing rooms today, given the fact that it's a long weekend and state election outcomes are expected on Monday. So traders are keeping their position light. They're not going in heavily long or heavily short on any of the stocks or index. Now, apart from that, even if you look at the volumes, they are quite muted in trade today. Volumes are in fact down nearly 2% compared to what we had seen the previous day. Now, despite this, dealers have given some stock-specific ideas or actions that we are seeing. Firstly, on MCX, dealers indicate that there are some sell flows coming in on the large HNI desk on this counter. Dealers indicate that the premium value has fallen sharply for MCX in the month of April, and this could mean to lower revenue for MCX in the first quarter of FY27. Apart from that, it's Crompton where they are seeing some buy flows on the PMS desk at the lower levels. They're expecting strong Q4 numbers from this counter and some buying action on the DI desk on insurance names like SBI Life, HDFC Life and ICICI Lombard. There are buy flows on the DI desk. Delivery volumes are also expected to be on the higher side.
Okay, so delivery volumes expected to be on the higher side is also an interesting point to note right now, though some nervousness in the markets, and like we're saying, it could be a mix of factors coming in. We've also talked about the political factor coming in, because we're waiting to hear on what's happening with the 5 state results on Monday. Gargi Nandi Roy, political analyst, joining us for her take. We're trying to get you all kinds of views this afternoon on India Market Close. Gargi, thank you so much for speaking with us. The big outcome, at least of the exit polls, seems to be that no one is sure what's happening in West Bengal.
Yes, thank you, Tamanna, for inviting me. But surely, Tamanna, this time there is a mood for change.
Okay.
And I think out of the 7, at least 5 exit polls show that BJP is coming to power. Now, I'm not an astrologer, but surely I know the mood of the people. The people do want a change. See that what we have seen in 2011, when there was a change, that same kind of mood is there. Only maybe that chunk of Muslim vote which got transferred, this time it is not getting. But this time it seems there will be a change, because you are a profit channel. You talk about markets, and you were talking about markets before me. I think obviously if BJP comes to power, Tamanna, for markets, it will be a good news. I think you'll see some rise in the stock market and Nifty. And
but you know what, Gargi, you're right. You're very right in saying one thing, that neither you are astrologer, neither are we. The fact that one major pollster is not putting out the polls today might lead to some of that question mark. Just want to understand from you as a political analyst, what is the significance of these 5 state polls? Because nothing really changes in the center or any impact on policies.
No, but I think I'll first come to Bengal. See, I think Assam, we have seen how Assam has grown in these last 10 years and all. And just under Hemanta Vishwa Sharma, semiconductor industry came to Assam. So if there is industry, if there is manufacturing, obviously it is good for the market. Coming to Bengal, Tamanna, Bengal in this regime, under this regime, has seen exodus of 6,668 industries, 18,450 MSMEs closed. And this is not that it started from Trinamool era only. It started from this left era. In the left, because you know the left politics was such, they demonized enterprise, they glorified poverty. So there was an exodus of industry. I can name some of the greatest big names in which who had factories in Bengal and which left Bengal, like Hindustan Motors, or closed. But Hindustan Motors.
Okay. All right, we're running out of time, Gargi, but thank you so much for joining us today. As we look at what is going to be the impact of polls. One of the many things. Now, markets is something that we need to cover right now, but we hope to speak with you again soon, Gargi. So thank you so much for coming in. I actually want to come to Sameer Dalal on what the market mood is right now. Sameer, what is the biggest concern as far as you see on the markets? We've seen some recovery, but do you think top of mind continues to be the price of Brent and the rupee?
Oh, absolutely. So for the market, I think that is something that you have to focus on. When you have $125 a barrel, you think of the negativity that's going to happen for the oil marketing companies if they don't increase prices, right? Because at the end of the day, they're going to sell it at a huge, bigger loss than they're already selling. Now, the alternative is if the government takes a hit on its taxes, it hurts the government financial, or you raise the prices at the petrol stations, which hurts inflation and consumer consumption. So it is a very, very negative factor. I'm actually a little surprised to see the resilience in the market, given that crude is at $126 a barrel. I guess the expectation is that this is going to be short-lived. But, we've been saying for this war from February, well, not February, but early March onwards, it'll be short-lived. And we are now almost at the end of April, and 2 months down, there's no sign of anything changing. So, how long can you keep living on hope? Second, when you have had crude prices so high for so long, it is going to create problem in the value chain of the downstreams. And I think you're going to see those in the numbers in Q1. So I think the market needs to brace for Q1 being a little disappointing. And the minute that happens, yearly full year target estimates need to be downgraded, and then the market is going to look expensive. So I would be a little cautious on the market right now. I think unless something changes really fast, I think we need to be worried.
All right, yeah, that cautiousness also pervading Dalal Street as we speak. Jay Bala, on that note, I think we have to thank you, and I apologize, it's been that kind of a show. We haven't gotten too much time to speak to you today. Hopefully, we will be able to remedy that the next time we speak. But we slipped into a very quick break. We're off the low point of the day. At least that's something positive to talk about at the end of the trade. We've got half an hour to go. Let's see where we end. Stay tuned. We'll talk about more stocks on the other side.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open, your favorite market show just got better. On NDTV Profit, for your profit. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world.
Welcome back. Markets are in slight recovery mode but still feeling the heat. Meanwhile, let's look at what SmartWorks has done. SmartWorks Co-working has seen its strongest quarter ever with double-digit revenue and EBITDA growth. What's worked for this company? You saw that big spike when the numbers came in, and then, of course, falling prey to the mood of the markets overall. But Nitish Sarda, founder and MD SmartWorks, joins us now. Nitish, thank you so much for speaking with us. What has worked for you this quarter at a time maybe when it's not really clear whether that kind of growth in co-working spaces can come in? What has boosted your numbers?
I think we're seeing a lot of, thank you, Tamanna, for having us on your show. I think we're seeing a significant amount of demand coming in for flexible spaces for a platform like SmartWorks, where we're able to give a customer a standardized solution across the country. If you look at our numbers, we're getting in, we've increased our revenue by about 31% this year, from 1,375 crores to almost 1,800 crores. With that, our EBITDA margins have also significantly increased from 175 crores to almost 314 crores. This demand is actually coming in from all directions. If you look at the market currently, GCCs, global capability centers, are driving a significant amount of growth in the Indian RE space, followed by Indian homegrown companies who are also going ahead and taking up more and more space. Whatever is happening across the world, but if you look at the absorption of office space in India, in the first quarter of this calendar year, we have absorbed the maximum amount of space that we've ever done across our history.
Which is what I wanted to understand. Has there been a change in strategy? Is this something different that you're doing? Because across the board, there has been an increase, right? Your net seats leased is up 68% year on year. Effectively, that is why you've swung from a loss to a profit, though your EBITDA margins are down. So has this growth come at a cost? Has your acquisition cost gone up? Can you explain to us the semantics of how you got here?
Our EBITDA margins have actually significantly increased. If you look at our EBITDA,
no, I'm talking about consolidated year on year.
Yeah, so consolidated year on year, if you look at our EBITDA margins last year, they stood at a normalized EBITDA of about 13.75%. This year, we're ending at about 17.5%. This NDS EBITDA margins would be affected through some of the accounting entries, and this doesn't account for the lease payments that we do. The normalized EBITDA margins is what stands at almost about 17.5%, which is a 300% bump up from what we were last year. I think this growth is driven because of the value prop that SmartWorks as a platform is providing. If you look at some of the larger enterprises which are moving in, we have more than 37% of our revenue coming from 1,000+ seater deals who are committing to long tenures of 47+ months. So the predictability.
I just want to go back to you on the EBITDA margins because we need to understand this. So your EBITDA is up 45.6% at 338 crores versus 232 crores. This is correct?
175 crores last year. The normalized EBITDA stood at 175 crores last year.
No, you're looking at normalized EBITDA. I'm looking at just the overall number. When you say normalized EBITDA, how are you looking at it?
So there are two EBITDAs. There's an NDS EBITDA, which the company reports, which includes all the accounting entries. And then there is the normalized EBITDA, which is net of the accounting entries that you need to do, which are non-cash in nature. So the NDS EBITDA is what has significantly increased from 13.5% to 17.5%. The reported EBITDA, which you see on the balance sheet, despite the base increasing, it's increased from 200 and something crores to 314 crores.
Okay, so in your reported EBITDA, that is where the margins are looking a little squeezed. You're saying that your normalized EBITDA is much better. So what are those accounting entries that you think is causing this difference?
So these are accounting entries which come in with respect to the lease equalization reserves that you need to create. These are accounting entries that with respect to some of the accounting entries which are non-cash in nature. So they don't have any impact on the cash flows. If you look at our OCF for the year also, they are very, very healthy with a 314 crores in EBITDA. Our OCF stands at 10% higher than that, closer to about 345 crores.
Okay. Hi, Nitish, this is Alex here. I'm wondering about the addition of space that you are planning in FY27 as well. So you've ended, where do you end at FY26 and where are you going to end FY27 at?
We are ending FY26 at 10 million square foot of operational space. This makes us almost 1% of India's commercial real estate space and 10% of the flex space across the country. But if you look at our committed space take up, we've already increased our committed space take up to 16 million square foot, which means that currently the 10 million for the next 2 years, we have almost locked in all the supply that we require to grow at the 30% mark that we're looking at growing over the next 2 years. That supply is already blocked with the 16 million square foot, which is we've gone ahead and committed to. 10 million out of that is operational. The remaining 6 million is going to get operational over the next 12 to 24 months.
So, and if you were to talk about the yield that you're getting in FY26 and what it will be in FY27, and as you pointed out, you've locked in supply. Give us a sense of the trajectory on yield as well.
So on one side, we've locked in the supply. We've also gone ahead and locked in the revenues. If you look at our committed revenues today, we stand at almost 5,000 plus crores of revenue locked in, which means that even if we don't do a single deal from now, we still have over the next few years going to get over 5,000 crores in revenue. In terms of the the total locked in revenue growth, you will see that at 88% of our current space is fully committed to. Whatever new space is going to come in is what is going to incrementally increase our revenue and vis-a-vis increase our margins from there.
Okay. And finally, FY27, you've actually turned profit in the last quarter. What is the outlook for FY27?
So we think, we've grown almost 31% year on year on our revenue numbers. Our EBITDA margins have gone up by 75%. We started the year with about 13.7% of normalized EBITDA, which today stands at, in this quarter, at about 19%. I think revenue growth of 30% with a stabilized EBITDA at 19%, which is what we are exiting the last quarter at, is something that we are fairly confident of achieving next year.
Okay. All right. Well, thanks so much for taking the time and wish you all the best for FY27.
Thank you. Thank you so much.
On this side of the show, we've got Rajesh Palvia, Axis Securities, as well as Samir Dalal of Natwarlal and Sons Stockbrokers. Samir, quick view, because we've got a packed show, lots to talk about. What do you make of SmartWorks?
Company is interesting. Haven't studied it in details, but I mean, look, what they're doing is renting out space and re-renting it out at a smaller lots, and because of which they're able to make returns. But we need to see it. I mean, I haven't studied it, but we need to see how they grow over the next few years.
Rajesh, I want to talk to you about a couple of stocks here, Nalco in particular, and maybe the rest of the metal pack as well, specifically, because it took a bit of a hit post those numbers. How does it look?
Yeah, so Nalco has now broken its 20-day moving average, and looking at the supply pressure now, I think this fall can continue further. On the downside, stock may test a level of 385, 388 kind of zone, which is its 50-day moving average support area. Though long-term structure is bullish, but yes, some pressure is there on the near-term chart. So maybe it could slide further another couple of percent, like 385 to 389 would be the next level to watch for. If it's not able to hold 385, then we may see further more downside towards 375 also. But looking at the overall structure, we believe that stock will attract again buying interest around 385 zone. So those who wants to buy, wait for another 2 to 3% kind of correction, then one can deploy some long trade around those levels.
Okay. Nalco in focus, but I want to talk about HUL with Samir Dalal. Samir, have you looked at HUL numbers?
Yeah, I did look at those.
Okay.
They were decent numbers, just because the stock was, I guess, fully priced or a little, well priced. The stock is seeing a correction, but the numbers, nothing wrong with them at all.
So do you think you would buy it at this level? Because what you're saying is a profit booking, right? Do you think HUL is a good buy, considering we don't know what's happening with crude prices, packaging costs, demand, etc., etc.? But do you think FMCG and especially HUL, with what their performances look like, is worth building positions in?
Okay, so Tamanna, there are two things. One is results being decent and in line, and the second is whether you buy something because value is fair or growth is there. Those are the two components, the two primary components that you've got to look at. So when you look at HUL as a company, ROE, ROC, fantastic, right? No questions asked. The problem is growth going to be there? That is where HUL has had a bit of a challenge. They're growing at low single digits. And when you command a PE multiple of 40 growing at low single digits, then you got to hope for margin expansion, which will compensate for that high valuation. Can't keep having that happening. At some point, competition is going to ensure that comes down. So that is the bigger problem that we have. Growth is not there and valuations are rich. And that is why, even though the company's quarterly numbers were good, I'm saying the stock corrected because everything is well priced in. Would I buy it? No, I wouldn't. I still find valuations expensive. maybe closer to 1800 is where I would probably initiate looking to buy it. Would I sell it? Because if you're a long-term investor, no, but I would not buy it at this point of time for sure.
Okay. Let's go across to my colleague Mahima, I believe, joining us right now to tell us about HUL and the trajectory for growth.
No, this is actually Mahima speaking with HUL at the press conference. So Mahima had the opportunity to ask the HUL management about their numbers. Listen in.
My question is on volumes, because this time it's a 15-quarter high number that you've seen, right? Considering that you've said that you will be taking, calibrated price hikes, that could impact volume going forward. But at the same time, you've also said that, growth is our top priority. So going forward in FY27, I know you will not talk numbers, but any range in which you will be seeing volume growth coming forward?
So firstly, we won't offer a short-term guidance, right?
Yeah.
But let me get into firstly, what's the step up we are seeing?
Yeah.
I think the first thing is, what are we working on? The first is fewer, bigger bets. We've talked about this before. We will continue to focus on scaling up a few priorities so our resource allocation is becoming sharp. So that's the first thing. The second is working on our brands, modernizing them, premiumizing them, both in terms of communication, but also in the segments in which our brands play. Creating higher exposure to the higher growth segments is what we're working on across all our brands. Remember, HUL, we have 20 large brands and 55 total brands. So across our brands, really systematically ensuring that our brands we step up. The third is in terms of building the capability of our channels, really doubling down behind execution, because it's much more an omni-channel market, India, than ever before. So whether it is QCom, e-commerce at the top, or actually we are now investing also in general trade. So we're actually investing in building our footprint in chemist channels and open format general trade stores. And we have created a new specialized force to go to market in these channels. That combined with, continuing to drive our leverage, our operating leverage, is what sets us up for the next year.
Okay, all right. Still pushing that volume growth. Let's see if it pans out. For now, let's turn back to Nalco. It's under pressure after its Q4 results, and Mahima joining in to talk about what may not be working because it's fallen off a cliff there. Mahima, there's still growth, but is it a situation of not meeting those expectations?
So, Alex, what's happened is that overall, if you take a look at the QOQ numbers, which we generally take for metal space as a whole, right? They look, decent when it's compared to on a QOQ basis. But if we take a look at the year-on-year number for Nalco, I think that's where the problem is. In terms of revenue, that's fallen by 5% year-on-year basis. And this is despite of the aluminium prices, uptick that we saw in the last, couple of days. In fact, almost March month as a whole did see an uptick in aluminium prices because of the West Asia conflict. Even in terms of PAT, on a year-on-year basis, it's fallen by around 17%. Other expenses has inched up quite a bit, almost a 31% uptick, and that has impacted the year-on-year margins as well. Stock, of course, did see a run-up on the back of aluminium prices going up, but overall, I think most of it, today is also on account of profit booking that we're seeing on the counter. But on a year-on-year basis, revenue saw a downtick of around 5-odd%, EBITDA saw a downtick of 14-odd%, and margins also down by about 600 basis points. I think the street right now is probably looking at the year-on-year numbers and not happy with regards to those numbers, and that's why we're seeing that stock tanking in trade today.
To see all perspective, so when you're looking at year-on-year, it's not looking as pretty as it did. Sameer Dalal, how are you feeling about IT? One segment which is holding on to its space today. In a tough market, and a weak rupee actually is not a bad idea for IT companies. A strengthening dollar is not necessarily the worst news for them.
Yeah, so it leads to great profitability increase, but that doesn't change the dynamics of the company when it comes to whether business is going to continue to grow or not, right? So for IT companies, why they're holding out is simply the fact that they've already fallen so much. There's very little room for them to continue to fall. In fact, valuations are now at, I will say, fair value multiples, right? So that is one of the things. Second, the bigger problem in IT, which I've been saying for a while, is the fact that growth is going to be very subpar. You're talking of companies going as low as to -2% and as high as to about 7-8%. And of course, then you have outliers like Persistent and Coforge who are higher. But having said that, why should companies that are growing at 5 to 6% top line, yes, they're getting benefit of the currency fall, so margin expansion and profit growing, maybe 7, 8, 10% growth, trade at 20 times because your core business is only growing at 5, 6%, right? So what I've been saying for a while, I stand by that IT is a great bet to have from a point of view against a fixed deposit because you'll get your 6% div yield, 5, 6%. Plus, if the stocks go up by 4%, you walk away 10, 11%, which is going to be long-term capital gains tax, which is far better than an FD, which is taxed at the highest tax slab. So from that perspective, IT is a great investment. From an equity perspective, taking the risk in equity, I don't think IT is going to give in the next year and a half significant returns. We will have to keep monitoring how AI integration is done by IT companies for its clients. And that could be the game changer, which we'll know in the next 1 year. Is IT dead? No, it's not. It's just that it's going through a 2-year period of a lull, I think.
That's the first time I'm hearing IT being compared to a fixed deposit, though I must say, Samir. Having said that, Rajesh, I'll come to you on any short trades, and I don't want to say BTST because it's a long weekend. I don't know how appropriate that would be, so particularly in these times. So what short trades would you suggest?
So on the short side, I think Indigo, Interglobe Aviation, one can look to go short as stock has already broken 20-day, 50-day moving average. And looking at the breakdown on the near-term chart, if it continues to trade below 43.70 kind of zone, I think trajectory is on the lower side. And we may see lower target of 42.70 also for Indigo. So this is one stock which is coming in mind on the short side. Again, another stock that is from the metal space is, taking some hit. Hindalco is correcting from the higher level. If I look at the near-term structure, there is a breakdown of upsloping trend line on Hindalco. So looking at the structure here also, we may see some more profit taking to initiate. We are projecting target of 1,000 on the downside. Stop loss needs to place at around 1,055.
Okay, there are some ideas for you. Would you look at Nalco at all, Rajesh?
So Nalco, we are waiting for 389, 385 level where stock is having major support area. So till that level, yes, slide can come. But if it's break below 385, we may see furthermore liquidation towards 370 zone.
Getting beaten to a pulp right now in closing trade. Just a few minutes left to go. All right, Adani Ports and SEZ reported a 25% rise in revenue for FY26, exceeding its guidance of 38,000 crores. EBITDA rose 20% ahead of its stated range, while the company handled more than 500 million metric tons of port cargo in a year for the first time. Listen in to Ashwini Gupta, whole-time director and CEO, Adani Ports.
Hello, and thank you for supporting us by having confidence in growth of APSEZ. We said 500 million metric tons, and India, along with our global businesses, delivered. This is not an operational statistic. It marks an India infrastructure movement. Now, I present another strong performance by APSEZ for FY26. Once again, we have exceeded our own guidance. APSEZ outperformed the upper end of revenue, EBITDA, and CapEx while closing with net debt to EBITDA at 1.9x and a ROCE of 16%. Another evidence of our healthy business growth with financial discipline. FY26 revenue grew by 25%, EBITDA grew by 20%, and PAT grew by 16%. During the year, we faced challenges and disruption. Operation Sindoor, geopolitical disturbances, and West Asia crisis. Still, we delivered, serving the nation by handling multiple challenging vessels like LPG, managing transshipment overflow from Middle East to hit 500 million metric ton.
Okay, all right. So that's the word coming in from the management of Adani Port. Standard disclaimer, of course, NDTV Profit, part of the NDTV Group and also owned by the Adani Group. Samir, quick view on Adani Ports. This is, of course, you've seen the numbers, and there is also a benefit that seems to have come through with regard to the use of the Vizhinjam port as a transshipment terminal because of the way that some of these routes are shifting. What's your view?
So fundamentally, again, good numbers. Like you said, there is a few one-offs, but that is okay because, look, at the end of the day, this is a business which will constantly have changing dynamics. If this war in the Midwest, continues for a little longer, this business will continue for longer, allowing profitability to grow. Again, same problem I face with this stock, which I face with I know your channel is owned by the same group, but I still say, great business, valuations are not great. For a business that is delivering ROCs of only 15-16% for trading at about 45-50 times forward earnings is very difficult to fathom. If not for that, it's a great company to invest in. So if the stock ever corrects closer to maybe 1200, that would be the time you should go in and buy. But beyond that, I can't recommend a buy at 1600 to expect returns from him.
Okay. All right. Well, let's talk about several stocks that you should watch out for at the end of trade. And in fact, on that note, let me thank both the gentlemen who joined in today and for giving their views. Pleasure speaking with you as always. But pull up the intraday chart for the Nifty 50. We're off the low point of the day, certainly, but we're still down about 150 points, more or less where we started this program. So again, pull up the intraday chart and you'll see what I'm talking about. We're significantly off the low point of the day, which was midway through the trade, and then you've seen a little bit of a wobble towards the end of the trading session. Heat map for the Nifty 50, and you'll see more green on the screen than you did at the start of trade. About 13-14 stocks that are trading in the green right now, led by Bajaj Auto, and the buyback news coming through that is beneficial for the company as well as its shareholders. Sun Pharmaceuticals, Infi and the tech pack doing okay. Reliance Industries bouncing from the low point. It seems like there is a little bit of deployment of funds, if anything, that is causing a few of these heavyweights to move up. Metal pack is under pressure today.
Metal under pressure. Those NALCO numbers have not helped year on year. Definitely, you're seeing Hindalco also taking a knock. In fact, I don't know if you can get that dual chart with NALCO and Hindalco with the intraday. That'll give you an idea. May 6th is the Bajaj Auto buyback. They'll also announce their results on that day. Bajaj Auto is going to be in focus because remember, they're celebrating 100 years of existence of Bajaj Auto this entire year. So maybe they're a little generous with investors.
And they have the cash.
Buyback. They have the cash. All right, NALCO. Let's look at the NALCO intraday and the Hindalco intraday if we can, and both of them, and see if there is a pattern that we can see there. Look at that. They're mirroring each other because the NALCO numbers came out. The year-on-year number is bad. That stock is down 8.5-9%, and then Hindalco follows the same pattern. So, which is why you're going to see Hindalco under pressure. We had one of our analysts recommend Hindalco as well. So, that's maybe what you should look at. Let's pull up the sectoral heat map very quickly as we're closing off this Thursday afternoon. It's a 3-day break from markets. Markets don't want to go into those 3 days not knowing what's going to happen next. Nifty metals hurting, Nifty realty hurting, so are consumer durables. PSU banks have had a bad day. IT is just managing to keep its head above water with a 0.5% uptick, as is pharma. But overall, I would say, Alex, this is a street which is nervous. This is a screen that is showing nervousness more than anything else.
Absolutely. Just to close out, pull up the advanced decline ratio because you will likely see a widening even, actually, okay, it's not too bad. It's more or less where you were at the start of this program. It's had a little bit of a widening and then a closing again. But you're closing with the declines in the ruling seat. Speaking of ruling seats, there's going to be a lot of that chatter over the weekend heading into the results on Monday. And that's the other thing that we're going to have to talk about, of course. It could lead to a sentimental move on Monday.
If at most, and lack of other things in place, I would say that it's either going to be Trump as the topmost headline or Mamata Banerjee. We don't know which one and whether it's going to be a good one or a bad one. So it's going to be interesting to watch in any case. But any poll impact on markets, especially state polls, is usually sentimental and temporary. Definitely a factor to watch out for. That's all the time we have, but don't go anywhere because we have editor's cut for you. Just in a short while ago, and our guest editor today is Gautam Shah. He's going to be joining in Alex Hirul and me to talk about what he thinks is going to happen in markets next week. Don't go away.
केसरिया से मन जोगी हुआ रे दिल झूमे देखो मतवारा हुआ रे केसरिया से मन जोगी हुआ
हर पल मनाओ केसरी त्योहार विमल बोलो जुबान केसरी
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to. Get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. New year, new power panel, India market open, now in its boldest lineup. This is where the trends get tested and stocks get conviction.
I'll recommend a buy call on a stock only when I'm fully convinced on the stock. With a table thumping buy.
And when the street wants the levels, he brings the chart.
Charts speak the truth, and I deliver the levels with no frills.
Parag Thakkar and Kush Bohra are now part of the morning crew with Tamanna, Neeraj and Alex. Same show, sharper voices. Every morning on India Market Open. Your favorite market show just got better. On NDTV Profit, for your profit.
Welcome, you're watching the Editor's Cut. This is where we talk about what the week has been like and what we think is going to happen, and it's basis all of the experts we speak to, because I was just thinking about it, folks, that we end up speaking to such a whole variety of people through the week, right? It's analysts, people who track markets, mutual fund money managers,
this week
companies.
Has been political analysts as well.
And political analysts as well this week. And so, you know, we can just put together a sense of everything that we're absorbing and putting through. And I think one big takeaway for me this week is that there is confusion. If I was to say what is the word of the week, it's confusion. Whether it's on exit polls, whether it is on the question of has the street priced in the Strait of Hormuz and the US-Iran war, on whether there's going to be a deal or not. There is just, the whole narrative changes every day. and confusion prevails.
And one more what I would want to add to that is tension. I think now that has started to creep in. All this while we were not seeing people who were really tensed about the situation. I think that's coming in as well with the confusion.
I think to a certain extent also people are feeling it because March was horrible and then the month of April has been really good for your portfolios, right? You were crying for a little bit of assistance and anything will do, but it's been a pretty healthy jump, particularly at the broader end of the spectrum, where within touching distance 3-5%, less than 5% for the mid cap index, about 6% from the 52-week highs from the small cap index, and that's at the index level. So your portfolios would have likely looked better.
Yeah, no, I mean there've actually been some stocks which have seen a 30 to 40% jump in this entire 8-9 weeks. But as we're getting into the third month of the US-Iran war, things are looking unclear. And I think the question, and that's really my take this week, the question now is how long can we hold on for? We had a guest this morning who actually said, I'm scared. And this is a very optimistic guest, and you know who I'm talking about if you watch this channel. The fact that Brent June futures have hit $122 a barrel, the peace deal is elusive. Trump is saying, why should I take an 18-hour flight to talk to the Iranians when I don't agree with anything they say? The question now becomes is how long can India hold out on passing on these prices and seeing any real impact? The analysts we're talking to are talking about 2 weeks more. Something needs to give in another 2 weeks because there's no second order impact on grounds so far. This could change quickly. Now, the other factor really is Q4 results, right? They're positive in part, and then there's a celebration on the street. Any company which has given good results, you see that stock spike up. Investors are coming in and, thumping the table on it. But that data now seems redundant. More and more, what a company has done in the fourth quarter or the last financial year doesn't seem relevant right now. You have the managements all sounding optimistic in conference calls. There was one management who said that our tailwind is, for example, asset quality, even if the geopolitical situation is bad. I'm talking about Bajaj Finance here. But can anyone be sure of a resolution in the US-Iran war? Not really. And the other thing, folks, of course, is 5-state polls. And you were asking me about this, Alex. Any response from the market will be sentimental and temporary. There might be a reason to really come in and, rejoice or be in a sour mood depending on it, but that'll be for a short time. The fact that there's uncertainty is also a big question. That's why I said confusion. Your major pollster, My Access India, today has come and said, I'm not putting out my results.
And the reason is very interesting.
Yeah, because he's saying 6 in 10 people don't want to tell me how they voted.
Is that telling in itself, Tamanna?
I think it is. I think it is because there's fear one way or the other. And there are two aspects of fear in these polls, right? One aspect of fear is, and this is why maybe you also had a high voter turnout, that if you didn't vote, then would you still be seen, identified as a citizen?
Citizen.
And then, of course, because the incumbent in that state has such a huge grip, do you want to let anyone know that you may not have voted for them?
Yes.
So it's a dual fear mandate, and in the lack of any clarity, no one wants to take a guess.
Yeah.
Even someone whose job it is to actually tell you what they think has happened.
But I completely agree with the idea of any sentimental bolstering on Monday will likely be short-lived if that overarching problem does not go away. And in fact, you were talking about crude oil prices. The mirror to that is rupee and the way that rupee has gone. So I was pulling up a little bit of information. India and the rupee has been the worst performing currency by a mile in 2026 so far. So take a look at this. You've actually underperformed the Turkish lira, the Peruvian sol, Indonesian rupiah, and South Korean won, all of which have fallen between 4.9 and 2.8% in 2026 alone against the dollar. And I'm talking about, for example, the best performing currency is actually appreciated. That's the Brazilian real, has appreciated close to 10% against the dollar in 2026. the Australian dollar and the Chinese renminbi have appreciated 6.8 and 2.2% against the US dollar. Since the 1st of Jan 2025, that is the previous year, the drop is as much as 10%, and only the Turkish lira and the Argentine peso have depreciated more against the dollar since that time. So in this context, and asset allocation is obviously key, but when we're sitting here in India, the average retail investor, Tamanna Hiral, has relatively less ability to invest in equities in various markets. You can go through GIFT, but that mutual fund route is restricted to a large extent, and they are opening and shutting depending on the flows. And so therefore gold becomes a very, very important hedge that everyone should consider having in their portfolio. Of course, investment advisors in any case say that you should have about 10%.
That's interesting. So you're making a case of the comeback for gold.
I am certainly making the case. In fact, gold should always be a little bit part of your portfolio. The argument against it comes from the fact that people say, oh, it's not productive and all of that. But if you think from India's perspective, it's important because first of all, we're a price taker of gold, right? So whatever gold prices are globally, that will reflect on your ETFs. But if you look at the ETFs over the course of the last decade and you map out the depreciation of the rupee, you will find, and you compare it, of course, to a dollar-denominated gold ETF globally, or just the gold price, you will see that the ETFs in India also reflect the appreciation of or the depreciation of the rupee. So if you look at 2026 and you say gold prices in the international market are up, 7% or thereabouts, then if you calculate close to 6% depreciation of the rupee, if you invested in a gold ETF at the start of January, chances are that your return will be over 10%. So even in that context of a relative underperformance of equity, you've been held in good stead because a part of your portfolio is in gold.
But the argument over there, Alex, is yes, gold is usually taken as a safe haven in war situations. The spoiler to the party right now is what's happening with crude, right? And that's the reason why you're not seeing that kind of confidence that is building up when you talk about gold, or for that matter, silver as well. In that kind of a scenario, is it still correct to build a case when it comes to investing in gold and silver, or wait until crude settles at certain levels where you see some bit of stability emerging? Because usually the correlation is markets are going down, that's the time you invest in gold and silver. Right now, as Tamanna was mentioning, there's confusion across.
My only point is that gold has not performed the way that you had traditionally expected it to perform at any point during this conflict. In a normal situation, because it's already run up.
That's and the point. Plus, you have crude which is coming in, is spoiling the party for it.
So 65% gain in 2025. Obviously, the reason why gold actually fell off a cliff and then recovered.
That was a different crisis they had to manage. Yeah. So what about you? What stood out for you?
So I think for me, the way I'm looking at it, Tamanna, is that there is tension between long-term structural optimism is what you're seeing right now. But when you talk about the short term, there is acute pressure. So these are two sides that we're looking at. Now, first up, your underlying growth story in terms of India from the commentary that we pick up remains absolutely intact and attractive. However, there is a shift happening from a broad-based rally to a more cautious, bottom-up picking kind of an approach. Now, the sentiment which is underlying the markets right now is also very fragile. So any news that comes in, we see a break that happens on that front. Apart from that, we are moving away from a high valuation uniform rally, and the Indian markets are becoming a more volatile phase where the quality and earnings growth is becoming a matter of concern. Like, for example, if you see CET, spectacular set of numbers in the fourth quarter. However, the commentary was that your first half of FY27 is going to see major impact in terms of margins on the back of raw material prices. That's what the markets have reacted to.
That's what my point is. Your Q4 data that we're seeing right now is redundant. It's old data because it exists in a world where the Strait of Hormuz was still open, where crude had not skyrocketed, and where there was no fear of constant global supply disruption.
At this juncture, in fact, I was speaking to a fund manager today, right, of a small cap fund and two thematic funds. And what he was saying is that he has already adjusted his expectations for earnings for FY27. And the longer, at this juncture, it's an ongoing adjustment, right? So the longer this conflict lasts, the more you will have to shave off of earnings in FY27.
So, okay, so to add to that, you were talking about the rupee. Now, if you talk about the rupee, 95.32 is what we hit in intraday trade today, right? Your rising oil prices are also triggering your FI outflows. So you have the rupee, which is weak. April alone has seen FI outflows of what? $7.5 billion. 2026 alone has seen outflows more than $20 billion. And to add to that, if you talk about the central bank strategy from here on, you're not really seeing them, say, play a level, they're not trying to level the defense over here, but what they're trying to do is manage the volatility. So that's where everyone is stuck.
You're saying they're not defending a level.
Yeah, I mean, there is no defensive play that they have right now,
you
right?
You can't at this stage. It's like
exactly.
throwing water.
That's exactly
it's
what
like using a bucket and trying to pour water at a forest fire.
Yeah, it's not going to work. Okay, one thing though that was, I would say, because a lot of what we've talked about are the negatives. One thing though that was a little heartening was this conversation we had with the guys from Kepler. Now, Kepler is this agency that tracks the movement of oil and energy across the world, and they talked about how a large consignment of crude from Venezuela was making its way to India on the path of the Cape of Good Hope.
Yeah.
And their lead analyst talked about how India has figured out 85% of its requirements. There's a 15% gap and of how much crude we need. And that 15%, it's not that we don't have other alternatives. Dunya mein crude hai, but the fact is that there is a gap of how much is going through for the whole world. So the world will find alternatives. Is my point. It's a race against time, right? Does India manage to figure out how much crude we need in time till those alternatives are found, or the Strait of Hormuz is open? It depends on what happens first, and that was quite heartening to see.
And you said it's all about the time, because if I remember correctly, please correct me if I'm wrong, 28 days or so is what it takes, 28 to 30 days
to come from the Cape of Good Hope.
From Venezuela to India from the Cape of Good Hope, and you're talking about 2 days effectively from the UAE through the Hormuz Strait into India. So it's managing of a supply chain that was very, very quick. And of course, by the way, this last week has been momentous from that perspective as well. The UAE stepping out of the OPEC, and what it means for crude oil. A lot of analysts talking about the fact that if they move, and we had these numbers up, they have 3.5 million barrels per day capacity right now. They're amping it up in 2027 to 5 million barrels per day. And the implication for a relatively inelastic commodity is that even a small increase in supply can have a dramatic bearing on the prices.
But think of it this way, there was never a problem with crude supply.
Sure.
It was a problem with crude. This choke point is the transportation.
Yes.
There was excess crude in the world even before the Strait of Hormuz problem happened, and basically the war happened. Gautam Shah is joining us. He's founder of Goldilocks Global Research. Gautam, we wish you could be here. But on Editor's Cut, we've all given our takes of how we've seen the week gone by, the situation, and what we think is going to happen. How are you looking at things?
Well, good afternoon. I think markets are beyond geopolitics. We've discussed a lot of geopolitics in the last 1 month, but I think the good, bad, and ugly, all of it, I think, is now in the price. Because if the situation intensifies, the market is not reacting. If the situation gets better, the market is also not reacting. So I don't think it's a bad place to be in, because markets are now looking at more domestic related factors, which is India's earnings, consumption, AI-related disruption, FI selling, and all of it is pretty much there. So I really feel that it's a battle between domestic liquidity and all other factors. And it's really domestic liquidity that has kept this market afloat. Because if you look at that one chart of Nifty versus the world, you'll realize that the Nifty versus the world, we are actually at a 52-week low, despite all the strength that we've seen in the last couple of months. So I think in an overall context, I still feel that the Nifty and the large caps would not do anything substantial. I said this last time in our interaction as well, that 24,600 could be a ceiling. Right from that level, we've seen a bit of a downtick. And we are yo-yoing in that band of 23,500, 24,600. And if Nifty was a team, if you look at the players of the team,
IT, FMCG, Reliance Industries, SDFC Bank, none of them are firing. In this environment, you can't expect the team to do well consistently over a period of time. And given that, I still feel that the Nifty and the large caps are going to go nowhere probably for the rest of the year, and they will just continue to languish in a range. But in this very period of the last 3 weeks, we've seen so many themes do well. I mean, metals, PSU, energy, the entire Adani group, real estate making a comeback. So be in specific pockets. This is a stock specific market. We are facing a lot of headwinds, but smart money is actually going into value, and growth stocks are not doing well. And I think this is a trend for the rest of the year.
It's a very interesting point that Gautam is making over here, because if you talk about the range, I was just looking at Nifty 50 range from the 3rd of March to now. It's been a 2,200 point range from the lowest levels of Nifty 50 to the highest levels. I mean, a low of 22,182 to a high of 24,601. Likewise, Bank Nifty has been in a range of 10,200 points, a low of 49,954. And a high of 60,177. Now, when Gautam is indicating that probably this is going to be a market where you will see value and not growth, it connects me to what Rhythm told us, that there is pessimism in sectors like banks and IT, and wherever there is pessimism, that's where value will come in. There will be no growth. So don't run behind growth, run behind value. So probably these could be sectors one should be investing in. I mean, the question is then, do you really stick with that kind of a scenario?
I think I'm curious to know what Gautam is seeing as value buys right now and where those spaces are. Gautam, are you looking at any of the Q4 data at all? Does that make sense right now in the current context?
Well, I think the bigger problem is really consumption and the economy itself, and the fact that do we really deserve such rich valuations versus the rest of the world. You know, for the last 3 years after the COVID rally started, 2020 to 2023, everything was justified because things were, on track. AI disruption was not there. FI selling was not there in that magnitude. But I think things have changed quite a bit in this last 1.5 years. Because if you look at other markets of the world, I mean, look at what Brazil has done in the last 6 to 8 months. Look at what Korea has done in the last 1 year. Very, very massive moves. Look at Japan. It's trading at lifetime highs today. So I, as a global analyst, when I look at many of these pockets, I just find that the India piece is really not top down. It's really bottom up in terms of opportunities. But coming back to that point of value, the fact that Coal India, NTPC, NMDC, Power Grid, SBI, SAIL, all of these stocks have done phenomenally well in the recent past, that they've held out beautifully. So the message is loud and clear. Be in the entire PSU basket. I think that's where clear value is. Energy, obviously, for its obvious reasons, is doing well. And metals, fundamental analysts still don't have an understanding as to why metals are doing as well as they have in the last 6 months. But I see a massive base metal rally coming, with copper, aluminum, zinc, lead, all likely to do well. So that's again an opportunity. But if you look at the growth stocks, I mean, if you define HDFC Bank and Asian Paints, for example, as typical growth stocks, look at what they have done. I think the writing is on the wall.
Gautam, we were debating about the Indian rupee and whether gold can come in from the Indian perspective as a foil or as a hedge. I wonder what you think about, one, the currency pair, and two, the yellow metal and the way that it has behaved in this year.
On the currency, every time I've tried to be a little optimistic, the market has failed me. And I think it's happened every single time in the last 6 months. And I think when it rallied from levels of 94.5, there was this feeling that maybe now things are getting slightly better. But I think in the last couple of days, it's back to levels of 94, 94.5. And forget the Indian rupee versus the dollar. Look at what it's done versus euro. Look at what it's done versus pound. It's really a sorry state of affairs. And when I speak to many of the institutional investors, not only are they complaining about no relative returns for Indian markets, large caps, they're also a lot complaining about the currency. So I think this is a problem that we are definitely dealing with. And with oil at levels of 100 and beyond, that's not helping. That's the reason I said there are just too many headwinds. In this environment, can you actually park your money in gold and silver? If you really look at it, it's gone quiet. Last 2 months have been very quiet action for gold and silver. So much has happened on geopolitics. Logically, you would have expected gold and silver to make new highs. That's not happened. And they're not collapsing as well because there is a lot of demand at lower levels. So I think they will consolidate. So don't expect serious returns in gold and silver. You should stay invested, but you should pick the right price to buy, which for me is 4,300 thereabouts for gold and 6570 thereabouts for silver. But coming back, I think the real opportunity is micro cap and small cap, because there is probably less FI selling or no FI selling, low DII ownership, and probably companies can do far better, in that landscape because they're not getting disrupted overnight.
Just to that point, Gautam, the opportunity certainly existed in March, but I'm just wondering, after this, and we were talking about it earlier in the week, out of the 500 stocks in the Nifty 500, you have, you had over 300 at one point that had gained 30% in the month of April alone. So you're saying that there still exists a lot of opportunities in the small and micro cap space?
I think so. So microcap index, just to put numbers, is up 22% from the recent lows. Small cap index is up about 18-19% from the recent lows, which is very large. Now, don't look at NSE 500 as a metrics because that's predominantly large caps. But if you look at the total market index, which is about 750 stocks, which I think will give you the exact color of the market. So I do believe that the real opportunity is in stocks where the market cap is somewhere between 1,000 crore and 30,000 crore. That's my working basket. In fact, that's what we have been recommending at Goldilocks. And I think you're going to see a lot of big moves coming in there. Remember, this entire space has seen massive price destruction for the last 18 months, where on an average stocks have fallen 45%, irrespective of the fundamentals. So the comeback had to happen. And even on down days right now, you are seeing a lot of micro caps and small caps. Even today, the micro cap and small cap screen was quite decent, I would say. So I think this is an opportunity which is likely to stay for the rest of the year, mainly because of domestic money.
I'm wondering, Gautam, are you then not at all constructive on the Nifty?
I'm not, Tamanna. I mean, it will keep you interested. It will keep jumping either side. It will keep tempting you both on the greed, and it will keep getting to a point where it will get a little fearful, but it will not break out or break down. Had this been a different kind of an environment where there was no domestic money, I would have said that we would have fallen a lot more. But I think it's good to be in a range. In technical analysis, we say that correction are of two types. One is when you actually fall and correct. The other is you go sideways and you correct. And I think we've gone through that sideways correction actually for the last 18 months, if you really look at it on an overall basis, which is good. And I think the market is finding its footing. Hopefully the next couple of quarters, the earnings season goes off well. And then I think people will start to realize that there is definitely an opportunity in India. But my bigger concern is there are just too many opportunities in the global landscape, around the world, with S&P 500 today at lifetime highs. I'm told Google came out with wonderful results just an hour back or something. So I think given all of that, you have to think globally as well and not just look at the Indian markets.
So are you saying, Gautam, invest globally and not in India right now? Because in India, if you're talking about markets, it's mainly with regards to domestic-oriented sectors and not anything which have exposures to the export-oriented markets. But apart from that, you could be looking at S&P 500. You could be looking at what's happening with the NASDAQ. These are these are indices which have actually jumped quite a bit.
Unfortunately for an average investor, it's very difficult to invest globally because you just don't have too many products. We can keep talking about it.
Thank you for saying
but an average retail investor or an HNI does not have that product. And even if some of the popular products that are available are a typical S&P 500 and a typical NASDAQ, which has already seen a massive move in the last 2.5 years. So that's genuinely a problem. But for somebody who's only looking at the India story, be in the right pockets. We really try to be in PSU metals.
You have to tell us a few more pockets apart from PSU metals, because our Desi guys, how many of them can invest, are investing. But you have to leave us before we wrap up and look for the next week with some great ideas, Gautam.
I must say this, diversification is dangerous. in today's market environment. We've all been learned that you need to diversify to do well at the markets.
Yeah.
Diversification has actually not worked for a lot of market participants in the last 2 years. And I think if you are concentrated and if you are in those select basket of stocks, very few handful of stocks in the large caps have done well, and a lot of stocks in the micro caps and small caps have done very well. So stay concentrated, stay in a huddle, stay with companies, which have nothing to do with foreign policies, stay with companies where there is earnings visibility for the next 5 to 10 years. And as I keep repeating, for me, it's metals, PSU and energy. I think they'll do much bigger things going forward. Do not try to buy growth which might be available at good prices. I think we can get weaker and weaker, and it's going to be more difficult for market participants in that environment.
Stay in a huddle. I think that's a good takeaway. Gautam, thank you so much for joining us on Editor's Cut this week. And I think wise words there. I don't remember the last time I heard Gautam Shah saying he's not constructive on the Nifty.
Nifty, yeah.
Yeah, that's telling to what kind of times we are in. Having said that, we started by saying that the word of the week is confusion. It's very possible that, in 24 hours from now, we'll be extremely optimistic. By Monday, the world could have changed and we don't know in which direction.
Yeah, I mean, you have 3 days to deal with where you are not going to see any market reaction, at least in India.
Yeah, flurry of posts and commentary that could come in, that could change
on either side.
On either side. So I suppose stay nimble is the biggest takeaway that we can give you. But that's all the time we have on Editor's Cut this week. Tell us what you think about the show. Tell us what you think we should add in it. And we're listening and waiting to hear from you. Thank you for watching. Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Economy, business, world, technology. Noise filtered, numbers decoded. Insights that rewire your worldview. From governance to growth, we connect the dots. Your daily edge, your global advantage. India Business Report with me, Gauri Dwivedi, weeknights on NDTV Profit.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management.
Benchmarks are under pressure with the Nifty ending below 24,000 mark. Sensex lost close to 600 points today. PSU banks and autos are the top sectoral losers, with all major sectors trading in the red. Rupee slides to fresh record low of 95 rupees 33 paise to a dollar, recovers from all-time low to close at 94 rupees 92 paise per dollar. Indian currency pressured by Hormuz tensions, leading to crude surge and FPI outflows. Oil on the boil. Brent crude spikes to wartime highs, hits 122 after Trump flags military options against Iran, eases slightly to $115 a barrel. HUL delivers a steady set of numbers, beating the street expectations across key matrices. Net profit, revenue and EBITDA all came in ahead of the estimates, while margins held firmly at 23.5%. HUL posts highest volume growth in 15 months at 6%. Amid looming Mythos AI threat, IBA holds a meet with the bankers in Mumbai. Sources tell NDTV Profit that FinMin is not keen on Indian banks getting direct access to Mythos. After passenger fury over last-minute flight cancellations at Mumbai airport, SpiceJet cites operational issues and bad weather. Bengaluru, Delhi and Ahmedabad routes faced major disruptions. Heatwave grips northern states as temperatures soar. Relief likely in parts of North India soon. Meanwhile, Bengaluru rain wreaks havoc, at least 7 killed in rain-related incidents. Hello and welcome. You've tuned into Profit 360. I'm Nisha Poddar, and over the next half an hour, we'll tell you all the important news developments of the day that you must know about. First, let's begin with the market. And the equity markets and the benchmarks are under pressure, with the Nifty ending below the 24,000 levels today, while the Sensex lost close to about 600 points. Now, all major sectors trading in the red. For a detailed market wrap and key movers and shakers, let's take it across to my colleague Jasmeet with all the market action. Jasmeet, tell us.
Well, thank you for that. A weak day for markets indeed. If you look at Nifty 50, it ends in red and closes below the crucial mark of 24,000 in today's trade. While small cap 250 and mid cap 150 also feel the heat and they end in red today as well. If you look at the weekly image, Nifty 50 ends in green over the week, but still closes below the 24,000 mark. While in terms of the broader markets have outperformed the benchmark over the week, while Nifty small cap 250 has gained nearly 2%. In terms of top gainers in small cap 250, we have stock like Cohen's Life Sciences and Sapphire Food among the top gainers in small cap 250. Now, Nifty mid cap 150 also ends in green for the week. And if you look at the top gainers of mid-cap 150, we have stocks like Sind International and OFSS, the Oracle Financial Services, which has gained among the top gainers in mid-cap 150 over the week. In terms of the key sectors, all sectors end in green, barring the financial aspect of Nifty. That's Nifty Financial Services, Nifty Bank and Nifty PSU Bank feel the heat and they end in red, but barring those, all the sectors have ended in green over the week. Now, in terms of top gainers, we have Nifty Oil and Gas gaining the most sector over the week, has gained over 2%. In terms of top gainers in oil and gas, we have stocks like Reliance Industries and ONGC among the top gainers. Now, if you look at the weak sector, the sector that lost the most over the week is something like a Nifty PSU Bank, where Indian Bank and Union Bank fall the most in over the week. So all in all, we do see a good image over the week, but during the day, the Nifty ended in red.
All right, and Jasmeet, there was also a fair bit of volatility during the trading sessions where the losses were much higher and then it recovered slightly. All right, let's also get an expert opinion going on the Indian markets and what's really pressuring the Indian markets and the outlook forward. Well, Mark Matthews told NDTV Profit that higher oil prices hits Asia far harder than the US, and given its importance as well as the import dependence of our markets, he says that's also why Asian markets are under pressure. Listen in.
If it stays at this level, it's definitely a fundamental threat for India. And that's why, by the way, Asia is underperforming this morning the United States. Not just India, but other countries in Asia as well are net oil importers. America is a net oil exporter. For America, it's more mixed than bad. For Asia, it's just plain bad, and that does include India.
All right, and it's not just the equity markets which are really seeing that pressure building, but it's also the currency market. In fact, the Indian rupee, that really slipped up, continuing with its depreciating trend over the last few days. Remember that rupee has hit a fresh historic low today, breaching the earlier record set on March 31st of the last year. Now, the currency closes at 94.92 against the US dollar. But remember, the all-time low that it has really touched today in the trading session was 95 rupees 33 paise against a dollar, which is the lowest level that the Indian rupee has ever seen. And on a broader basis, the rupee has now depreciated over 7% in the last 6 months and around 6% year to date, making it one of the weakest performing Asian currencies in this particular year. Now, the fall is being driven by a combination of factors, really. Surging crude oil prices really augurs very bad for the Indian rupee, and that's really a pressure point. And oil prices, remember, nearing $120 per barrel amid the Middle Eastern tensions. Now, India's heavy dependence on oil imports, a stronger US dollar, and also continued foreign portfolio outflows that are seen in the equity markets are the pressure points on the rupee. Global uncertainty is adding to that particular momentum. Now, with global uncertainty really intensifying, the pressure on the rupee remains elevated as the markets really brace up for further volatility. Let's also listen in an economist view on that, Sakshi Gupta from HDFC Bank, on the worrying levels of 95 to a dollar for rupee and how RBI could be looking at it.
They are not targeting, any particular levels on the rupee, right? This is a, continuous communication that has come in from the RBI and is very reflective in their actions. So I think it is more about the pace at which the rupee is moving. So, whether, a quick jump to 95 plus levels, of course, as I said, warrant some amount of, could warrant some amount of intervention from the RBI, but they do not have, 95 is not the line in the sand for them.
All right, so that was about the Indian markets, both equity as well as currency, and both being impacted by a single largest factor, which is the crude oil prices. Let's take account of that as well now. Now, the global markets are really seeing the surge in crude oil prices, with Brent holding above $118 to $121 per barrel range, and WTI really trading north of $107 a barrel as the geopolitical tensions in the Middle East really intensify. Now, the latest leg of the rally is being driven by the escalating concerns around Iran and stalled negotiations with US, and also remember the renewed risks around the Strait of Hormuz, which is a critical global shipping choke point. Now, the markets are pricing in a fresh geopolitical premium with fears of potential supply disruptions and even military escalation in Iran. Now, with energy inflation risks really returning to the spotlight, the key question is how sustained this spike could be and what it means for the global growth as well as the central bank policies across the world. Let's listen in to Nachiket Saurikar for more on this particular important factor.
The Strait of Hormuz is closed. We have now been using the inventories for 45 days as about 10-15 million barrels of supply is curtailed on a daily basis. And we are seeing the prices going up as a result. And these prices now will remain elevated at least till end of Q4. First, we need the straits to open, and after that, it will remain elevated for another 6 to 9 months as the countries have to go ahead and fill up their inventory. So now we have clarity that the oil prices are going to be higher for a much longer time.
All right, crude inventory really depleting fast, but of course the government is making measures of really restocking our fuel while Iran crisis really continues. So 12 million barrels of Venezuelan crude are now headed to India on 6 super tankers, expected to really replace a significant portion of Iraqi imports. And this comes as the US-Iran conflict really enters its 3rd month and the Strait of Hormuz blockade really continues continues to disrupt the global supplies, and India is also feeling the heat of that. A Kepler report really suggests that May deliveries of about 11.8 million barrels, just around 2 days of India's consumption, underscoring tight supply conditions as well. Now, Kepler also tells NDTV Profit that Russian crude remains both strategically as well as economically critical as India looks to diversify the sourcing of its fuel needs. Let's listen in to Sumit Ritolia, who leads the analyst group at Kepler.
It's not new that India is diversifying, like being dependent 90% of our energy requirement of crude. Like India has been diversifying from quite a few years, and given now the situation around Strait of Hormuz, diversification is very important. And as you pointed out, like Venezuela, it's a welcome move, I think. If you look at our data, also Venezuelan crude import, India used to import around 300-400 KBD, and as of now, what we are tracking in May and April, we might be at 6 years high of Venezuelan crude import. But that said, overall import has dipped. Like we see around 15 to 17% of dip, like what India was importing around 5 million barrels per day, 5 to 5.2. As of now, we are importing just around 4.2 to 4.4 million barrels a day of crude.
All right, let's now shift our focus to some big earnings of the day. Remember, we are in the thick of the earnings season. Adani Ports and SEZ posted a strong quarter. It is also the first Indian integrated transport operator to handle over 500 MMT of port cargo. Now, the Q4 revenues are up 26.5% at 10,738 crores. EBITDA is up 20.3% at 6,020 crore rupees. And net profit is up over 10% at 3,300 odd crores. Now, the important outlook that has been given by the company is that they expect the FY27 revenues at about 43,000 to 45,000 crore rupees, EBITDA at 25 to 26,000 crore rupees, and will also be looking at taking up a capex of 12,000 to 14,000 crore rupees in FY27. Let's listen in to the management. Ashwini Gupta, the whole-time director and CEO at Adani Ports and SEZ, on the company's quarterly performance and guidance forward.
Hello, and thank you for supporting us by having confidence in growth of APSEZ. We said 500 million metric tons, and India, along with our global businesses, delivered. This is not an operational statistic. It marks an India infrastructure movement. Now, I present another strong performance by APSEZ for FY26. Once again, we have exceeded our own guidance. APSEZ outperformed the upper end of revenue, EBITDA, and capex while closing with net debt to EBITDA at 1.9x and a ROCE of 16%. Another evidence of our healthy business growth with financial discipline. FY26 revenue grew by 25%, EBITDA grew by 20%, and PAT grew by 16%. During the year, we faced challenges and disruption. Operation Sindoor, geopolitical disturbances, and West Asia crisis. Still, we delivered, serving the nation by handling multiple challenging vessels like LPG, managing transshipment overflow from Middle East to hit 500 million metric ton. Every year, we set a guidance. Every year, we exceeded. This is not a luck. This is integrated in our culture. Reflecting on the strong performance and results, our board has recommended a dividend of rupees 7.5.
All right, Adani Ports management there announcing a dividend of 7.5 rupees. Adani Enterprises has reported a steady operational performance for the fourth quarter, with revenue really rising over 20% on a YOY basis to 32,400 crore rupees. It has also approved a 15,000 crore rupees of fundraise, which is signaling to expansion and capital requirements across businesses. It's also worth noting that this also includes a one-time gain of nearly 3,900 crore rupees in year-ago period, which impacts the comparability on the profit front of those numbers. So those are Adani Enterprises really numbers. But remember that global backing for India's clean energy push is getting stronger. Speaking in Delhi, Jeffrey Sachs, who's a professor at Columbia University, called the Adani Green expansion extraordinarily important for the country. He highlighted that the scale and forward-looking approach of the renewable push not only strengthens India's energy transition, but also positions it as a global leader in sustainable infrastructure. Listen in.
I think what the Adani green push is extraordinarily important for this country. Very smart. It's looking to the future, and it's operating at a major scale. So it's a very, very positive development. Very exciting for the whole world.
All right, let's talk about HUL. Of course, the stock has been beaten down after the results, but that was also probably the sentiment of the market today. But HUL's numbers were steady for the fourth quarter of FY26, where there was double-digit growth. But also remember that it posted the highest ever volume growth in last 15 quarters at 6%. In fact, Mahima is here with the fine print of those numbers. Mahima.
Yes, so overall, good set of numbers from HUL. In fact, a steady set of growth is what we are seeing. The revenue saw an uptick of around 8% EBITDA has overall seen a good growth of around 6% Margins have come in at a higher end of guidance at that 23.5% mark. The management, in fact, has gone ahead and said that the margins will remain in that range of 22.5% to 23.5% despite of the raw material inflation that we are seeing overall. And net profit has seen a good growth coming in at 21%. The focus, I think the key takeaways from the management interaction as well as the press conference were that the management remains focused on fewer and bigger bets, remain focused on volume-driven growth. They remain focused on premiumization as a whole. They've said that they are going to take calibrated price hikes anywhere between 2 to 5% because of the West Asia conflict. Margins, again, like I said, they said that it will remain in that range of 22.5 to 23.5%. And to maintain that, they will be taking calibrated cut in other expenses like media, advertisement, etc. In terms of overall, trade-wise perspective, they said that they're investing in general trade as well as they've, have had a separate team which